is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everyone. Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. So Constellation Brands, a really good barometer for any kind of trade issues between the U.S. and Mexico, issued a downbeat guidance due to some of those tariffs, plus muted demand. They now expect earnings of about $12.33 to $12.63 a share in the fiscal quarter for 2026. Ken Shea is Bloomberg Intelligence Senior Consumer Products Analyst joining us. Hey, Ken, we mentioned muted demand and tariffs. How much of the wobbliness is because we're just drinking less, and how much of it is because prices will be higher?
Yeah, hi, Alex. Well, you asked the million-dollar question here. There's so many moving parts to the Constellation storyline here. It's really a challenge on analysts to put it all together. But you touch on the right points, and that is the near-term challenges facing Constellation and other brewers, for that matter, is weak demand. A lot of it is economic. Constellation would also point to their key demographic is the Hispanic demographic, and they're having a little tougher time with the employment situation and the slowdown. But they have some longer-term threats also. I mean, you have more substitute products. You have legal cannabis. You have the hemp-based CBD THC products that are now gone Main Street. You don't have to go to a dispensary to buy THC anymore. You can just go to the local liquor store. You have the GLP-1 drugs, where people our studies show that are consuming less alcohol because they're on those drugs. All those things are weighing on the near term and perhaps longer term sales growth potential for beer. And that's what the analysts are trying to wrap their heads around right now.
What is the price elasticity on alcohol? Can these companies pass along price increases?
Well, it depends on the product, Paul. The good news among that otherwise onerous outlook is that Constellation's Corona and Modelo brands lead the market in terms of growth. Those products continue to command premium prices. They're growing faster than the market. So they're generating best-in-class operating margins on those products. But, you know, they're not immune to the slowdown. And clearly, they lowered their guidance yesterday. While their fiscal fourth quarter came in a little better than expected, some of the concerns out there is they lowered their longer-term sales growth projections. It used to be, a high single-digit kind of sales growing segment for many years. They came out and said, over the next few years, you're going to see more like low single-digit. And the analysts were a little taken aback by that. And to Alex's question before, how much is that near-term cyclical economic issues, and how much is longer-term demographic things weighing on this category? So no one really knows, and we'll find out.
Nobody knows, right? So then what does Constellation do about that? Like, do they go build a beer plant in the U.S.? Do they look for some M&A? Do they pare back? Like, what do they do? Well,
they're innovating. I would argue that Constellation is one of the more innovative beer companies. So they're taking that base of a really good brand family of Corona and Modelo, and they have Pacifico, but they also are extending into cheladas, which are very flavorful beer malt-based products. They're getting into the malt-based, seltzer markets a little bit. They used to do it, but I think they're coming back with a better product now. They have a no-alcohol version, Corona. So it's innovation, I think, that they believe can continue to drive sales growth. But there's no silver bullet. I mean, there's no big acquisition out there, I don't believe, that they're going to make to enhance their growth. I think they have a good brand and a good asset to grow. But again, you're not going to escape the long-term headwinds facing alcoholic beverage products in general, as a matter of fact.
So can you follow the beverages, the tobacco, and the cannabis companies? Is there a place to hide in your sector here in a world where we're going to see potentially slower growth from some of these trade policies?
Well, of the ones you mentioned, Paul, I mean, the tobacco, particularly cigarette company, those cigarettes are some 90% of that business still. They are pretty much immune to the tariff situation. It's pretty much a domestic business. Yes, there's some tobacco leaf imports that come in and so on, but by and large, that's a domestic business. So if you're worried about tariffs, perhaps that's a place where you can go. In terms of, beyond tariff threats, really the soft drink side of beverages is a good place to be. I would argue that even the tried and true carbonated beverage sodas, the diet sodas, are still performing pretty well. They're innovating well. Keurig Dr. Pepper continues to come out with new innovation that's moving that category. They're kind of leading that category's growth right now. They're doing a pretty good job doing it. So that's a good place to go in terms of the universe that I cover. Cannabis is tough. Cannabis, the regulation on cannabis is not easing. The Trump administration is not being kind to the cannabis industry, and we're not expecting much in the way of legalization, liberalization near term, with the exception of some states. Some states will probably continue to legalize, but from a federal point of view, I would wait for the next administration.
Yeah. Dr. Pepper. I haven't had Dr. Pepper in a long time.
Big Texas drink.
I think I kind of want one.
Yeah,
All
it's
right.
good.
They and they have Diet Dr. Pepper, too. This is cute.
Really?
All right, Ken, thanks a lot. Really appreciate it. Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst. I just want to point out, we've been talking about the back end of the curve, right? Moving pretty hard. So's the dollar. The Bloomberg Dollar Index is down a whopping almost 1.5%. Again, these are moves that you don't see in these kind of markets. And I think there was a zeitgeist, the conversation yesterday that, do you want the U.S. to start trading like an emerging market?
No, thank you.
And is that what we're kind of looking at?
Yep. So just a lot of uncertainty out there, certainly.
That kind of sums it all up.
Yep.
All right, that wraps it up for me and Paul on this Thursday. Balance of Power with David Gura and Kelly Lyons is up next after this global news update as you're taking a look at the equity markets still on the decline, S&P up over 4%.
This is CBS News on the Hour, sponsored by Steel.
I'm Steve Kathan. Another deep dive on Wall Street. A day after stocks soared, the Dow Jones Industrial Average is down about 1,500 points. And there's a new number that characterizes the trade war against China. CBS's Linda Kenyon at the White House.
The White House says it's a clarification. When President Trump yesterday announced a 125% tariff on Chinese imports, he did not include the previously announced penalty of 20% for fentanyl. By adding that penalty, the tariff against China is now 145%. The Trump administration says these escalating tariffs follow China's decision to retaliate with higher tariffs of its own against U.S.-made products.
Top Democrats are calling for an investigation into possible insider trading related to White House moves that paused tariffs yesterday against other countries ahead of the market surge. Latest look at inflation from the government shows prices in March rose 2.4% from 1 year ago. CBS's Jill Schlesinger breaks down the major components.
Consumers say they are bracing for higher prices, but at least in this report, the news was pretty good. Food costs were up by 3% from a year ago, while energy prices were down 3.3% from a year ago.
A close vote today in the House of Representatives.
The yeas are 216, the nays are 214. The motion is adopted without objection. The motion.
And by a narrow margin, Republicans pass a budget blueprint that's a key move to push through the Trump agenda, also passing a bill that would require proof of citizenship when registering to vote for federal elections. LA police have arrested the wife of Weezer bassist Scott Schreiner on suspicion of attempted murder after they came upon her during an unrelated chase. CBS's Elise Preston.
The chase through the backyards of several homes led police to Jill Schreiner. Police say she was holding a gun and pointed it at the officers. They commanded her to drop the weapon. When she didn't, they fired, wounding her in the shoulder.
A jury has awarded $1.68 billion to writer and director James Toback's accusers, as we hear from CBS's Michael Wallace.
Many of the 40 women claim Toback approached them on the streets of New York City, promised to make them movie stars, then sexually abused them. Toback was nominated for an Oscar for writing Bugsy.
I only thought this much before I'm going to kill someone.
He has long denied the allegations and has argued New York's 2022 law extending the statute of limitations on sexual abuse cases violated his constitutional rights.
OpenAI is countersuing Elon Musk, alleging unfair competition. And on Wall Street, recapping the situation, the Dow is down 1,691 points, the S&P down 260. This is CBS News. lot's been said in recent months about a former first couple's future together. Now the subject of some of the talk speaks out.
Former First Lady Michelle Obama has broken her silence about talk of an impending divorce.
Like all women and a lot of people, I operate from guilt. What should I do?
She explained on Sophia Bush's Work in Progress podcast that after years of letting her kids and her husband's schedules dictate her own,
I chose to do what was best for me.
The 61-year-old scoffs at speculation she and the former president have gone their separate ways after she was a no-show at President Trump's inauguration and Jimmy Carter's funeral. Deborah Rodriguez, CBS News.
The Italian fashion house Prada announced today it's reached a deal to buy longtime rival Versace for $1.38 billion. The deal will create a luxury group that could better compete with Gucci. I'm Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
A step forward turns into maybe a big step back for the equity markets. Welcome to Balance of Power. I'm Kaylee Lyons in Washington, D.C. Joe Matthew is off today, and joining me in his stead is Bloomberg's David Gura, who makes his trip to Washington in the midst of a trade war between the two largest economies, which our understanding about has changed a little bit as the 125 reciprocal tariff on China, which the president announced yesterday in an escalation, is added on to the 20% fentanyl-related tariffs, bringing the total to at least 145% in the market today, David. Certainly taking note of that.
Yeah, the enthusiasm that we saw yesterday certainly waning as the session goes on, and I think we see that wall between the U.S. and the Chinese economy getting higher and more fortified in the hours that have passed since yesterday, and I think a lot of concern and confusion about what's going to happen here over these next 3 months or so as these negotiations take place with the White House and all these countries.
Yeah, so maybe that's a taste of the bad news today. If there is any good news, if you're out there looking for it or you were hoping for progress on tax cuts, we did get that today on Capitol Hill. The House was able to pass a budget blueprint that had already passed the Senate that sets the stage for the real fight still ahead, which is crafting a reconciliation bill that's going to cut more than $1 trillion in spending, in theory, to make permanent or at least extend the 2017 tax cuts so you, again, have some forward progress. But it's kind of being shadowed by the tariff.
Absolutely, and this was no sure thing as well. You look at what played out yesterday on the Hill, and there was confusion once again as you saw kind of more right-wing members of the Republican caucus there having to leave the chamber with Speaker Mike Johnson to negotiate a series of cuts. They liked what they heard from the President of the United States and from the Speaker and eventually voted for it. But now I guess our focus shifts to what's the pathway going forward here for that legislation, sort of all of the President's legislative priorities.
Yeah, and maybe we'll hear from President Trump about that. I would note he is assembling a meeting of his cabinet, and the press is going to be allowed in at some point, which means we should have a taste that we can bring you live here on Bloomberg Radio when that begins. But much is unknown, as always, with this White House.
Absolutely. So as we look at the markets dropping here on this Thursday afternoon, the VIX rising once again, seeing that volatility, that fear gauge spiking once again. Let's turn to New York and Charlie Pellet for an update on the markets. Charlie?
Hi, thank you very much, David Gore. Thank you very much, Kaylee Lyons. You mentioned the VIX, 48.01 right now on the VIX. The Dow, the S&P, NASDAQ, very much in the red right now. However, let us keep this all in perspective. Yesterday, we had the S&P surging by 9.5%. NASDAQ yesterday up 12.2%. History, yes. So right now, we've got the S&P down 4.8%, down 261. Dow Industrials down 1,628, a drop of 4%. The NASDAQ Composite Index down 5.5%. Risk appetites vanishing after the biggest burst of buying in years. The 10-year at 4.37%. Your 2-year now at 3.81%. Spot gold trading right now at 31.56 the ounce. Gold advancing today by 2.4%, up $73. A retreat for West Texas Intermediate crude back below $60 a barrel, 59.42. WTI down by 4.7%. Tiffany Wilding is economist at PIMCO, and this morning on Surveillance, she talked about tariffs and markets.
You are seeing the president basically do what he said he would do on the campaign trail. We think the 10% tariff across the board, that's sticking. Higher tariffs on China is sticking. I mean, they are very effectively trying to decouple the U.S. economy from China, and that's exactly what they said they would do.
Tiffany Wilding of PIMCO. Speaking of China, it has announced it will curb imports of Hollywood films, opening a new front in its trade war with President Trump and the U.S. Shares of entertainment companies are being hit hard right now. Case in point, the Walt Disney Company down by 7.5%, Paramount Global down 1.5%, Warner Brothers Discovery plunging 13.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now with David Gura and Kaylee Lyons.
Charlie Pellet, thank you very much. David Gura here in for Joe Matthew, and we continue to process what happened yesterday, that extraordinary reversal that we saw in the markets. The president backing away from what he said was going to be a sustained plan to have a baseline tariff of 10% and a series of reciprocal tariffs on countries around the world. He decided to just go with that 10% baseline, with the exception of China. That tariff now well over 100%. Again, a huge market reversal yesterday. Here's what the president had to say after he decided to make that change.
There's a lot of winning out there, and we're having a good day in the stock market, as you can see, an all-time record day, and hopefully it continues. I think it should. Country's stronger than it's ever been, and somebody had to do that. We had to take the medicine. We had to go through the operation, and that's what we've been through, and a lot of presidents would not have done it. No president would have done it, I think.
So perhaps the president is not going to be super enthused to see that the market reaction is not continuing today, as we saw yesterday, as we contend with these tariffs, knowing full well that A, there is always still uncertainty out there as to whether or not the president could change his mind again, and B, because of that uncertainty, even with the delay, it already could have had or still will have an economic impact. And that is the subject of a piece of analysis that you can find on the Bloomberg Terminal and online today, in part written by our colleague Sean Donnan, Bloomberg senior economics writer, who is joining us now here on Balance of Power. So, Sean, as we consider that we had already heard from a number of corporations, be it Walmart or Delta, even Amazon reportedly was canceling inventory shipments from China. Even before this delay was announced, already we've seen it affecting behavior and, I would guess, the economy as a result.
Yeah, no, absolutely. And I think that's one of the big takeaways from the last 24 hours. Yes, while the president has scaled back some of his tariffs, we still are landing at this 10% baseline rate, which is going to cause a lot of recalculating related to supply chains for companies. But then you have this much bigger, really a prohibitive tariff of 145% now on imports from China. And, you know, what we're hearing over and over again from people in the supply chain business, from people who monitor the data, from actual companies who have orders, you know, waiting or literally at the kind of loading dock in China, to ship to the United States, is that they're all hitting the pause button. And that is going to hit the U.S. economy. It's going to hit the global economy. People, you know, some of the companies that we've been talking to have a few months worth of inventory that they can work through. But after that, it's, you know, huge question marks about what comes next. And that's this kind of uncertainty effect that economists have been talking about for weeks. When it comes to tariffs and the economy, you know, how do you build a factory in this climate? How do you hire people in this climate? Everyone's kind of hitting the pause button, and that's never good for the economy.
Sean, we've heard the president lean into two metaphors. One is medical. He talked about the patient and the medicine that he's administered. The other is sartorial, talking about the kind of tariffs he aims to put in place. And he said they're not off the rack. They're going to be bespoke. They're going to be tailored. And I'd love to get your sense of what these next 90 days look like, what the White House has telegraphed about how they're going to embark on all of these negotiations with all of these 70-plus nations, trading partners in the months ahead. Any clarity on what that's going to be like? And I think we all know that when it comes to these trade agreements in the past, these have been years-long endeavors in the making.
Look, let's just build on those metaphors. I think what the president announced yesterday is that the operation is going to take another 90 days. And what other people are saying is there's going to be some side effects to the medicine, and they may not be pretty. And then, you know, if we're talking about the suit, well, he's, you know, the off-the-rack suit is that 10% baseline tariff. Everyone gets that off-the-rack suit, and we're not moving into a world of tailor suits. We're moving into a world where, you know, they're going to be shortening the sleeve a little bit here and there to kind of fit the client. This is going to take time. A lot of these negotiations in, the kind of pre-Trump world took months and years to carry out. They're incredibly complicated. In fact, that's why a lot of times trade negotiations don't get concluded. It's just really hard stuff to do. The whole idea that you can solve all of the tariff barriers facing U.S. exports in the world in the next 90 days and get countries to agree to swallow a 10% baseline tariff, which is what the president seems to be doing. And we've heard from other parts of the administration that, getting below that 10% is only going to happen if you come with a kind of almost a miraculous deal from the other side. And then we also have these sectoral tariffs that other countries are going to want to see taken off. If you're Japan, if you're South Korea, if you're the European Union, these 25% auto tariffs are as meaningful as the 10% baseline tariff, and perhaps more so.
Yeah. Well, and there's steel and aluminum to consider. The president's still promising tariffs on pharmaceuticals, for example, possibly lumber, semiconductors. There is no sign that this is over yet, obviously, Sean. And to the point David was asking about the countries that do want to negotiate, I wonder about the countries that might not, specifically China. As the president argued yesterday, he thinks China wants to make a deal. But Sean, have we really seen any indication of that from Beijing?
No, look, I think the indication we're seeing from Beijing, at least publicly, is exactly the opposite of that. They are, battening down the hatches. They were meeting in Beijing today. We reported out of Asia earlier to kind of talk about the stimulus measures to kind of shore up the domestic economy to weather the tariff storm. I think there's a view in China that you hear from analysts is that the leadership in Beijing has decided that they can, plow ahead without the United States in that economic relationship if they need to. In fact, if you think back to the first Trump term and the Biden term and all the export controls that were put in place there that were meant to kind of limit China's access to semiconductors and other important products, they've been taking a kind of, if you're looking at it from Beijing's perspective, they've been seeing kind of hostility coming out of Washington for a while. This is obviously a huge escalation, but is it the type of thing that's going to cause you to enter a conversation? Do you think that these tariffs are going to go away? What is it that you can give to the United States to make Donald Trump happy? Donald Trump wants to eliminate the trade deficit with China. That's going to be pretty hard to do. And, meanwhile, caught in between these two economic giants are the companies that do business there and the consumers that buy those products. That smartphone is not getting any cheaper today.
Sean, we got about a minute left, and I'm looking here at the NASDAQ down about 6%, the S&P 500 down about 5%. Have we decoupled from China? This was something that the past administration pushed back on a lot. They said that wasn't their objective, to decouple from China. Are we effectively there with the tariffs where they are today?
So look, I think that the view of a lot of experts is that Donald Trump has never been someone who wants to decouple to China. He simply wants to sell more to China. But with these tariffs, they're becoming so prohibitive that we are certainly a lot closer to that decoupling cliff edge, as we put in the headline in the story that we ran out yesterday on this subject, than we were a year ago when Janet Yellen was in Beijing and saying America does not want to decouple. The cost of that would be too great.
Sean Donnan, thank you very much for the time. That's Sean Donnan, Bloomberg senior economics reporter, senior economics writer, and as Kayleigh said, a piece that I think both of us commend to you to read with him and Enda Curran writing it. This is Balance of Power on Bloomberg Radio.
Street. We do check markets all day long here at Bloomberg. We are looking at another down day for the U.S. stock market. This after yesterday's surge. Right now, we've got the S&P dropping by 5.7%. The S&P is down 313. Yesterday, you recall, the S&P 500 index gained 9.5%, but right now down 5.7%. The Dow is down by almost 2,000 points right now for the Dow. That represents a drop of 4.9%. NASDAQ is down 6.6%, down by 1,132 points. The 10-year at 4.36%, the 2-year 3.79%. Gold now at $31.60 the ounce. Spot gold surging 2.5%. West Texas Intermediate crude below $60 a barrel, very close to 59 even right now, down by 4.9%. And Bitcoin today is down 5.5%, 78,520 right now on Bitcoin. CarMax shares are plunging after backing away from the timing of its financial goals, joining a growing list of companies indicating that uncertainty around President Trump's trade war is making long-term planning difficult. Shares of the used car retailer, they are down now by just about 19.8%. Again, recapping another sell-off for the U.S. stock market with the S&P 500 index dropping now by 6%. Keep it locked into Bloomberg for the latest on these fast-moving markets. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Once again, your hosts, David Gurup and Kaylee Lyons.
All right, Charlie Pellet, keeping track of the steepening market losses today from New York. Thank you so much. I guess not many people paying attention to the words of the House Speaker, Mike Johnson, which actually sound pretty familiar to the words posted on True Social by Donald Trump yesterday about this being a good time to buy in the stock market. Certainly a lot of investors don't seem to be feeling that way at the moment, as there is no bid coming in like we saw yesterday. But of course, David, we were hearing from the speaker, not just talking about the markets, but also gloating because he was able to pass on the House floor something that we weren't totally sure last night he was going to be able to do, that budget blueprint that looked a little bit different coming from the Senate than what the House wanted. And yet he, with the help of President Trump, was able to get this thing done.
Spoke with a weary Carson Brennan Boyle last night, who'd spent the day kind of navigating all of this, uncertain of what the day was going to hold in those negotiations. But indeed, the speaker had conversations with the president and members of his caucus who were reluctant to go along with that initial piece of legislation. Mike Dorning is with us now. He's the deputy leader of our Capital Influence team here in Washington. Mike, contextualize this achievement here for the House Speaker. There was something familiar about what happened on the House floor yesterday when these kind of renegade members of the Republican caucus, and he had to walk out, get down to brass tacks, I guess, and try to hammer something out. What's your takeaway from what's happened, and what does it portend for these negotiations going forward?
So I think the most important takeaway whenever you're thinking about these is that the Republicans universally want these big tax cuts. So they're committed to this. They are going to get this done. They have some differences over how much to cut Medicaid and social safety net programs. And it's all about keeping that going. They have political momentum now, early in the year. Even though they don't really need to get this done until the end of the year, they don't want to risk becoming unpopular or their political momentum slipping. So they need to lock it in as soon as possible. So it's all about keeping that going. And you just have this tension between the moderate Republicans who would rather not cut Medicaid and food assistance so much, and the fiscal hawks are saying, we don't want to run up the debt too much. Yeah. And so this is all about norming differences and having squabbles and like positioning and a little screaming here and there.
In good measure. Yeah.
And it's just moving it along until someday they'll resolve that tension.
Well, and the tension you're speaking to is just the tension within the Republican conference in the House, not even the kind of tension that exists between what many people in the House want versus what the Senate may be willing to tolerate. We heard from the Senate Majority Leader John Thune, who also had to have a hand in convincing some of these holdouts that many senators, I think was what he said, view $1.5 trillion of cuts as a minimum. But that doesn't necessarily seem like a commitment to cut as much as the House wants.
That's a way of whitewashing away differences. Yeah, a lot of senators would like to do what you want to do, but like, he's not saying that we will do that. Yeah. He's just saying, yeah, a bunch of people. It sounds good in the moment when you're saying it, but like any good politician, he knows how to sound like he's assuaging you without really committing to anything other than I feel your pain.
Mike, a question just about the atmospherics on Capitol Hill. So we were talking about the way that the speaker has embraced all of this, but as we look at our terminals here and see the NASDAQ down 6.8% today, the sell-off deepening and extending despite what happened yesterday with the president's announcement. How does the conversation shift? How much introspection is there about the way in which all of this has been sequenced, and how much irritation is there among Republicans that this component of the president's economic package wasn't what came first, it was the tariffs?
So the Republicans are, underneath the surface, pretty divided on the tariff program, and there's a lot of traditional Republicans that really are free traders and not that interested in the tariffs. But publicly they will say, hey, Trump's just trying to get a fair deal and, you know, he's doing the right thing. But you can see that they're worried, but they don't feel like there's much they can do. And particularly for a lot of Republican senators in particular, but even House members represent agricultural areas. And those are areas that are going to get hit hard by the retaliation from China, and they would get hit harder if other places retaliated. Yeah. Last time, Trump essentially just wrote them a check for their losses. But their losses are going to be bigger this time, and it's just going to be harder to manage writing like a big check at the same time that you're cutting Medicaid and food assistance and tax cuts and talk about debts and things. They'll probably manage to do it in the end, but those people get nervous.
All right, Bloomberg's Mike Dorning, who helps lead our Capital Influence team here in Washington. Thank you so much for joining us on this day. Well, you may be able to cling to some good news on Capitol Hill in terms of forward progress. Markets don't seem to be taking much stock in the prospect of tax cuts coming down the line. As we just saw, the NASDAQ 100 briefly cross 7% declines, right now down about 6.6%. The S&P 500 down the better part of 6 percentage points as well. And a lot of that selling pressure is into the technology stocks that were absolutely ripping yesterday. Apple, after having its best day since 1998, is now down about 7.25% on the day. NVIDIA is down 11 percentage points as they contend with the 145% tariff that is on Chinese goods. And all of this, David, overshadowing what could have been good news for the markets in terms of inflation data today as well.
We got that CPI data from the Labor Department this morning. CPI excluding food and energy up 1.1% since February. The entire overall CPI down 0.1% since February. So yes, it could have been good news, as you say,
and yet
been eclipsed by all of this.
But let's still talk about that data, even though it doesn't seem to be making much difference in risk appetite today. Stuart Paul of Bloomberg Economics is joining us here from New York. So, Stuart, just talk about the data, which obviously doesn't reflect the impact of whatever tariffs were put into place anyway. But does this send a positive signal about the economy, or do the fact that it is backward-looking data completely override any positivity?
Well, so it depends what we're really thinking about. So if we're thinking strictly about the reciprocal tariffs that have been put in place, you're right. The data don't reflect anything about the reciprocal tariffs. If we're thinking about the tariffs, the supplemental or additional tariffs that were implemented on China, particularly with regard to fentanyl, this should, back in February, this should have shown some of the tariff impact that was imposed on China. Instead, we saw core goods deflation, and we saw consumers pulling back spending. We saw limited price pressures on some of the more discretionary services categories, things like airfares, hotels, and car rentals. So things really related to travel, those are really sentiment-driven. They're really discretionary services categories. So if we could take anything from the report today, it is that even though there were some tariffs in place, limited tariffs on China, there was not full pass-through on the goods that would be most effective, and sentiment is starting to have an effect on some of the harder data. We are seeing the categories most affected by sentiment showing less price pressures. Those are those discretionary services categories.
The Fed obviously taking notice of all of this, and Austin Goolsbee, the Chicago Fed president, speaking at the Economic Club of New York, as we're on air, talking a bit about the inflationary aspect of these tariffs, saying they make both sides of the Fed's mandate worse. They deliver a stagflationary shock to the economy. Stuart, what's your sense of how they are processing this? I think back just a couple of weeks ago, Fed Chair Jerome Powell really adamant that the Fed was going to, for the moment at least, be able to kind of look through these tariffs. Obviously, seeing how they play out, what they were going to be and how they're going to play out. How does the Fed sort of think through the tariffs and dovetail that with the data that we got this morning?
There are a few different factors that are in play. So not only is the Fed thinking about tariffs, they're also thinking about tax policy, immigration policy, and so on. And whenever Chairman Powell has the microphone, he's quick to remind listeners that the Fed has to take into account the totality of all these policy changes. As you mentioned, there is two-sided risk to tariffs. That's to say that it does create some demand destruction, and so you could see lower real growth, but it also creates inflation pressures, and the Fed needs to contain that inflation. So what's the Fed going to do? Is it going to hike or is it going to cut? Well, in the same set of comments from Austin Goolsbee, he reminded folks that the Fed's timeline is not the same as the market's timeline. Now, markets are pricing in about 92 basis points of cuts from the Fed this year. In the latest summary of economic projections, the Fed showed just about 50 basis points of cuts. If you think, as we do, that the Fed is going to be more concerned about inflation pressures than slowing growth, you would think that the Fed might even cut just one time in December of this year. And I think that it's that realization that could be taking some of the steam out of equities, that could be resulting in some of this retracing that we're seeing.
Well, and that's just what's going on in equities. I also want to talk about the bond market, Stuart, because the president specifically called it out yesterday when talking about his decision to implement this 90-day pause on reciprocal tariffs. He said he saw the bond market getting queasy. He felt that people, and this is his word choice, were getting yippy.
Yippy.
Right now, we're up 3 basis points on the 10-year, 4.36. The 2-year yield, of course, the Fed-sensitive part of the curve, down 9 basis points at 3.81. But clearly, the president got a little bit spooked by what he saw in the bond market earlier this week, Stuart. And I wonder, as you're considering kind of where the economy is and the kind of Fed uncertainty, the pressures that now exist with tariffs, if you actually think the president, with his pause, was able to get the bond market out of the woods, or is there a possibility that the Fed might need to intervene in the bond market at some point?
Yeah, Kaylee, I don't think that the Fed is going to be rushing to provide liquidity. I don't think that they view it as necessary right now. The 3 big pillars that have been affecting the bond market over the last 36 hours have been, 1, fear about China dumping securities, but it doesn't look like that's the case. Fear over a leveraged basis trade resulting in financial stability concerns and additional instability that might force the Fed to intervene, to your point. And third, just a couple of auctions yesterday and today that have people a little bit nervous. Are banks, are dealers going to have the space on their balance sheet to take down the bonds that are being auctioned? Is there demand out there in the market for the bonds that are being auctioned, especially given what we've been seeing over on Capitol Hill and with concerns about the extent to which the U.S. is going to be able to grow out of its increasing debt burden? And with all of those factors in play, it's all contributing to the queasiness. It's not necessarily a reason for the Fed to step in imminently, certainly not imminently, and instead we're just going to need to see some auction results.
Seems like we may be seeing a second bout of that queasiness, and you mentioned the Fed stepping in should it come to that. What does that look like? If you're to imagine that or play clairvoyant here, what could the Fed do? What are they watching in particular? We, of course, know that China holds so many U.S. treasuries.
Yeah, so the international capital flows data that would reveal officially whether China has been dumping bonds, it comes very much so with a delay, but I think that the larger point is that China's been holding its U.S. securities portfolio basically constant for over a decade at this point, and the volume of long-term securities that it has on its balance sheet is not necessarily the thing that's going to cause the most concern. What would cause more concern, especially for the Fed, would be if something like a basis trade were to be blowing up, but it doesn't look like that's the case. So what tools does the Fed have in its arsenal? It can basically provide unlimited overnight liquidity if it wants to. There's very little that the Fed that limits the Fed's capacity. I think that the Fed would, however, be very slow to lower interest rates, even in response to, let's call it bond market queasiness. I think that the Fed would only lower rates in pretty dire circumstances. Doing so, a supposed emergency rate cut would actually instill more fear in markets. And so I don't think that the Fed is going to be rushing to respond through interest rate policy to any sort of queasiness that we're seeing.
Well, so there's that. I guess you're not necessarily going to see the cavalry riding through to the rescue in terms of the monetary policymakers, which puts more onus on the fiscal policymakers and what's coming out of the White House, Stuart. And they continually have argued that even with this kind of pause period in which they're going to be negotiating better trade deals, that these deals are aimed at getting a better deal for America and also bringing back manufacturing to the United States. Can you just talk about, A, how long it would take if those investments were to materialize on the part of companies deciding to build out more infrastructure and hire more people here, but also how difficult that is to do in an environment like the one we are currently experiencing?
It's going to take a long time. Even the money that's been offered up, even the money that, the $1 trillion or so that's been waved around as investments by foreign companies and foreign countries in the United States, it takes a long time to stand up. Even brownfield investments, new factories, it takes years, 18 months at a minimum, to really start ramping up U.S. capacity in a meaningful way. I think that instead what we're likely to see is, in the interim, would be an increase in U.S. capacity utilization, which right now is running at about 78%. Instead, even just based on sentiment, you see, however, a retreat in factory activity. We just saw that in March, according to PMIs, manufacturing PMIs. Looking ahead to next week, one of the first data points we're going to get next week is March industrial production. And we're expecting factory output to be basically flat, right? Even though all these manufacturers are seeing tariff threats, they're seeing tariffs that are being put in place. The actual increase in aggregate hours worked in the manufacturing industry was just a few thousand hours in March. So it really does take a long time to get those factories fired up in response to tariff policy. And what we saw just yesterday, this walk back of tariff policy for everybody but China, basically, is reason for companies to sort of slow their roll when it comes to investment. And the final thing to think about is that all of this uncertainty puts upward pressure on rates. When you're financing a brand new factory or a retooling of a factory that's been sitting idle for decades, you don't want to see higher financing costs. So the upward march in interest rates right now is something that's going to take some of the steam again out of the idea that factories could be fired up.
Stuart, last question here. As you're kind of going through your calculus and looking at the health of this economy, you mentioned sentiment just a moment ago. At a moment like this where there is so much uncertainty, how much do you kind of hold that up higher than the hard data? So we're kind of waiting for this moment in which the hard data might reflect those inflationary pressures we've been talking about. How much at this moment does sentiment matter to you as you try to get a handle on where the economy is today and where it's going?
Under normal circumstances, I put very little stock in sentiment. Under current circumstances where conditions on the ground are evolving so quickly and the news cycle is evolving so quickly, it's actually far more important to put a lot of stock in sentiment data. And when you see political uncertainty indexes spiking through the roof, when you see that taking some steam out of investment plans, when you see companies that are both revising guidance or even just withdrawing guidance completely, I think that actually matters a lot. So as we get deeper into earnings season, even beyond sentiment, I'm going to be looking towards guidance for some insight, especially into investment plans, and then that's going to matter a lot for developing forecasts for the larger macro data prints.
And in these early days of earnings season, seeing a lot of kind of revamping of those forecasts, that forward guidance. Stuart Paul, thank you very much. Stuart Paul, U.S. economist with Bloomberg Economics. As I look at my Bloomberg screen, see a lot of red on it. I know Charlie Pellet does as well. Let's go to him in New York for an update on these markets this afternoon. All right.
I thank you very much, David Gore. Thank you very much, Kaylee Lyons. We are off session lows right now, but let's get right to the numbers. We'll keep it all in context for you here at Bloomberg. S&P right now is down 4.94%, looking at a drop currently of 268 points. You run the HCPI function on the Bloomberg. We can see at the worst level a few minutes ago we had the S&P down by 6.3%. Again, keeping it in context, down now by 4.9%. The Dow down 1,722 points, down 4.2%. NASDAQ is down 997 points now, a decline of 5.8%. So the bottom line, stocks are sinking as investors continue to worry about the impact of the U.S.-China trade war on corporate earnings, economic growth, and new hiring. The 10-year, 4.34%. The 2-year, 3.84%. 3.80% on the 2-year. Spot gold up $82 the ounce, up 2.7%, $31.65. And West Texas Intermediate crude now down 4.9%, $59.34 a barrel. So again, equity markets selling off. The Dow, the S&P, NASDAQ deeply in the red. We are off session lows. The Russell 2000 index of small cap shares down 5.5%. Again, the S&P right now down by 4.9%. You got to keep it locked into Bloomberg Radio to find out how things shake out right through the closing bell, and of course how Asian markets react tonight. Again, right now the S&P down by 5%. Balance of power continues right now, and back we go to Washington. Once again, your hosts David Gurup and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. I said it yesterday, what a difference a day makes. And once again, a different day and a very different story in these markets than what we were dealing with yesterday. As the president, of course, yesterday announced a 90-day pause on reciprocal tariffs for countries that hadn't retaliated against the U.S. That means everybody but China. And his reasons for doing so were in part due to market activity, the kind of which we are seeing once again today. Although while we're focused on equities today, the president seemed specifically to be worried about the bond market. Here's a reminder of his commentary.
I thought that people were jumping a little bit out of line. They were getting yippy. Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. I saw last night where people were getting a little queasy. The big move wasn't what I did today. The big move was what I did on Liberation Day.
Markets apparently getting a little yippy again today, as we just heard there from Charlie Pellet. I want to bring in Rick Davis, partner at Stonecourt Capital, Jeannie Sheehan Zaino, senior democracy fellow at the Center for the Study of the Presidency and Congress, Bloomberg Politics contributors both. And Rick, let me start with you. And you watched what unfolded yesterday, and there was kind of a uniqueness to that moment, what the president did there. I'm curious sort of what you think the path forward here is for the president if we see this kind of sell-off deepen further and perhaps go into resurface or continue over the course of these next 90 days? What are his options? They seem decidedly more limited in light of what happened yesterday.
Well, you know, I don't know if they're more limited, but, you know, yesterday reminded me of running John McCain's presidential campaign in 2008 when the markets collapsed and Congress said, oh, we're going to come to the rescue with this TARP bailout, and then they couldn't get the votes for it, and the markets were swinging wildly, mostly down, and I thought this is the biggest impact on a global financial market by Congress in history. And yesterday was the biggest impact of our markets by a president in history. So we see the decisions being made at the government level having just really profound impacts on our markets and our economy. And this is a global impact that the president had yesterday. So look, I mean, I think that what we're hearing today is that more and more executives, more and more bankers are saying, hey, if you can actually rationalize these 75 countries that are saying, hey, let's negotiate to a fairer trade regime than what we started with, then maybe some of this pain and anguish that we're going through right now will be worth it. But let's go cut some deals. Let's show progress there. And I think that hopefulness is partly what we saw happen yesterday when the president delayed the reciprocal tariff implementation by 90 days. So I would say there is some upside for this president, but he's enjoying the downside right now. Clearly, he isn't worried about it, but we are starting to see a profound impact on his popularity ratings, and tariffs are showing up in these polls for, you know, one of the first times.
Yeah. Yeah, evidenced by the YouGov poll, where his popularity is the lowest it's been since he retook office. It's interesting, though, Jeannie, because the tone from the president yesterday about the markets was different than what he had been trying to strike in the days before. When our colleague Anne-Marie Hordern, who was traveling with him on Air Force One, asked if there was going to be a Trump put at some point, and he completely rejected the premise of that question, said he wasn't worried about the markets, and still yesterday happened the way that it did. And I do wonder if you think we have learned something here about what the president is and is not willing to talk or tolerate, or is it less about President Trump himself and more about those around him, his economic team like Kevin Hassett and Scott Bessent and Howard Lutnick, what they are willing to tolerate?
Yeah, I'll tell you what I learned, Kaylee. Number one, I learned the definition of the word yip and yippee. So that was very helpful for me, as I'm not a golfer. But the other thing I learned is he is not nearly as tough as Thelma and Louise. There he told us he was going to drive right off this cliff. There was no negotiation. There was no turning back. This is a commitment he's had since he was a kid. And he's been very vocal about his favorite word. And yet when the pressure came, and it came particularly from the markets and the bond market, as you guys have been talking about, he did blink. And this is the, I think, largest U-turn we've ever seen a president make. And so while Rick is saying there may be an upside for the president, I find it hard to believe. This is a political disaster for a president who has made his mark saying he is tough as nails. You know what? In politics, sometimes it's better to be wrong and strong, that old adage. And what he showed us is he's not willing to be strong against this. Now, do I think he should have been? I don't agree with the policy, but it was a policy of his own making he's deeply committed to, and we've seen where it went. And of course, the markets woke up today and said, wow, this is an uncommitted disaster because we still don't have any certainty. So I don't see a lot of upside for the president at this point.
Rick Davis, let's talk about the pressures the president has been and is under. So yesterday we know from Bloomberg's reporting, he was monitoring the markets very carefully. He saw that queasiness in the bond market overnight. That was something that gave him some agita apparently, and then woke up and saw on Fox Business, Maria Bartiromo interviewing Jamie Dimon, the CEO of JP Morgan Chase. He took note at the kind of praise for tariffs, I guess, in broad strokes, but the worry about a potential recession. Then there's what we've heard from Congress. So we had the first opportunity to have comments from Jamieson Greer, the president's trade representative on Capitol Hill for 2 days, testifying before the House and the Senate. We saw lawmakers expressing perhaps some confusion, uncertainty about the president's policies when it comes to trade. And we know that he spoke with Senator Lindsey Graham, a close ally as well, yesterday. How much did we see that terrain shift over these last few days? Members of Congress who had been kind of in lockstep with him on trade and tariffs policy beginning to, if not express outrage, raise some concern or questions about the way all of this has proceeded.
Yeah, and I think you keyed on an important aspect of congressional concern, and that is, what is the policy? I think that there would be more support in Congress with Republicans if there was a static and very clear plan that said, here's what we're embarked upon. Here's how the trade reorganization globally is going to work. Here's the benefits, and this is what the costs are going to be to the American people. And yet, right now, we hear the president, he got out early and said, hey, this is going to be painful. We got to go through, take our medicine to get to a good place. Yeah. But we're not going to negotiate. And then, as Jeannie said, now the biggest talking point that seems to be helping the markets is, hey, we're going to negotiate with 75 countries. And so Republicans get out there and they go home and they talk to their constituents. They say, hey, we're not going to negotiate. This is the way we get manufacturing brought back to America. These are going to be great jobs, and we're going to be less dependent upon people around the world.
Well, and Rick
then
Davis,
they turn around and cut a deal.
Well, and President Trump is talking about the prospects of the deal, saying he's going to try to get the world to treat us fairly. He's speaking right now in the cabinet room at the White House. Let's go there live here on Bloomberg Radio and on YouTube.
Very strong country, but we have Scott here and Howard and some of the people that are working on deals, and the biggest problem they have is they don't have enough time in the day. Everybody wants to come and make a deal, and we're working with a lot of different countries, and it's all going to work out very well. I think it's going to work out really very well, but we're in good shape. There's no inflation. There's very little inflation, and I went 4 years without inflation, and I took in hundreds of billions of dollars from China and others, taxes in China. But we took in hundreds of billions of dollars a year from China, and we had no inflation, essentially. So we think we're in very good shape. We think we're doing very well. Again, there'll be a transition cost and transition problems, but in the end, it's going to be a beautiful thing. We're doing again what we should have done many years ago. We let it get out of control, and we allowed some countries to get very big and very rich at our expense, and can't let that happen. It's not a sustainable formula. So I wanted to just thank everybody at the table, and maybe I'll go around and ask some of you a little short couple of answers. Pete just got back from Panama, and he's been all over the place, and you want to give us a little report on that and whatever else you might have to say. Everyone at this table is doing an incredible job, by the way, I have to say. Incredible. And the relationships it's like they're friends. There's really, The relationships are very strong, really good, really strong. And these meetings are very good. And I think, you know, I don't believe there's any other president that allowed the press to come into a meeting such as this. These are very sacred meetings. These are very private meetings, but we have nothing to hide. And I think it's good. I think it's a good, we want to be, a word you like to use, Jeff, is transparent. So we want to be transparent, and we'll do that by starting with Pete. Go ahead, Pete.
Yes, Mr. President, we just got back from Panama last night. We were at the Panama Canal with their Southcom commander ships, F-18s, troops, and signed a couple of historic deals. One which is with the Panama Canal Authority, a framework for U.S. vessels, first and free through the Panama Canal. Right. And then also a memorandum of understanding with their security minister for the presence of U.S. troops. Fort Sherman is an old U.S. base there, as well as their naval station and air station, jointly with Panama to secure the Panama Canal from Chinese influence. That's something you said, we're taking back the canal. China said too much influence. Obama and others let them creep in. We, along with Panama, are pushing them out, sir. And so we had a very successful trip there. President Molino sends his regards, very complimentary of the U.S. as he's a great ally, and I think they want the Communist Chinese out. And with our troops there partnering with their forces, we've got a chance to push them all the way out, sir.
We've moved a lot of troops to Panama and filled up some areas that we used to have, and we didn't have any longer, but we have them now. And I think it's in very good control, right?
Yes, sir.
Okay. Thank you, Pete. Very good. Howard?
So, so we've have so many countries to talk to. It is, it's incredible. I think Scott and I'm not sure we could ever have enough time in the day to talk to all these countries because they want to talk and they want to talk now, and they have come with offers that they never, ever would have come with, but for the moves that the president has made. Demanding that people treat the United States with respect. We're getting the respect we deserve now, and I think you're going to see historic deals one after the other. And then I'm very excited that within a week and a half, we're going to start with the gold card. And the Trump card is coming out, and we're very excited about that, and that's coming soon. So very excited.
Thank you very much. Good job. Linda?
Well, on a couple of fronts, we have been addressing the issue of anti-Semitism on campuses. There's been some grant funding and contract funding that we've reviewed, and some canceled and some we've put on hold, waiting for that, while we do an investigation. On the other side of what my responsibilities are in having education go back to the states, we're meeting and talking with governors. I was with, this week, all 50 commissioners of education around the country, and because we also want to provide them with tools and best practices as education does move back to the states. Making great progress, great response from the states, and very positive.
And what about colleges? You're holding back $400 million from Columbia, $8 billion from Harvard. Can you imagine the money we pay Harvard? They have a $60 billion fund, and we're giving them $8 billion, and we're trying to figure that out. And then they hire de Blasio, the worst mayor in the history of New York, and they hired the woman from Chicago who was a disaster, total disaster, and they pay them massive salaries, and they're supposed to be teaching you government. That's not Harvard. That's not Harvard the way it used to be. So do you have anything to say about that? The dollars you're holding back from quite a few universities that were not behaving.
Yeah, and the other, there's some Princeton, Cornell, others that are coming in, and actually getting calls now from the presidents of the universities who really do want to come in and sit down and have discussions. And so we're investigating them, but in the meantime, we're holding back the grant and the fund money.
Okay. Great job. Thank you.
Very thankful for the House voting for the president's budget resolution along with the Senate bill. Made a ton of progress this week in working with members to ensure that a desire for flexibility in the Senate was not misconstrued as a desire not to slow and do spending reforms. And so we're very thankful for that. And now we can get after writing that bill, getting the president as big a package of his agenda to his desk. So very good week.
Good. That's right. We just got the House vote. And now we're well on our way to getting, as we call it, the great big beautiful bill. It's a beauty. There's never been a bill like this one. We're trying to get it all into one beautiful bill. It's tax cuts, regulation cuts, and many other things. The border, a lot of money for the border. You're doing a fantastic job. So, but we just got a report that we, as you know, you knew before us. Were you surprised we got the vote? And we're happy to get the vote. So I think we're going to be in very good shape. Okay, please.
Mr. President, last year, the Chinese received 1,700 orders for new ships. American shipyards received 5. Under your leadership, like so many other industries, we are going to revitalize and make shipbuilding and maritime great again with these blue-collar jobs. These are the cranes, the ports, opportunity zones, and drive that investment back in. We have, under that executive order, and also one to streamline foreign military sales for people that want to buy our equipment, and of course acquisition reform, all just this week under your leadership, Mr. President.
So we're going to be rebuilding our shipbuilding business. We may would have to go to Congress for this, but we may buy some ships from other countries that we're close to and that do great jobs with ships, but we're going to start the process of rebuilding. We don't really essentially build ships anymore, which is ridiculous. It's going to be a very big business for us in the not too distant future, but in the meantime, we have countries that do very well at building ships, and we'll be dealing with those countries, and we may be ordering top-of-the-line ships from those countries. And within a fairly short period of time, we'll be building our own ships. So we'll probably have to go to Congress for that, but we're not going to have a problem. Susie, thank you very much for the job you've done. Go ahead, please.
I just wanted to make sure you know that this cabinet, I think, pretty uniquely collaborates and cooperates and works together to accomplish all that you've asked them to do, and I think they deserve a lot of credit for that.
It's true. You're doing a great job. The chief of staff, doing a great job. Lee, go ahead.
Mr. President, the Biden EPA was strangulating the economy. The Trump EPA understands it's not a binary choice. We can protect the environment and grow the economy. Working with Doge and Elon Musk, we've now canceled $22 billion worth of grants, and we have launched what is the largest deregulatory action in the history of the country. Just in one agency, that's how much of a mess the Biden EPA left us. It is going to end up reducing the cost of living. It's going to create jobs. It's going to make it easier to purchase a car. It will be easier to heat your home. We're proud of this effort. The effort that we have is fulfilling the mandate that you earned from the American public. Clean air, land, and water for all Americans, unleashing energy dominance, permitting reform, advancing cooperative federalism, making America the AI capital of the world, and bringing back American auto jobs. When you called me that day asking for me to take this position, I was honored. And you were very specific and clear in what you wanted us to accomplish. We understand our mission, and at the Trump EPA, we're going to make you proud.
Great job. You're doing a great job. And you have a lot of applications for approvals for power plants, which are going to really power the regular plants, and they're going to be right next to each other because we can't rely on our grid. It's old and it's tired, and it's very subject to being attacked, whether by rain or by bombs or by anything else. And we're letting people build their own power plants, and these are a lot of them being built with the AI and beyond the AI chips, and we're letting them build their own power, and never been done before, and we're going to get it done quickly and approved quickly as part of a plant. They'll have a sort of be their own power company, and it's very exciting. They couldn't believe it when I told them that. I said, we're going to get you the approvals very fast as part of your regular plant. You're going to build electric producing plants, and it's very exciting. And they're able to do it very quickly and very well. And you made it possible. Thank you. You have a lot of applications for some of the biggest plants that have ever been built in the world. These are serious plants, aren't they? Huh?
Approved. We are open for business. Working with Secretary Burgum and Secretary Wright, we are going to make you proud.
Sean?
First off, Mr. President, it's Brooke's birthday today, so she keeps getting younger, so happy birthday to Brooke. I want to thank you as well for the shipbuilding at EO. Again, to build ships, you also need mariners to sail those ships. I was just up at Kings Point for the Merchant Marine Academy a couple days ago, and we have some of the greatest young men and women who are learning how to be mechanical engineers, to rebuild and fix the engines on those ships, but also how to sail ships. I would tell you that over the past decades, this academy has become, it needs some love. It's been a little bit dilapidated. We have to invest in sailors, and I appreciate you taking the initiative. To be a global power, we have to build ships and have sailors to sail those ships. These are the very people that help Pete should we come into points of crisis to support the military. So thank you for that. Number two, the last administration announced 3,200 projects, big, beautiful roads and bridges. Most of them are good. But they announced them, they didn't sign a grant agreement. 3,200, so the money doesn't go out the door to build the infrastructure in the country. And it's fun to do an announcement. It's actually the harder work to put together these grant agreements. So we're doing the work right now at DOT to get these grant agreements done and build the projects. Most of them are good. And they also put in all of this green and social justice requirements on roads and bridges. We're pulling all that out and putting the money toward the infrastructure, not the social movement from the last administration.
Good steel, right, as opposed to green paper mache. Okay, thanks. Great job.
Sir, first, we are, I would say, more than friends. We've all become family, and I think that what you have assembled in your vision is a turning point and an inflection point in American history. And so just being a part of that is the greatest honor. So thank you for that. And again, just the relationships here and the honor and respect we have for each other is a reflection of you and your leadership. So I just wanted to say that first. The second thing I want to say is that on behalf of the farmers and ranchers, food security is national security. We have to be able to feed ourselves. And your idea of using tariffs along with deregulation and tax cuts, but your idea of using tariffs to ensure that we are putting forward and putting America first, no one understands that better than our farmers and our ranchers. But having said that, emerging from 4 years of Biden with a 30% increase in inputs for our farmers and ranchers, with an almost $50 billion trade deficit. When we left the first time, it was zero, meaning that they are hurting. So the period of uncertainty we're in, they know that your vision will move us into an age of prosperity for all Americans, but for my people, for the farmers and ranchers, unlike any they have seen before. And I think they are really, really excited and so grateful for your leadership. But also, you have never failed to say that you have the backs of our farmers and our ranchers. It was the first phone call that I had after I was voted with the Senate, and that message just resonates with almost an 85% support of you in the last election. They're with you. Interestingly, the biggest budget driver at the United States Department of Agriculture is not farming and ranching or agriculture, it's food stamps. And so as we emerge and embark, Secretary Kennedy and I, on your vision of making America healthy again, a massive part of that is realigning and reworking our food stamp program so that it better serves those who need it. And yeah, to the point of getting the transgender, DEI, Green New Deal out of the USDA and realigning is really important. So
It's out of the
thank
military,
you.
right? Sir. Is it 100% out, would you say?
99.9, sir. I'm going to get that last point.
Get the
out.
rest of it.
But thank you, sir.
We've got a much different military, I will tell you. Thanks very much. Good job. And eggs are down.
Eggs are
big,
down.
right?
Yes.
Big.
Yes, sir. Wholesale prices. Retail will come. Easter is the Super Bowl for eggs. So, you know, there may be a little fluctuation, but no, we feel really good about it. Thank you.
That's what I hear. Thank you.
Thank you.
Good. I'd echo what Howard said on the trade cube, that we've got over 75 countries that want to come in. So it'll be Treasury, Commerce, Jameson at USTR, and we're putting a process in place. And as you said, you're going to be part of the negotiations too, because I've had these countries call me up and Secretary Bessem, we're happy you're going to be negotiating. Well, President Trump's going to be involved too.
Every detail.
bring your best deal on the budget. It's moving quickly in the House and the Senate, thanks to your leadership. We're also going to have debt ceiling in there, so we're going to get an increase in the debt ceiling. So, and that will be the done and dusted for
Part of the bill that we just got to vote on today.
part of the bill. It'll be done and dusted for 2 years. We won't have to worry about that. And then I gave a speech yesterday to 1,400 small and community bankers, and they were so happy to hear from your administration. And I told them Wall Street's done great for the past 4 years, 10 years, 20 years. It can continue doing great, but it's Main Street's turn now, and it's those small bankers through deregulation, through emphasis on Main Street, your Main Street agenda, bringing back jobs, that is going to power the smaller communities. And then finally, the bond auction went very well yesterday. We had a lot of foreigners show up as the support, showing that the U.S. is still the best place to invest. The inflation report, as you said, was quite good. And energy prices are down more than 20% since January 20th.
Amazing.
That's great. Really good numbers.
Great number.
Thank you. Pam?
President, we've had some great wins in the last few days. That you were
we just heard from
overwhelmingly
the Secretary
elected
Scott Bessent
by
alongside
the
other
biggest
cabinet
majority.
officials at a
The
cabinet
US,
meeting live
Americans
in the
want
White
you
House.
to be
Thanks for
president.
joining us on
President
Bloomberg TV and radio. This is Balance of Power. I'm Kaylee Lyons alongside David Gura in Washington. As we were just hearing multiple cabinet officials talk specifically about tariffs, the Treasury Secretary Scott Bessent saying that there is a process being put into place for negotiations in which he will be involved, but President Trump himself will be involved. And President Trump began this cabinet meeting with the press assembled in the room by saying that they are working with a lot of countries, though he did note there will be transition cost and transition problems as we go through this. We also heard from another important voice when it comes to this administration on trade, the Commerce Secretary Howard Lutnick, saying that countries want to talk and they want to talk now, suggesting they're coming with offers they never would have come with without President Trump's policies. So perhaps no surprise, David, that they're obviously very focused on trade given the developments of the last 24 hours, the pause in the 90-day pause in reciprocal tariffs for most countries, hence leaving room for these negotiations, though the tariffs on China remain in place and actually elevated to at least 145%.
And the Commerce Secretary allowing there's hardly enough time in the day to talk to all of these countries who are calling the White House now, trying to talk through what a deal might look like for each of them. Again, a fairly short time horizon here for all of these deals to be worked out, and we see the president sort of making his way around that cabinet table in the cabinet room. If, in fact, he fields questions from reporters at the conclusion of that, rest assured we'll go back to capture some of that for you here on Bloomberg Television and Bloomberg Radio. I want to turn now to Michael McKee, our international economics and policy correspondent, who has been, listening in as the president and his team have been speaking, but also paying very close attention to the 30-year bond auction that we saw just a moment ago, and also the undulations that we have seen and continue to see in the markets, both in the bond market and the stock market, and the economic data that we got as well, the CPI data this morning. Mike, I just want to get your reaction to what you heard there, and maybe give us your sense of sort of what these next 90 days look like. Here we have an administration eager to broker deals, as we heard there in that meeting. That's meeting with the realism of how difficult it is to broker trade deals historically, all the nuances and details that go into them.
Well, it took a year, more than a year, to renegotiate NAFTA, and almost nothing was changed in that treaty that came out as the USMCA. So I think you have to approach what this administration is saying about these deals with a great deal of skepticism. For example, we heard there, and we've heard from others in the administration, that 70 countries have approached the administration. But Kevin Hassett said this morning on one of the other networks that there are 20 countries. So, I mean, what is the actual truth, and what are we actually going to get out of it, and how much of this is going to be tariff reduction, and how much of this would have anything to do with non-tariff barriers? I mean, remember, they went after the Europeans and the British for having a VAT tax. Does that get addressed? Yeah. So a lot of reasons to be skeptical about what they're talking about. But what we can say will happen is if these other tariffs that are already in place stay in place, we will see prices go up, and we will see the economy slow down. It's going to be very interesting. These are very heavily weighted, obviously, towards China, and we import a lot of stuff from China. So how is that going to affect the American consumer's psyche if they can't get things from China?
Well, and investor psyche as well. After the remarkable gains of yesterday, the best day since 2008, obviously we have a massive reversal on our hands with 5% losses on both the S&P 500 and even greater for the NASDAQ 100. And we know markets did play a role in the decision-making of President Trump yesterday, though he was specifically concerned about the bond market, talking about queasiness, Mike. And I wonder if a little bit of that queasiness has been abated, not just by the tariff moves, by once again, for a long-duration Treasury auction, the 30-year yield, it looks like demand was a bit better than expected.
Yeah, the 30-year comes in reasonably strong. It stops through 2.7 basis points, about what we saw with the 10-year yesterday. It does suggest that people are out there looking for duration. Dealers took less. Directs, though, took a lot more than they did yesterday. Direct bidders and indirects were down a little bit from their average, but still relatively strong. So not a major change in the auction statistics, but a well-received auction in this case, as was the 10. So that may supply a little more confidence to people in the fixed income markets about foreign demand and overall demand for U.S. Treasuries. There's been some talk that people were backing away from investing in the U.S. I think the equity markets are reflecting what normally happens in these kinds of situations where you have a big turn down. This is what we've seen before, where you get these rallies and then stocks go back down again. Very much the pattern after 2008, after Lehman Brothers. So you just have to wait and see how long that takes to play out and where people start to find value again. And it may be hard to do in the sense that people can't trust exactly when all this tariff news is going to stop and we'll have what there is.
Mike McKee, at the start of that meeting, the president remarked on the inflation data that we got today, the CPI data, and he said, quote, "There is no inflation." He then corrected himself. That there's very little inflation, he said. We know that those data are looking backward, not forward, and there's a lot on your agenda today. You couldn't escape for the speech that Austin Goolsbee, the Chicago Fed, gave at the Economic Club of New York, but he brought this up and talked about the inflationary aspect of these tariffs and indeed the difficulty that it's going to pose for Fed policymakers going forward here, having to navigate, yes, these kind of inherently inflationary policies, but also what we saw over the last 24, 36 hours, that being a chief policymaker who's making a quick reversal on his policy priorities, seemingly. Talk a bit about that, the way that central bank policymakers, yes, the ones that you cover most closely here in Washington, have to focus on, but those around the world who are trying to figure out the direction of policy going forward here and how they sort of complement that.
Yeah, it is an issue for central bankers around the world, but a little different in different places. It is possible that because the Europeans, for example, will be putting on, if they actually follow through, lower tariffs than we're putting on, and it depends on what they tariff, they may not have an inflation problem. They may have more of a disinflation problem. And so the way they're going to approach this is different. Because the U.S. is driving all of this, we can have a growth slowdown and we can have inflation rise. And pretty much all of the Fed officials who have spoken this week have addressed that conundrum for them. What do they do in that situation? If you raise rates to bring down inflation, you might hurt growth and vice versa. So they're all saying we've got to be careful. We can't make decisions right now. We have to watch what happens. They've sort of all leaned into the idea that inflation is the thing that would matter more. But the formulation that they've always used is we'll look at which number is deviating the most from where it should be and attack that. So the bottom line message from them all is it's going to be tough on us. Don't get mad. We'll get around to it when we have some idea of exactly what we're doing.
All right, Michael McKee, Bloomberg International Economics and Policy Correspondent. Thank you so much for joining us as we're keeping an eye on financial markets. We may be off of session lows, but the NASDAQ 100 right now down 6.2%, still on pace for its worst day since March 2020. So let's get a check on the latest with Charlie Pellet in New York. Charlie, I'm having COVID flashbacks for sure.
Certainly a day of fast-moving developments. We got you covered on Bloomberg Television and radio. Let's recap and reset here in terms of U.S. markets as our market coverage continues. Investor psyche does remain fragile. We are on track for the 5th decline in the last 6 sessions. Right now, the S&P is down 5.4%. Keeping that in context, you run the HCPI function on the Bloomberg. We were down 6.3% at the worst level of the session, but right now, a drop of 5.4% on the S&P. We're down 291 points. The S&P at 5164. The Dow down 1,866 points. That is a drop of 4.6%, with the NASDAQ Composite Index down 1,050 now, a decline of 6.1%. The Russell 2000 Index of small cap shares down 6%. NASDAQ 100 Index also down by 6%. Bottom line here, another day of steep losses for the U.S. equity market. 10-year 4.35%, the 2-year 3.81%. Gold is up $76 the ounce, up 2.5%. 31.59 the ounce on spot gold, and West Texas Intermediate crude is now plunging by 5%. WTI 59.24 a barrel. So bottom line here, steep losses again, fear engulfing Wall Street, with the S&P now down by 5.4%. Our market coverage continues on Balance of Power. Back we go to Washington once again. Your hosts, David Gura and Kaylee Lyons.
Charlie, thank you very much. Charlie Pellet there in New York, following the markets for us as we look at the sell-off this afternoon. Gold, that glimmer of green in a sea of red. As we look at this kind of violent reversal, and I'm kind of curious here, Kaylee, as we watch all this unfold, sort of what fundamentally has changed? Yes, I think we can all agree it's a good thing that a trade war isn't being fought on 70-plus fronts, but it seems like the biggest battle, the most fundamental one here, is between the U.S. and China. Yep. And we were talking a little while ago just about the notion of decoupling and sort of where we are in that conversation, but a very deep divide now between these two economies, and I think investors are reckoning with the fact that that's the case.
Well, and it's not just any two economies. It is the 2 largest economies in the world. So while it does have major ramifications for both the domestic economy and the Chinese economy, there could be ripple effects across the globe as well, as we consider that when you add on the 20% fentanyl tariffs to the now 125% reciprocal tariff President Trump has placed on Chinese goods, that gets us to at least 145. And of course, China has slapped 84% tariffs back in the other direction on U.S. imports. And that leaves specifically tech companies incredibly vulnerable. If you're an Apple or an NVIDIA with that China exposure, perhaps the euphoria of yesterday is giving way to a bit of a reality check on that front today. And it's on that note we go to Mike Regan, Bloomberg senior editor, joining us from New York. And it is remarkable, Mike, after the best day since 1998 for Apple yesterday, that stock down 6.5%, NVIDIA taking it on a chin as well. It does seem that technology stocks are looking particularly vulnerable in this Thursday selling.
Yeah, Kelly, and I would sort of reiterate what Mike McKee just said about whenever the market has one of those just insane rallies like we saw yesterday, that doesn't necessarily inspire the type of confidence you would think it would. Wall Street traders are all too familiar that those type of eye-popping rallies really only happen in the middle of bear markets. We saw it in COVID, during the financial crisis, and many other bear markets. So I think when you think about the difference in mood from yesterday and today, yesterday, the rollback or the delay of the tariffs for 90 days was certainly good news. It wasn't likely worth almost 10% in the S&P 500. What seems to have happened, according to a lot of investors and strategists, and just looking at the data itself, is that there was a massive short covering. When you think about some of the most sophisticated, biggest hedge funds and other investors in the world, many of their strategies actually can be boiled down into something very simple and trend following. We've had this downtrend in the market since the middle of February, and that just inspires a lot of traders to short this market, to borrow securities in hopes that their prices will go down further and they can buy them lower and sort of pocket that difference when they repay that loan. So a big part of that rally yesterday, I think, was short covering. That happened in a flash, and now it's over. And we're back to really thinking about these fundamentals and the uncertainty around the fundamentals and the market resuming that downtrend.
I was reminded of something I read from RenMax Neil Dutta yesterday in light of what you said there, Mike. He wrote in his latest note, when markets rise 10% in a day, it's not a sign that things are healthy. I think getting at the point that you were making there. What is your sense from going through notes this morning and sort of getting a sense of where the market is today, of what investors are looking for here, what that kind of clarity is that they need to see here? There was that allowance from the president yesterday that he intends to be more flexible than we thought he was going to be going into this, perhaps an indication that he's willing to carve out some exceptions, something that he and his economic advisors had sort of ruled out flatly at the beginning of this process. What more do investors need to see here to kind of cheer them, or is this something that you think we're likely to see going forward over these next 90 days, this kind of anxiety about the uncertainty, sort of how these deals come together?
When it comes to that sort of looking for clarity, David, one of the really, I think, most illustrative things I read this morning was from our colleagues writing about Walmart. Walmart basically told one of its suppliers in China that produces Christmas ornaments, don't put the price tags on the ornaments. That was typically the last thing they did before shipping them out. You know, Walmart would tell them, put this price on each item, and they'd ship them out with the price tags on them. Now they're saying, don't put those price tags on these Christmas ornaments. And that really, I think, speaks, it's a great anecdote that speaks to the unknowns throughout not only the C-suites of companies like Walmart, but in the spreadsheets of investors trying to figure out exactly what to expect for the rest of the year. You know, we've seen Delta pull its earnings guidance. We've seen CarMax pull its earnings guidance. A pulled earnings guidance is almost as alarming to investors as a reduced earnings guidance. In some ways, I think they would prefer to see that. At least there's some numbers to work with. When a company completely pulls its guidance and says, we just don't know what we're going to make this year, it's very alarming for investors. And that's really the clarity, I think, from the Wall Street, from the trading side of things, is clarity on what that earnings outlook is going to look like. And there's just none to be had right now because of all the issues, all the uncertainties, and lack of clarity from Washington. You know, Trump is famously can change his mind from day to day and increase tariffs, pause them, eliminate them, and you know, it's just impossible to predict. So that just sort of feeds into all the decision makers in the C-suites around the country and the world, really, and all the investors trying to put a value on what these stocks are worth. And it's just a very hazardous situation when you don't have answers to all these questions.
Well, and Mike, that's an excellent reminder that big bank earnings kick off tomorrow. JP Morgan will be reporting at 7 a.m. Eastern time on Friday. For banks that came into this year thinking there was going to be a revival in animal spirits, investment banking fees potentially were going to fly. Obviously, we're living in a bit of a different reality. You were just speaking to the idea that earnings guidance is getting pulled, but we've seen IPOs pulled as well due to the volatility in markets right now. And I wonder what you're expecting the banks might be signaling tomorrow and how much of a catalyst that could be for wider equity markets.
Right. Well, they're in the books earnings through the end of March won't tell us a whole lot just because a lot of this turbulence has happened since then. For this current quarter, I mean, some of the big banks, you know, that have trading desks might be able to put up some great numbers for those trading desks. But those don't tend to really impress Wall Street investors because they do come at the expense of everything else you're talking about, IPOs being pulled, likely some M&A that is being reconsidered. And it just, you know, it's going to be a volatile outlook for the banks. I think the remarks, especially from the likes of Jamie Dimon, will be the most important thing. Again, the banks aren't going to be able to give us any more clarity than anyone else can. But as we've seen, you know, even yesterday, the words of someone like Jamie Dimon mean an incredible amount to investors. So I really think his conference call remarks will be must-see TV, or at least must-listen to earnings call for all of Wall Street coming up.
Mike Regan, thank you very much. Mike Regan, senior editor on markets in New York. And I think back on what he just said there, we've heard an awful lot from President Trump this week. Maybe second to him, we've heard a lot from Jamie Dimon. There was the lengthy letter that he wrote to investors earlier this week, followed by that interview, which was, in a way, kind of unprecedented here during a quiet period before earnings, going on Fox Business and having a long conversation about the economy with Maria Bartiromo. And then, as Mike was alluding to there just a moment ago, the comments we expect him to make on the earnings call that JP Morgan has in the coming days. I want to go to Terry Haynes now, the founder of Pangea Policy, and I suspect that he was shaking his head as I was asking Mike Regan for sort of a sense of the rational response that we might see in markets to what the president is doing here. Terry, we talk a lot about sequencing in the context of the president's legislative and economic agenda. Let me ask you about sequencing in another context. That is, how this White House, how this administration goes through what they say is a long call log, a long list of countries and trading partners eager to meet with this administration to hammer out deals. They want to send a sign to the markets, to Americans, that in fact they're making progress. Who needs to be at the top of that list? Who should they be prioritizing as they go through the sequencing of these trade deals?
Thanks for having me. I think they should sequence in a couple of different ways. One, they should probably look at the United Kingdom, Europe, but not of it, so to speak. I'd also look at major unaligneds, particularly India. India is hugely important, and working out some deal with Modi would be a great signal. Let's remember just 2 months ago in Washington, Modi came here and talked about MAGA plus MEGA, make India great again, equals mega. So maybe Trump should figure that out. And finally, somebody in the Asia Pacific, either Japan or Australia, would be very good. I think those three would send large signals about the seriousness and kind of the direction of travel of the administration.
Well, as we talk about the seriousness of the administration, Terry, and it's great to have you back here on Bloomberg TV and radio, I wonder if you see any kind of credibility dent that the administration is now going to have to contend with as it conducts itself in these negotiations, considering, once again, we have seen an extreme change in tariff policy and a flipping and flopping of the narrative. Does that actually give these other countries who are coming to the table a little bit more leverage? Is there a bluff to be called at some point?
Oh, sure. There's credibility gaps all over the place. There's a credibility gap on the part of the administration to some extent. There's an awful lot of allies and friends of the United States that feel whipsawed and feel bruised in a lot of different ways, and this pause does a lot of things, but one of the things it does is gives Trump an opportunity to right-size those relationships and frankly reassure people. One other thing that we should all be aware of too was that Lutnick's people at Commerce were out to a number of major countries, and I assume others as well. I know of a few that giving people a laundry list of what they wanted to talk about, both in terms of tariffs and other sorts of trade barriers, before the tariffs even went into effect. So, I will give the Trump people good marks for being able to talk to allies and friends and others before all this started. So hopefully that can help push things. Thirdly, I would point out as well, I thought Mike McKee gave a very good summary of all of this a few minutes ago on your air. One thing I would add to that, though, is that countries may well be able to come to deals by making future promises. The United States itself does this by saying, we're going to reach a deal to do X, Y, Z on trade, and as part of that, we promise within a certain period of time, we're going to pass legislation, we're going to change rules, whatever. Those countries will do similar things, I think, in order to make deals.
It must be grading season. We have here Terry Haynes giving his marks to the White House. Ira Jersey, our chief rate strategist for the U.S., giving his marks to the auctions that we've seen over the last couple of days, giving the 10-year auction an A+ and a 30-year auction an A, saying that they were really solid. Makes me ask you, Terry, sort of how you look at this administration's visibility into the markets and their response. You wrote earlier in a note that perhaps the White House, we've misjudged how much this president cares about market moves. And I think yesterday we saw perhaps an indication that it's still something that the president cares quite passionately about, that he could see those startling moves in the bond market, for instance, and feel like he has to do something, that things aren't going to course. Do you care to revise the statement that you made earlier? Have things changed this week vis-a-vis our sense of the way that the president looks at the markets?
No, I won't revise. I will extend my remarks, though.
Fair enough. You may. You
on
may.
Capitol Hill. I will extend my remarks in this way. When markets say, "Geez, Trump cares about the markets," I mean, to me, that's a illusion and a rationalization extraordinaire, because they don't really mean Trump pays attention to the markets. What they mean is, we, the markets, are actually the masters of the universe, and Trump will do as we wish. Well, I've been telling markets for a couple of months on tariffs that's not going to be the case. The reason why it's not going to be the case is because the goals here are geopolitical. This is not 2017. The reason why it's not is because economic policy is roped and yoked to geopolitical goals across the board. And, you can even see that with tariffs, where some of the tariffs exist for geopolitical reasons. So, presidents don't think about the markets all the time. The markets are not the only thing that needs to be dealt with. And, so what I would say to folks is that, you've shown, or as Trump has shown, that he's certainly interested in where the markets are on these things, but he's not paying sole attention, and he's not gonna dance to markets' tunes, number one. Number two, I think the other thing we need to remember here too is anybody on Wall Street that's self-congratulating today shouldn't. Because one of the reasons why these tariffs happened is essentially that Wall Street let them happen. In Washington, silence equals assent. If you're silent, that means go ahead. And they didn't really raise any objections to what was about to happen until well after it happened.
Well, it's a very fair point. Certainly, we're seeing, it seems, some protest happening now, looking at the red on my screen, Terry. Also on my screen, I would point out we are still paying attention to the cabinet meeting at the White House, which is ongoing. The president has gotten reports from almost every cabinet secretary at this point. The Secretary of the Interior, Doug Burgum, is speaking now. As you can see, if you're with us on Bloomberg TV or on YouTube, we still have Secretary of State Marco Rubio to hear from, and then the president may well start taking questions from reporters. We'll dip back in for those if indeed that happens. In the meantime, though, Terry, as you speak to this idea that the president isn't exclusively focused on the markets, what have you learned this week about the influence others in his administration may have in interpreting the market action and then shaping presidential policy by extension? As we understand that Scott Bessent and Howard Lutnick presented a kind of united front to the president yesterday, which helped lead to this change in tariff policy. Is this actually a sign that Wall Street's initial expectations of Scott Bessent being kind of a steadying hand, if you will, when he was tapped for this position, may indeed be serving in that role?
Markets still have a policy concern, of course, and in large part because this is a pause. It's not a volte-face or a throwing away of the policy. And Trump still has a lot of urgency around this. So markets are right to continue to be concerned. Where I think the White House has improved here is, though, in communication message, something that's important. And we've been talking for 6 months now about the so-called team of rivals that are headed up by Bessent and Lutnick. And I think what you saw yesterday here is Bessent put pretty much in charge of the messaging to Wall Street, while Lutnick is supposed to be responsible for the shepherding forward of negotiations and potential deals. Bessent has a foot in two camps right now. Bessent is trying very hard to push the tax cuts bill, and they'll try to push a bill and get it done, frankly, I think within this 90-day period. They have a pretty good chance of being successful at that. But at the same time, Bessent's going to continue to be the soothsayer for Wall Street, and that seems like the right conclusion for the Trump people to reach, since Bessent tends to stoke some confidence where I think Secretary Lutnick, for rightly or wrongly, doesn't.
Terry, you've mentioned a number of names there, and one that didn't come up is Jamieson Greer, Ambassador Jamieson Greer, the U.S. Trade Representative. And there was that photograph that we saw from the House hearing yesterday where the Truth Social post went out, and an aide had to lean over toward the U.S. Trade Representative and show him what the president had done. Where does he fit into this pantheon of economic advisors, and what does that tell you? Is it at all worrying that the man who has been charged here with trade policy wasn't in the Oval Office yesterday as Howard Lutnick and Scott Bessent and President Trump sat down and pounded out that poetic, important post on Truth Social?
Well, the USTR is typically given cabinet rank, not always by every president, but typically given cabinet rank. But at the end, not only does he get his power from the president, but he's essentially a staffer of the president. I mean, they all are, but they're not cabinet secretaries or anything else. And the USTR in this case, I think, is treated a little bit more as a staffer than as a peer of Secretaries Bessent or Lutnick. I also think, in Greer's defense, he's pretty new to this. Just got confirmed very recently, and probably not quite as up to speed on it as everybody else. But I think the net of what you point out clearly is that the three people who are in charge of all this are the president as the decision maker, Bessent as the person who has his eyes most clearly on the markets broadly, and Lutnick is the person who's supposed to go out and execute these deals.
Terry, finally, all of this conversation on tariffs and the activity we're seeing in financial markets today, which I would point out the NASDAQ 100 right now off of session lows, still down, though, 5 full percentage points. The S&P down by about 4.5%. Seems to have overshadowed what happened on Capitol Hill earlier this morning, which was a successful vote in the House to pass the budget blueprint that was passed by the Senate, advancing forward the budget reconciliation process in the aim of achieving President Trump's legislative agenda, which is expected to include sweeping tax cuts. We keep hearing from this administration, tariffs are just part one. You have to wait for the second half of the economic policy, and I wonder how that factors in, although I understand now that President Trump is taking questions from reporters from the cabinet room at the White House. So let's listen and watch live on Bloomberg TV and radio.
I think Scott went out. Scott, you want to have a statement on that?
Sure. Look, the up 2, down 1 is not a bad ratio, or up 10, down 5. And I think, as we have talked about, as we go through the queue and settle with these countries who are going to bring us their best offers, we will end up in a place of great certainty over the next 90 days on tariffs. But we had very good inflation numbers today. Oil's down. We had a successful bond market, so I don't see anything unusual today.
And next steps for China, sir?
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond nobody. How people stood for it, sitting in my position, is not even believable. And we're talking about many presidents, not just a couple. But they did, and all we're doing is putting it back in shape. We're resetting the table. And I'm sure that we'll be able to get along very well. I have great respect for President Xi. He's been, in a true sense, he's been a friend of mine for a long period of time. And I think that we'll end up working out something that's very good for both countries. I look forward to it.
Mr. President, China retaliated today by reducing the number of American films that can be shown there. What's your reaction to them now targeting cultural exports from the United States?
I think I've heard of worse things. Yes, please.
Also on China, the Ukrainians say they have evidence that Chinese soldiers have been found fighting for the Russians in Ukraine. Can the U.S. verify this? And if so, what does the U.S. plan on doing to China to combat that?
We'll look into it, but I think beyond that, we're really looking to get that war stopped. They're losing 2,500 and even more than that young people a week. They're Russian and they're Ukrainian. They're not American, but they're people. And we're seeing if we can get it stopped. And I think we're making progress. I appreciate the ballerina who was released. It was at the request of a very good friend of all of ours, actually. Dana White called me and he said it's the friend or the relationship of one of the fighters for UFC or one of the fighters. And Dana's an incredible guy, and we spoke to President Putin about it, and they made a deal. They released the young ballerina, and she is now out, and that was good, so we appreciate that. We hope that we're going to be able to make a deal relatively soon with Russia and Ukraine to stop the fighting. It's so senseless. It's such a horrible thing. It would have never happened if I were president, but it did happen, and we were given that card. and I think we're going to get it. I think we're going to get it stopped. Got to get going. We got to get it. We have to move it faster. Likewise with the hostages, we're making progress. There's 59 hostages, but only 24 of them are living, and that's the way it's been presented to me by the mothers of some of the dead, mothers and fathers of some of the dead hostages, and they want the bodies of their baby, as they say, their baby, their young boys. They want them back as much as if they were alive. It's amazing, because when I met the hostages 2 weeks ago here, I couldn't believe what they had to go through, by the way. But when I met them, they said, yeah, there's 59, but 24 are living. And they actually consider, I guess if you're a parent, you do consider it this way, that the remainder who are dead, the 24 that are alive, the remainder that are dead, they want them back just as much as they would want them back if they were alive. It's really pretty amazing and pretty sad. So we're getting close to getting them back. We have a lot came back. A lot of people are very grateful. Some came back in pretty bad shape. Some came back, they're okay. I think they're going to be scarred mentally for a long time, because if you sit down and talk to them, as I have, what they went through is incredible. But we're making progress. We're dealing with Israel. We're dealing with Hamas, and it's a nasty group.
Mr. President, so how close are you to the first country coming to actually make a deal with the United States over tariffs? Is it days, months?
Well, I think it's very close, but we have to have a deal that we like. We don't want a deal that's going to be a bad deal, or I could make every deal in one day if I wanted to. I could do this in one day. I could just say, here's what we'll do. And I was saying to the people before, to Scott, mostly to Scott and Howard, and some of the other people that work with us on the negotiations. We have a lot of law firms that have paid me a lot of money in the form of legal fees. We're going to probably use those firms to, if we can, I think we can. I'll make a contribution to the country, but they're great firms. They're the best firms, the biggest, and really the most prestigious. And we may be using them to help you guys out, because you're going to need a lot of lawyers. And I'm not sure Pam's going to be happy if I say, can you send over about 200 lawyers that work on trade? She's working on criminal stuff, and I think that's going to be her focus more than anything else. So we'll find out if we can do that. But we have a lot of lawyers that you've been reading about, where they paid $100 million a firm on average. Now we have the final 4 or 5 are at $125 million. So I have a lot of legal fees I could give to you people, and we might as well use them. Hopefully I won't need that many legal fees or that much. I may. Who knows? After it ends, after we leave, maybe I'll need it. But if I do, it's not going to be very pleasant. So I think we're going to try to use these very prestigious firms to help us out with the trade, because we have a lot of countries, but we want to make deals that are proper for the United States. Not just we can make deals easily. We want to make them proper.
Mr. President, if you aren't able to reach the deals that you want to see at the end of the 90 days, will you put those higher tariffs in place, or will you extend?
Well, that's what would happen. I mean, if we can't make the deal that we want to make, or we have to make, or that's good for both parties, it's got to be good for both parties. And then we go back to where we were.
Go back to the numbers that you announced last week.
I think so.
You wouldn't extend the pause?
Yeah. We'll have to see what happens at that time.
Thank you, Mr. President. You said yesterday you were considering some exceptions for companies. Can you talk about what you're considering? And then also on the reciprocal tariffs that would be substantially lower, is the same math formula going to be used, or is that tossed out?
I'm not considering now for any country or company, but it's possible that I would. But I'm not. We don't have that situation right now. People understand where we are, what we're going to do. But it could happen. It's called flexibility. You have to have certain flexibility.
What are you planning on using the money that you're gaining from revenue through the tariffs on?
Paying down national debt, reducing taxes, creating good budgets, helping Christie with the border and all of the other things. I built hundreds of miles of wall, as people now understand, 571 miles of border wall in the first administration. But we're going to beef it up, and we're going to add more. And, you know, the numbers are incredible, really. The numbers are what's taken place. We had great numbers, but these numbers are topping my last administration. And Christie and Tom Homan have done an amazing job, but you know, it's an expensive process. This weekend, where they used to have hundreds of thousands of people standing there pouring through the border in Tijuana, Mexico, this weekend they had nobody. You had a man sweeping this massive piece of concrete, which is, you know, the area where they said massive. And I've looked at that during the Biden administration. You couldn't see a piece of that concrete. There were so many people on it. You couldn't, if you had helicopter shots, you couldn't see concrete. Now, this weekend, you had nobody there but a man with a broom sweeping it and cleaning it up. Pretty amazing. Now, it's really an amazing job. But it will be used for that. It'll be used for a lot of things. It'll be used by the Department of Justice for doing a great job. Pam is doing a fantastic job. So it's going to be used for a lot of different things.
Mr. President, on the 10% tariff, is that a basement? Is that the?
It's a baseline.
Can countries negotiate that to bring that
It depends
down?
on what they're adding. You know, some countries we have massive deficits with, or they have big surpluses with us, and others it's not that way. So it depends. That's why it's really they're all different. Every country is different. Some have certain advantages that others don't have, and certain things. We have some. China has a surplus of $1 trillion. I mean, the numbers are crazy, and others have basically no surpluses. You know, we have some that are pretty even, but they hurt us in other ways, and we just want to get that taken care of. So everyone is a little bit different.
So, are you negotiating with the EU as one bloc or individual nations for the tariffs?
We're looking at it as one bloc. They've been very tough, but they were very smart. They were ready to announce retaliation, and then they heard about what we did with respect to China and others, but China, and they said, you know, we're going to hold back a little bit. They decided to hold back. I thought they were very smart. Look, the EU is very smart, but they really have taken advantage of the United States. They were formed for the purpose of taking advantage of the United States, and I don't blame them, and I don't blame China. I don't blame anybody. I blame the people that were sitting at that desk in that other beautiful Oval Office for allowing it to happen. Many presidents I blame. They should have never allowed it to happen. And I'm doing something that a lot of them wouldn't want to do. But I'm here. I do those things, and we're going to make this country great again. We were taken advantage of by almost everybody. I sat back in the last administration. I would actually read them. I don't have to read them now. I know them so well. I would read some of these documents that were signed, deals, and I said, who would do a deal like this? Who would do it? You've seen it, Elon. Yeah. I'd look at deals where it's so one-sided. Even we have a deal with Japan, and we get along great with Japan, and we had the Prime Minister here. He was fantastic. As you know, Abe was great. Shinzo was great. He was a good friend of mine, unfortunately no longer with us. But we defend them, but they don't have to defend us. I said, that doesn't sound too good. But we have a deal, a defense deal. We pay hundreds of billions of dollars to defend them. But if for any reason, in other words, we pay all the money. They don't pay anything. But if we're ever attacked, they don't have to do a thing to protect us. I said, well, that sounds like a wonderful deal. So that's just one out of thousands. And I just wonder who did this. And it's people that either hate our country or didn't care, an expression that you use. I think it's really a lot of them didn't care. It's just hard to believe how bad they are. Now, that's a little bit of a defensive deal, but I'm talking about trade deals, the same thing. They're so bad, you would say, how come? And even when I'd renegotiate, like, I'd go to a country, they'd give me everything I asked for. I said, why didn't somebody ask for it, like, originally? They give me everything. I think when they were negotiating, they didn't care, or they didn't ask, or they were shy, or they were very stupid, or they hate our country. Yeah, go ahead, Jeff.
You were speaking about Japan. Can you clarify what your vision is for U.S. steel? You referenced it yesterday.
Yeah.
There's some questions about what you actually want to see
Sure.
happen
Look,
with that.
U.S. Steel is going to do very well now because of tariffs, and I don't know why they even need a deal. But the only thing is, U.S. Steel, if you go back 80 or 90 years, that was a behemoth in this. That was our biggest, most. If we were around, we would have been very proud of it. Today, we have different types of companies that are big. Google, it's not the same as U.S. Steel, and I love Google, and I got to like the people that run it. Very capable people. They didn't like me so much in the first administration, but they like me a lot now. I don't know what happened, but I like them. But, you know, I think they would be the first to admit, when I envisioned, you look at some of those steel factories from 90 years ago, it was a different kind of a country, but they were miles long. Today you see just empty hulks. Those hulks are going to be filled up very soon because of what I'm doing with tariffs. It was a different kind of a thing. But if I didn't do that in the first term, my first term, if I didn't put tariffs on, we would have, because China and others were dumping steel, billions of dollars of steel. Our steel companies were all closing. We wouldn't have one steel plant open, and now we have a steel industry that's doing very well, but soon it's going to be thriving, really thriving, and those factories are going to be filled up, but more importantly, they're going to build brand new ones. Nucor and so many other companies call me, Nucor being a big steel company. They're building massive new steel plants, and it's great. And likewise, car companies. We have many, many car companies. 3 of them, I'm not looking to hurt Mexico, and I like Mexico. And by the way, I think the new president is a terrific person, a fantastic woman. We've had many conversations. She's a very elegant, just a fantastic person. And she's been very nice, very, very nice. But I'm not looking to hurt them. But we have 3 car plants that were under construction in Mexico. They stopped constructing, and now they're going to build in the United States because of tariffs. See, we should have never let this happen, because whoever it was that was president at the time, we lost 90,000 plants and factories since NAFTA. 90,000. It's not believable. How about that, Laura? You know, you're in that sort of world of factories and
Build back
plants.
manufacturing, construction jobs, bring those workers back home.
That's right. We're going to bring them all back. But think of it, from that period of time, which isn't so long ago, we lost. I said the other day, if you had a map on a big wall like this, and if you had pins, 90,000, I don't know if you'd have enough. I don't think you'd have enough room on the map to put the pins. 90,000 factories that we've lost since NAFTA. And it's not even, and about 6 million jobs, really, I think probably a lot more than that, but they say 6 million jobs. We're going to bring many of that back. I think we're going to bring more than all of it back. We're going to be better and stronger than ever before. But if a president, when they were leaving, said, look, you can leave, but if you're going to build a factory someplace else, and you think you're going to come and sell your steel or your car or any product that you make, your pharmaceuticals, which we're going to do, we're going to get them all back. But if you think you're going to just, all they had to do is say this, and they wouldn't have left. You know, I said it the other day. I said it with respect to, I made a speech a year ago, and I told them, if I win, we're going to charge a big, big tariff at the border. And people were thinking about building in Mexico a car plant. And I said, we're going to have a big tariff. So if you want to build a car, you're going to have to pay 25% more than the cost of that car. You're going to have to pay 25% tariff at the border. They would have never left. They could have kept everybody. If a president said, if you leave this country, you leave Michigan, you leave Detroit, you leave anybody, any of our states, because to me they're all the same. I love them all. I love them all, and I probably won them all, but they say I won most of them, but I think I won them all, but that's okay. But all you had to say if you were the president is, if you leave and you think you're going to now fire all those workers, leave all that, everything behind, and you're going to build in another country and sell it any, and no, you're not going to. You're going to pay 50% or 100% tariff. They would have never left. And all you had to say, Marco, all you had to say very simply is, You don't have to write it down. All you have to do is say it verbally. If you leave, you're going to pay 100% tariff. Therefore, don't leave. They would have never left. But they left 90,000 plants. I mean, it's hard to believe that many. It's not, you can't envision it. So just getting back to your, because I'm the great weaver of all time. To weave, you have to be a genius. To go on tangents, anybody can do that. But we'll get back to your original U.S. Steel. U.S. Steel is a big name in this country. Babe Ruth is a big name. We have a lot of big names, but not too many. U.S. Steel is one of the great names in the history of our country. And normally I wouldn't mind so much. I wouldn't be thrilled with it. But to buy for a foreign country, and we love Japan, but for a foreign country to buy that cherished U.S. Steel brand, that's hard for me to do. And maybe somebody else may want it. The company Nippon that's involved with it is a big, powerful company who do a good job. But why can't they just build a plant themselves? I mean, why do they have to, take U.S. Steel? So as you know, I rejected the deal. Now they've come back in a different form. They're coming back as an investor. And I feel better about that, I guess. But, I know them very well. I know the thinking. It's the investor. They'll invest, and somebody else maybe is sitting in this chair, and they will no longer have an investment. They'll have the whole thing. That's the way it works. They're very smart. They're very, very smart people. We're dealing with very smart people throughout the world. Great geniuses, actually. Look what they've done to our country. And again, I don't blame China. I don't blame anybody. If I could have done it, if I were in that position, I'd have great respect. I have great respect for the people. They ripped off the United States, and all we had to do, have a president that knew what the hell was going on, and none of those countries would have left. Those companies, none of them would have left. So that's a little lesson in basic business. And it's really basic business. It's not complicated business. It's very basic business. And we'd have every one of those car plants going just the way they were 30 years ago. None of them would have left, but now they're coming back.
Mr. President, the Labor Department has confirmed that $400 million went to fake people for unemployment benefits.
Yeah.
That's sort of your initial reaction.
I think it's terrible. I just heard it from Lori, and I appreciate it, and you heard it from Elon's people, right?
That's right.
Elon's done a fantastic job. Look, he's sitting here, and I don't care. I don't need Elon for anything other than I happen to like him. But I'm telling you, this guy did a fantastic job. I don't need his car. I actually bought one and they said, "Oh, did you get a bargain?" No. I said, "Give me the top price." I paid a lot of money for that car. But honestly, he makes a great car. You know what I do with it? I let the people in the office drive around in it. Margot and Natalie, they're all, Chamberlain, they're all driving around the most beautiful car. It's gorgeous. But I did that as a sign of, just a show of support. Numerous people have done that. Just a show of support. Because, he's done a fantastic job, but he hasn't been treated properly. Yeah.
Mr. President, can you talk to us about your communications with China? Has President Xi reached out at all since the tariff?
Well, I don't want to say who's reached out. I just say that I think it's going to work out, hopefully well. They're very big. It's hard to get over, if you're me, what they've done to our country. They've destroyed our economic base to a large extent. The good news is we're very vibrant, and we're going to get it back fast. We already have. Look, we're making $2 billion a day now, and during Biden, we were losing $3 billion a day. Biden was a disaster. He was the worst president in the history of our country. And, to me, worse than that, because the money you can make if you have the right guy in this position, worse than that was what they did on the border. By allowing the jails of the world, not South America, all over the world, to be opened up so that we take everybody from Africa, Asia, South America, Europe, the bad ones. They opened up their jails and they dumped them in the United States. And now this beautiful young woman who seems to be, boy, she loves what she does. So I think she loves what she does because she's a patriot. She hates to see it. and Tom and all the people. But for us to spend, you know, hundreds of billions of dollars this is just, I don't know. They either hated the country. Who would do this? Who would want millions of people to pour through an open border? We have no idea who the hell they are, and just walk right through. And half of them, whether you like it or not, you could look at them and you could say, they are not going to help us. These are some rough people. But they'd empty out their jails, and they'd empty out their mental institutions, insane asylums, and they let them into the United States of America. And inflation we can fix, and all of the other things we can fix. We'll get it going. But this is something, it's such a horrible thing. And it's really hard. You know, we have to do deportations. Now we're doing self-deportation. We're coming up with all sorts of ideas. And they must have known it's not going to work out well. And, you know, we want people to come into our country, by the way. We need them badly for the jobs. But we want them to come in legally. They have to come in legally. They have to show that they can love our country. Thank you very much, everybody. Thank you. Thank you very much.
President, Democrats are making allegations about market manipulation yesterday.
Thank you.
All right, everybody, you have been listening to President Trump there at the White House holding a meeting, talking about a variety of things. Very good afternoon. Live on radio, TV, YouTube, Bloomberg Originals. This is Bloomberg Business Week for this Thursday, April 10th. Another day where, again, we're focused on tariffs. We're seeing market volatility, Tim.
Yeah, the stock surge, that was so yesterday. The S&P 500 down 3.4%. The NASDAQ Composite down 4%. The Dow down more than 1,000 points, 2.6% to the downside. We're going to have more from Charlie Pellet in just a minute.
Yeah, and we should point out we are bouncing off our lows of the session, but nonetheless a reversal, not giving back necessarily everything that we gained yesterday, but nonetheless, again, a negative tone, risk off. We've got a great hour coming up. We're going to talk with Goldman Sachs Asset Management's Global Head of Insurance Asset Management. He has seen a lot of market cycles. He's got to figure out how to put money to work, investments to work in this environment. Curious to see what he has to say. But let's get to the trade, your top business stories on this Thursday. Here's Charlie Pellet.
Hi, thank you very much. Again, another day of selling on Wall Street. It is the fifth decline in the last 6 sessions. As Carol mentioned, we are well off session lows. You run the HCPI function on the Bloomberg. I can tell you the S&P 500 index was down by 6.3% at the worst level of the session. Here's where we stand now. We've got the S&P down 3.3%, down 179. The S&P now at 5278. The Dow, though, down 1,025 points on the Dow, a decline of 2.5%. The NASDAQ Composite Index right now down 687 points. That is a drop of 4%. The 10-year, 4.36%, with the 2-year that's currently yielding 3.84%. Spot gold higher by $80 the ounce, up 2.6%. The precious metal now at $31.62. Bitcoin is trading lower by 4.4%, 79,477 on Bitcoin. Cannot ignore West Texas Intermediate crude was trading below $60 a barrel. Back above that level right now, 60.21 on WTI. It is down by just about 3.5%. So bottom line here, we do have stocks plunging again today as economic angst continues to hit Wall Street. The S&P 500 index down now by just about 3.1%. Briefly, Prada is buying Versace for about $1.38 billion in cash, strengthening its position as Italy's largest fashion group by adding one of the luxury industry's best-known brands. Prada ADRs, they're up by 7.7%. Again, recapping, S&P lower now by 3.1% for on-demand news 24 hours a day. Subscribe to Bloomberg News Now wherever you get your podcasts. Keep it locked into Bloomberg and television and radio for the latest. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are up to date on the markets. We're going to focus on the markets until we see the close today. But we do want to mention, of course, we're just off a cabinet meeting, President Trump holding one at the White House. Let's get some thoughts in terms of the policy, the implications. Ed Mills is Washington policy analyst, managing director over at Raymond James. Ed, safe to say many would assess that this is a very different political environment, geopolitical environment, and investors have to make sense of it. What do you make sense of what you just heard from the president and really the last 24 hours?
Yeah, Carol. So what I've been telling folks here at Raymond James is that there are 3 paths forward here on the tariff discussion. Number 1, Trump cuts deals or changes his mind. 2, the courts or Congress stop him. Or 3, he doubles down, and we're going to see a change of the global world order that's been established since World War II. I think in the immediate aftermath of the tariff announcements, the markets was over-indexing number 3. Yesterday's announcement was a move back to, oh, Trump is going to cut the deals. And I think that was a positive reaction. But as we're digesting this, here at Raymond James, we calculate that actually a 10% across the board, but 145% on China, the dollar-weighted kind of trade impact there is about 40% higher than the original announcement. So we get relief, but the China issue here is a huge issue. And from a dollar-weighted average, a significant increase of tariffs across the board.
Ed, in your view, does the China issue get resolved?
I think it's a question of what does resolution mean. We have seen a greater openness from China in the last 24 hours than we've seen since January 20th. When I've talked to my China contacts, Tim, is that there's a sense that China doesn't want to get involved in another drawn-out negotiation. You go back to the first term. It took 3 years before we got the quote-unquote first kind of phase of that trade deal done. Xi does not know what Donald Trump wants. China does not want to negotiate and have the goalpost moved on them. They can't really sustain this forever, so something has to happen. But what Donald Trump wants, what the administration wants, is not clear enough just yet.
Ed, real quickly, 30 seconds. Can you invest in this market?
I think you can. I think that the bull case from here is that we get the deals. Congress, the House passed the budget resolution today. We're moving towards tax cuts. We saw executive action on deregulation. If we can build upon that, that's an investable market. We tell folks at Raymond James, stay the course, stick to your plan.
All right. Uncertainty, though, still the watchword. It certainly feels that way. All right, Ed, going to leave it there.
Absolutely.
Thanks for weighing in. Ed Mills, Washington policy analyst. He's also managing director over at Raymond James.
Well, back to the selling on Wall Street, because at one point today, the S&P 500 was off the most going back to March of 2020. It's bounced off that low, but still down 3.2% right now. Whenever we whip out these superlatives, we know things are getting a little, well, I don't want to say
I don't know, they're becoming the norm, kind of.
I was going to say, it's going to be like, it's kind of relatively rare, but the last week, Carol, we've been doing this quite a bit. We've also been checking in with Eric Weiner quite a bit. He's a Bloomberg News senior editor of Equities America. He joins us here in the studio. What happened between yesterday and today? Why the change in tone?
Well, yesterday was kind of a euphoric reaction, and you had this momentum of everybody waiting for that, that delay and it coming in. And then as that happened, we went up about 4%, and then the short squeeze started coming in, and liquidity was
and yesterday
really
was a lot about short covering, wasn't it?
Yes, that was it. So you had liquidity tight.
Right.
So it just basically pushed everything way, way, way beyond where you would think it would go based on the news. And then there wasn't a whole heck of a lot of analysis on exactly what the tariffs meant, to speak to Ed's point, where China actually means a lot more. So escalating on China versus de-escalating on the others was, something that had to be figured out overnight. Once the session ended, on our team, we started talking about preparing for today, and we were talking about 2% to 3% down. It went further than we thought, but there's a lot of correlation in the market right now. So things are moving in groups and in clumps, much more so than they normally do. And when you see that, you get these massive moves one way, massive moves the other way.
So dollar down, stocks down, bonds down?
And yes, and also broad sectors of the stock market down all at once. So it's not just selling, say, tech, it's selling all of tech, everything in tech, and the whole sector goes.
Can I ask you, what's the significance, though? Because this is a thing that we've been talking about since we've seen the selling, is that global investors in general, maybe not looking at the U.S. as being a safe haven, whether it comes to stocks, whether it comes to the treasury market, the real world, right, the dollar as well?
That is exactly what's going on. We actually saw some movement away from utilities and REITs, where people get their dividends. So that's like the safety play in in the market, in the stock market in general, and people are moving. The Europe Stock 600 is up today. Was up today. So it's, you know, people are finding other places to put their money.
You sat with us a week ago. You sat with us earlier this week. One common refrain we've heard from you is this has been an orderly demonstration of actions in the markets, whether it's been up or whether it's been down. Do you stick to that?
Yes, although at 6% we were preparing for the shutdowns. What we
circuit breakers.
The circuit breakers,
okay.
Exactly. Well, actually, yeah, because it would just be a 15-minute hold.
But still orderly to you?
Still relatively orderly. What we haven't heard and what we're waiting for is some hedge fund can't make their margin call. You know, some counterparties not showing up, and you know, there being empty trades. We're not hearing about that. Things are still working. Yes.
What would make you change that view? What are you going to look for to say this is no longer orderly? I'm getting flashbacks to 2020, to 2008, 2009,
COVID, yeah.
And flashbacks to the dot-com bust.
Yeah, when we start hearing about a fund going under, we start hearing about funds being caught, because everybody's caught off sides here, but caught dramatically off sides. And it's a lot of leverage in the system. There's still a lot of leverage. So when that starts unwinding, we will start getting calls like, oh my God, we're hearing a fund is going to go under, and it's a big fund. And that's when things start getting really concerning. We haven't reached that point yet.
Oh, TBD. Yeah. Just kidding. Eric, thank you so much. Eric Weiner, Bloomberg News Senior Editor, Equities America. All right, stocks down, and this is despite some good inflation data. Yeah, folks, we got a CPI report this morning. I know it feels like hours ago. It was hours ago. But let's talk a little bit about the economic fundamentals and someone who here at Bloomberg just kind of rolls in trade policy, the global economy, everything into one. Michael McKee is back with us.
Yeah, but
I'm talking you up, so you better deliver.
I thought Duke was going to win that Final Four. So.
Spoiler
alert. Well, I know.
A lot of people missed it. How are you? Okay, inflation was good.
Inflation was good.
Yeah.
And it really doesn't tell us much, which is kind of the cliche that we were all going into this with, because it's before the tariffs came on.
Yeah.
But it was better than expected. The headline dropping 0.1%, and that was largely due to gasoline prices going down 6.3%, which isn't necessarily good news because prices went down because people were marking down growth outlooks. But we also saw furniture and apparel. We get a lot of those from China up, but they were up by about the same amount they usually are in March. So it wasn't a big deal. There were two things that were interesting. Smartphones down 1.1%. You would have thought that maybe prices would have gone up. Unless Apple was, we saw a story today about how they brought in a bunch from India.
Right.
But then travel is the one area that seems to be already taking a big hit from tariff talk. Airfares were down 5.3%. Hotels and lodging down 3.5%.
That's real.
And what was really interesting is Omar Sharif, you know, I mean, Inflation Insights, he gets granular with this stuff. It was all hotels in the Northeast, which to him suggests it was Canadians.
Oh, interesting.
Okay.
We've heard that from people on the states here on the East Coast that border.
And so maybe this spreads
upstate
into the
New
next month, but because it's the timing, the Fed isn't going to pay much attention.
But from a tourism perspective, if you can attribute that to Canada at this point, or if Omar Sharif can do that, is it economic uncertainty that we can also attribute to the decline in hotel prices and the decline in airline prices? Are companies not booking to the same extent that they were several months ago as a result of uncertainty?
It definitely seems that way, and we're getting tourist boycotts. And so this could be a major impact on the economy. Tourism is much bigger than people think, certainly big in New York City. That's something we have to keep an eye on. And what's also kind of interesting is we don't know how long any of this will last, but remember next year we're supposed to have the World Cup here. And there are people already talking about...
Well, not just here, but throughout North America.
Yeah, well, everybody will go to the games in Canada and Mexico, but will they go to the games that are here?
That's really interesting. Hey, listen, our most read story on the Bloomberg right now in the past eight hours, stock slide as economic angst hits Wall Street. When you look at the economic fundamentals, when the Fed, Mike, is looking at the economic fundamentals, right, we know what their mandate is. You know, how are they assessing the situation right here on this afternoon, and how are they maybe thinking about the market volatility and how that plays in?
Well, I haven't talked to anybody this afternoon, but I suspect that, like everybody who's a professional at this business knows, this is kind of the pattern that you see. You get the big up day, and then it goes back down again, and so they're not going to be surprised by that at all. Depending on how bad the correction gets, you could have a wealth effect issue that would slow growth. We'll have to see on that score. The real issue for them was what was happening in the bond market.
Right.
And we did talk to a number of them yesterday, including Beth Hammock, who used to be the treasurer at Goldman Sachs, so she knows the markets. And they basically felt that there was a lot of volatility, but there wasn't a systemic issue. There wasn't an imminent failure of market operations, which would be about the only reason that the Fed would get involved. So it's good news that when we're having these kinds of disruptions, that the system is holding. And you were just talking about how this is an orderly decline. I mean, we're getting 3-4% down a day. We're not. Yesterday we had the big rise, but we're not seeing the kind of collapses that we saw in previous episodes, like when you have a Thursday down 7% and a Friday down 5%, and then Monday in 1887, 22%.
Right.
That hasn't happened, so it doesn't suggest there's a panic out there that the Fed would have to worry about.
Okay, well, 30 seconds on that, Mike. A host of Fed speakers making news today. How would you characterize that they're looking at this?
Oh, it's almost like they're singing from the same script. They're all saying, we have to keep an eye on this. We could have a problem with growth. We could have a problem with inflation. We're more worried about inflation than we are growth at this point. But we are unable to make a decision about moving rates one way or another because there's not enough information. But the good thing is where rates are is perfectly acceptable to us. So you just expect them to stay on hold and to not say anything controversial for quite some time.
20 seconds. I'm going to squeeze in one more. Anything that could a Fed rate cut do anything to kind of appease our trading partners? Like, I think about the trading picture overall, how global investors, how other countries are looking at the United States and feeling uncertain about the outlook or what we might get from the White House next.
I don't think a rate cut would make a difference because it wouldn't be coming from the administration, so it wouldn't have any policy impacts. It could have an impact on the dollar. It could, in theory, bring dollar's value down, but it seems to be doing that on its own.
Yeah, it's doing just fine on that.
I'm not sure.
All right, cool stuff. Michael, thank you so much. Mike McKee, he's Bloomberg News International Economics and Policy Correspondent. Let's talk a little bit more about the U.S. Treasury market, the U.S. rates market. Bloomberg Intelligence headquarters out in Princeton, New Jersey. That's where we find Ira Jersey. He's the team's chief U.S. interest rate strategist. So, Ira, glad we could talk to you. I feel like it really is about the bond market. We did have a 30-year auction. Looks like I think it went fairly well. So talk to us a little bit about that and the overall trade that we're seeing in treasuries today. We also had, of course, that inflation print that Mike just talked about.
Yeah, so the long bond, the 30-year Treasury bond, had sold off pretty dramatically this morning, and I think some people were trying to say, oh, let's hop in here a little bit. We can get cheaper levels, and the auction went very well. I mean, the auction, we graded it an A, and after yesterday's 10-year that got a grade of A+, the people don't mind buying demand at auction, but it didn't stick, and I think that that's an important factor here, whereas yesterday you kind of got this big snapback and a pretty big, large rally after such a strong 10-year auction. Today we rallied a little bit, but it as I mentioned, it didn't stick. And the yield curve has just steepened absolutely massively. And the question becomes, is that because of some flows and just people getting out of the long end, like private pension funds or insurers from overseas? Does it have to do with people thinking the Fed's going to cut rates and that's going to stem inflation in the long term, or is there something more nefarious going on under the system? And some of these things we don't know yet. I suspect that a lot of it is just people who are fearful that foreign investors who have had such a big bid for long-term Treasury bonds, that bid's just gone away, and now we're trying to find a new level where buyers care.
I mean, are you talking Japan, China? Who are you talking about?
Well, we're just about everybody. I mean, so for one thing, a lot of people have been saying, "Oh, is this China selling? Is this China selling?" You know, I don't know, but at the same time, China has a lot of FX reserves, the same as Japan, and foreign exchange reserves generally are not held in long-term treasuries. They're usually held 5 years and in. And if you go, you know, just speaking with central banks globally, that's the case. Whether it's Brazil, Peru, China, it doesn't matter. They tend to buy only short-term treasuries. Who does buy long-term treasuries are private investors. It's the insurance companies, the hedge funds, the you know, sovereign wealth funds certainly are you know, own them. So I suspect that it's some combination of them that, and it might not even be them selling. It's just fear that they won't be buyers, and I think that that's a big thing that we have to remember. Sometimes the market reprices not because of actual flows, but because people think that those flows either will or won't materialize. There's private foreign investors globally own a ton of duration risk. You know, we put out a note earlier this week that where we show a chart just of how much duration they own, and it's you know, hundreds of billions of dollars. So it would not be a big surprise that if you know, a life insurer in Taiwan gets a nod from their board and says, "Hey, don't buy treasuries anymore," that wouldn't surprise us at all, because it's you know, with what's going on with trade flows, that's going to affect boardrooms and how people perceive U.S. Treasuries as an investment vehicle.
You know, so net, Ira, because I've been thinking about this a lot, and we've had everybody talking about, of course, you know, the stress that they've seen in the Treasury trade. We heard the president addressing it and the reason why he put that 90-day pause in. I mean, has that gone away, and do we truly understand the stress points at this juncture?
Well, if you mean stress points, like when I look at the market and market depth, the market depth certainly has gone down a little bit, but I think in large part that's just because of the volatility. So generally speaking, you're talking about bid offers getting wider as the market becomes more volatile. So that's a natural cause. I do think that there are some stress points insofar as that dealers, so Treasury dealers, were as long Treasuries as they've ever been as of last week. Now we get more of that data. We get a new read on that data as today at 4 o'clock. And so because they're so full, I think they went into this sell-off without having the capacity to buy more. So that's one reason why doing something like exempting treasuries from the supplementary leverage ratio, the supplemental leverage ratio, might maybe help liquidity generally, because then you can have elasticity of dealer balance sheets that just doesn't quite exist today. And like I mentioned, dealers also had over $400 billion of treasuries on their books, the highest ever a couple of weeks ago. So you know, they weren't able to buy more, and that just means bid offer has to widen. That means that it's harder for them to intermediate the long end, right? These long duration, high risk, price risk securities anyway, in the 30-year. Meanwhile, the front end, you know, that rallies, right? Look at how massive this curve steepening's been. It's been incredible. It's been a great call by us, not the way that we thought that the curve was going to steepen, but that was our key call starting the year, was being steepeners.
Ira, there's been a lot of reporting in the last 24 hours about why we saw the pause, the 90-day pause from the president yesterday. And some reporting has indicated that the bond market helped him make that decision, or helped his officials move him in that direction. How do you view the power of the bond market when it comes to this president?
Well, for every president, the bond market is key. Like, the U.S. Treasury market is how we fund our debt. It's how we're perceived globally in terms of having both the safe haven currency or have the reserve currency and a safe haven asset that is U.S. Treasuries. But we're still going to have, regardless of what President Trump and what Congress tries to do, we're still going to have, you know, multi-$100 billion, if not trillion-dollar deficits for the next few years. And in order to fund that, you need to have a functioning Treasury market. And, you know, obviously, if you're the government, you want to have interest rates that are as low as possible, especially given whatever the economic environment is. So all of those things are true. So the Treasury market is key. And if, you know, people aren't buying treasuries globally, that's, or I should say that people buy treasuries globally because of the recycling of dollars, because we export a lot of dollars because we buy other people's goods. If that goes away, you're going to see probably in aggregate interest rates are a bit higher than they would be if, you know, we did export a whole lot of dollars.
What I want to go to, though, is what the Wednesday sell-off that we saw, the basis trade that everybody keeps talking about, right?
It's not the basis trade. Oh my goodness! It's like the basis trades and 2-year notes. 2-year notes are rallying. If this was due to the basis trade, the 2-year notes would be selling off, and they're not.
Okay, well that's because I'm trying to, like, everybody's kind of shooting stuff out there in terms of exactly what happened, and I just want to have the right context in terms of the president pointing to the bond market, everybody talking about it. Like, do we really understand what happened, and are we in a better place, I guess is my question.
Well, I don't think we completely understand what happened, and I don't think anybody does yet. We will find out over time. But in terms of the basis trade, right? The basis trade, I think, is scary to a lot of people because it is so large. But keep in mind, the basis trade exists basically for 2 reasons. One is that asset managers, so general investors, whether they're hedge funds or mutual funds and the like, they go out and they buy Treasury futures. Well, if they buy Treasury futures, someone else has to be on the other side of that.
Right.
And the person on the other side of that has to hedge their interest rate risk then. And so they do that by either buying Treasuries or receiving in interest rate swaps. And either way, you wind up in an environment where someone has to put on that basis trade. And there's been a lot in 2-year notes, 5-year notes, and 7-year notes that people have been doing this. And it's in large size. Is it a systemic market risk? I don't think so, right? It's only a systemic risk if everyone, only one side of that trade wants to get out of that trade. So that's where I question whether or not it's the basis trade is driving this volatility.
It's what I wanted to ask you yesterday, and I couldn't get to you, and now I got to you today, so I'm so glad we could. Ira, thank you. Really appreciate it. Bloomberg Intelligence Chief U.S. Interest Rate Strategist, Ira Jersey.
Hey, keeping an eye on markets is Charlie Pell. Let's get to him for an update on the markets and, of course, the business flash. Hey there, Charlie Pell.
Well, hello there, Tim. We are lower, off-session lows. Do want to begin, though, with a couple of developing stories, headlines right now on the Bloomberg Professional Service. The U.S. wants to install federal oversight of Colombia. The Trump administration wants Colombia to enter into a consent decree, that according to the Wall Street Journal. Also getting word that Novartis, the drug maker, is going to invest $23 billion in U.S.-based infrastructure over 5 years, and Novartis up now by about 0.1%. A lot of red on the screen today as the selling continues. We are down in 5 of the last 6 sessions. Right now we have got the S&P 500 index dropping by 2.9%. At the worst level of the day, we did see the S&P down by roughly 6.3%, but again down 160 points now on the S&P. Dow Industrial is lower by 904, down 2.2%, and NASDAQ is down 637. For the NASDAQ Composite Index, a drop of 3.7%. The Russell 2000 Index, broad-based selling, down now by 3.6%. Small cap shares moving lower. The 10-year, 4.38%, with your 2-year at 3.85%. Spot gold up $82 the ounce, $31.65, up now by 2.7%. West Texas Intermediate crude down 3.7%, just above $60 a barrel, $60.02, and Bitcoin is now down 4.2%, 79,700 on Bitcoin. So again, the Dow, the S&P, NASDAQ, all declining, off-session lows with a 3% drop right now on the S&P. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, you're up to date on the markets. Again, volatility and uncertainty, the watchword. We've got a great next guest who's got a global view, has seen a bunch of market cycles. With us is Mike Siegel. He is a partner at Goldman Sachs Asset Management, serves as global head of the insurance asset management and liquidity solutions businesses, as well as co-head of the client solutions group in Asia Pacific. You do see a lot. Also with us as Bloomberg TV global finance correspondent Shonali Basak, who actually brought us Mike. So we're so grateful because there's so much going on, Mike. And we want to dig into your specific worlds, but you do watch everything globally. And I'm assuming everything is connected. You watch a lot of different markets at this point. Let's start with the environment. We had one auto parts CEO describe it to us as the great financial crisis, the COVID shutdown, and the auto strike all rolled into one, at least for him specifically. How do you see today's market environment?
Well, Carol, thanks for having me, and thanks for that question. I think that people are clearly on edge and are reluctant to make any significant decisions until we get better clarity as to where the tariffs are going to end, where that situation is going to end. Once we have more clarity to that, you can then go back and see the markets will react, they'll adjust. The Fed will react, it will adjust, and so will companies in terms of how they're going to invest, including my insurance clients and including the liquidity clients.
We don't know how it's going to end, but I'm curious if you've mapped likely scenarios for how they'll end. What do you think is going to happen?
Well, we do map scenarios, and so first I'll stick with the insurance industry, which is very well capitalized and not levered in the sense that they're not over their skis. They don't hold a lot of equities on the balance sheet, so the equity market volatility that we've been seeing is not creating a capital strain. They are primarily fixed income investors, and by the way, we're seeing the intermediate and long end of the curve rise. We're seeing credit spreads widen. So on reinvestment, that's a pretty good situation, as long as it doesn't continue to cascade into something much more significant. Yeah.
Even though it's good for the longer term, for people who are reinvesting in bonds, you have insurance clients that are holding long-term bonds, and 10-year, 30-year notes are really blown out at this point. Are they suffering through a lot of pain because of it?
Yeah, so Sonali, you're absolutely right that on a mark-to-market basis, these bonds have lost value. But most of these institutions don't have to report on a mark-to-market basis. They're able to hold their bonds to maturity. So really, they are more benefiting from the ability to reinvest at higher yields than what's been happening to the current holdings. Not the same thing being true for hedge funds, example, or other institutions that are marked on a daily basis may have to provide collateral as their asset values are dropping. But that's not the case for the insurance industry.
But do they feel that there's a certainty that this does get resolved sooner rather than later? I think I love your interview you did with Boaz Weinstein, who I thought was assessing the situation and saying the thing is here we have a president who's in for just under 4 years here, and that he said the uncertainty genie is out of the bottle. So do we continue to, in your view, and you've got to think about short term, longer term, medium term, that uncertainty will be with us throughout this tenure?
I think uncertainty will be with us, hopefully not at the level that we have right now. And again, are companies in a position where they're forced to act or not? And to the extent that they're not over-levered, they're not forced to act, they could sit, watch, and look for opportunities. And I could tell you—
Are they nervous at all?
Oh, absolutely.
Okay. Keep going. Sorry.
So I would say, when you game plan out, right now this has primarily been an equity market event. Concerns that it becomes a bond market event. Rising yields are not that much of a problem. Draining liquidity becomes a problem. So there's a concern or a watch for that. Also, I would say for our insurance clients, they are long-term holders of corporate debt. How are those corporations going to fare? And certainly some corporations are going to be much more affected by tariffs, which would weaken credit. Others are immune to it. So we and our clients are doing a lot of work right now, going literally bond by bond, security by security. What is the sensitivity to the tariffs or not?
Well, on a micro level, some of that uncertainty has already led companies on a case-by-case basis to pull guidance. CarMax today, certain financial goals that it's just not giving. Delta earlier this week. You mentioned a lot of uncertainty, and I know yesterday Goldman Sachs rescinded its call for a recession this year. Are you seeing signs of a recession?
So let me say this. So one of the things we want to talk about was the survey. First, I would say on the insurance survey—
it's a 14th annual global insurance survey, 405 companies representing over $14 trillion in balance sheets assets combined. That's a lot.
That's a lot. It's about half the global industry's asset base. I bring that up because one of the questions we said is, what are you concerned about? And that question they got absolutely right. They're concerned about inflation. They're concerned about geopolitics. They're concerned about tariffs and market volatility.
Welcome to our world in a nutshell.
What they didn't get right, and nobody did, was the magnitude of the tariffs and the implications for that. So they didn't see recession this year. That view is changing, including at Goldman Sachs and within our clients. They thought the equity markets would be well-behaved, not rip-roaring, but well-behaved. That view is changing quite dramatically. That they also thought that rates had peaked and would be coming down slowly, both at the short end and the long end. And I still think that that's the prevailing view. So this backup in longer-term rates is looking like an investing opportunity. None of our clients have been selling or directing us to sell on their behalf. They are looking for opportunities to get into the market, but they're not in a rush. You know, they want to see how things settle out. Once they see how things settle out, then they'll know where to put capital to work.
You know, you mentioned that you're looking bond by bond right now. And the reason that's so interesting to me is because you're already seeing somewhat of a capital markets freeze. And if you're worried about corporate debt at all in this environment, what does it mean for the way people have confidence in investing in corporate debt in the future, in new issuance, for example?
Yeah, so Sonali, that's really going to be industry by industry, case by case, and that gets back to this uncertainty. Until we know how this unfolds, and it may not unfold to a point where we have definition. This is the way it's going to work. You've elevated the amount of uncertainty, which is elevating the amount of risk. I need to get paid a bigger risk premium to hold any of these instruments. And that's why we see credit spreads widening out.
You know, a lot of people are saying this is also a golden opportunity for while public capital markets are freezing to look at private capital, because you're seeing these private credit giants just float right in as the public markets are closed. But are you concerned that there's still a lot of pain under the surface in private markets, given that, you know, they call it the denominator effect? These companies are seeing their public portfolios really shrink and their private portfolios therefore become a bigger proportion of their holdings.
So let me take that question break that into two parts. One is the underlying asset values themselves. And so we've got private equity, we've got real estate, we've got infrastructure, we have private credit. At the moment, we're not seeing any of this flow through to the existing investments that have been made, but we have to see how things unfold. And if we end up in a deeper recession or a deeper recession, that's going to weaken the underlying asset values. Now, the thing you said about the denominator effect is the ability to put new capital to work. And there's two components to that. One is I already have a private equity portfolio. I was hoping to get realizations, give me fresh cash to put back to work. And if the public markets are closed, particularly the IPO market, you're not going to see as many of those realizations. So I'm going to be keeping more of my capital tied up in those assets. And then the second point you're making, which is more applicable, quite frankly, to pension plans and sovereign wealth funds, is as the public assets, particularly the equity assets, decline in value, all of a sudden my exposure on an asset allocation basis to the private assets has increased. Again, reduces my willingness to invest more. So
because this was supposed to be the year, right? That all of a sudden we could tap the public markets, sell some assets, IPO, whatever, right? Or M&A, and it.
Well, this was supposed to be the year. It is only April.
Okay. So you are hopeful that it gets better?
Well, I'm always hopeful, but we shall see.
I guess I'm just saying in an environment where if we expect more uncertainty over the next 3.5 years, that makes it tricky, right?
It makes it tricky. I think, you know, right now the administration is in the middle of trying to rebalance trade through tariffs. At some point that will settle, and then the markets can assess what does it all mean. And then I think you will see markets open up again. You'll see more flow of capital.
We're talking about the risky stuff. But I'm also wondering, you have one of the biggest money market businesses in the world under your purview. So how are those behaving? What are they being used for in an environment like this? Because it's generally safer than a lot of the debt markets that we're talking about.
Yeah, so Sonali, we manage over $700 billion of short-term liquidity products. We consider that to be the canary in the coal mine. So we're always watching what's happening with flows there. And at the moment, things have been very stable. The vast majority of the assets are government assets, you know, short-term treasury bills, et cetera. And we don't see flows coming into that market. We take that as a good sign. Another part of the market, which is called prime, includes a lot of commercial paper and other short-term debt of corporations. And we don't see companies moving out of prime. So at the moment, and we watch very closely, things feel calm at that end of the market.
When money leaves your money market funds, where does it go?
Well, over the last several crises, if I could say it like that, it's been actually coming into the money market funds. Basically, you know, the two competing forces would be bank deposits and money market funds. And, some of the crises have called into question, creditworthiness of banks, so it comes into the money market funds. If people are very nervous, it's going to go into government money market funds, so primarily T-bills and other government-guaranteed forms of debt.
Are you calling this a crisis right now?
No.
Are you seeing money coming into money markets?
No, as I said, we're watching on a daily and minute-by-minute basis, and we haven't seen any flows come in, unusual flows, nor have we seen flows moving out of prime into government.
Guys, by the way, every single crisis for the last decade or so, Mike has been one of my first calls, which is exactly why I
How's it going? How's it going?
Sonali, I hope that's not why you called me in today.
Is any money going outside the U.S.? Increasingly?
You've seen, coming into the beginning of the year, it looked like the U.S. economy was going to be the fastest, outside of China, the fastest growing economy in the world.
Exceptionalism, right? We talked about American exceptionalism.
Exceptionalism. And you also saw the dollar strengthening over a long period of time. So if I took foreign money and put it into the U.S. market, I had probably a underlying market that was going to rally, and I pick up the currency appreciation, a double whammy. Right now, the dollar's weakening, and the U.S. markets are selling off, so I'm sure that that's putting a damper on those flows.
I want to go to China and specifically the U.S. relationship with China. You spend a lot of time in China. You live partly in Hong Kong. You're co-head of the Client Solutions Group in Asia Pacific. Is the relationship between the U.S. and China broken?
That's really not in my bailiwick, but I will tell you our relationships with the government entities and the companies that are there, between our firm and those entities is very strong. What's playing out is just playing out above everybody's head, and we're leaving it to play out at that level.
But it has significant implications for the way that companies do business with one another. If one country has tariffs that exceed 125%, if it exceeds that, that's a big deal.
It's very important for the two countries to have good relationships, and then that translates down into the entities that we work with and the relationships we have with them.
Can I ask you one last question? Oak Tree Capital Management co-founder Howard Marks wrote today that Donald Trump's tariff policies have the potential to be the biggest economic event of our lifetimes, and warned that reversing them could still have consequences. Do you agree?
I don't know if I agree with that statement, but I will say this, that volatility has a cost. It's undermining, people's confidence to invest, whether it's corporations building plant and equipment, whether it's investors putting money to work. So there is a cost of volatility, and we're seeing that by the declines in the market and the widening out of spreads.
So appreciate this. Thank you so much, so much. Mike Siegel, partner at Goldman Sachs Asset Management, global head of the Insurance Asset Management and Liquidity Solutions business, also co-head of the Client Solutions Group in Asia Pacific. Mike, thank you very much. Really appreciate it. And Sonali, thanks for bringing us Mike, Bloomberg TV global finance correspondent. So if she calls you, you know what it's about. Is this a crisis?
But he says no for now.
He says no for now.
All right, let us know if that view changes. Do appreciate it. Thanks again to Mike Siegel.
Thank you
Let's
very
now
much.
head on over back to Charlie Pellet. He's been keeping his view on the markets. Hey, Charlie.
Hi, thank you very much, Tim. Here's what's going on. Economic angst, big time again today. We are off session lows, but the Dow, the S&P, NASDAQ, all very much in the red right now, looking at a 2.8% drop on the S&P 500 index. We're down 153 right now at 53.03. We've got the Dow lower by 2.1%, NASDAQ down 3.5%, keeping that all in context. Again, the S&P down by 2.8% of the worst level of the day. We did have the S&P falling by more than 6%. The 10-year 4.38% with the 2-year currently yielding 3.84%. We got a whole lot more on the markets coming up with our Gina Martin Adams. Spot gold is surging $90 the ounce right now, up by 3%. Precious metal at $31.73 the ounce. West Texas Intermediate crude down 3.2%, 60.38 on WTI, and Bitcoin right now down 4.2%, 79,639 on Bitcoin. CarMax backing away from the timing of its financial goals, joining a growing list of companies, indicating that uncertainty around President Trump's trade war is making long-term planning difficult. CarMax right now down by 16.1%. And we're just getting word that a passenger jet carrying at least 2 members members of Congress was clipped by another commercial plane on the ground at Ronald Reagan Washington National Airport. Developing story. We got the headline right now. We'll have more details as they become available. Recapping, S&P now down by 2.7%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie, giving you the update on the markets. Got to say, Argina Martin-Adams warned us yesterday that yesterday's rally did not give her too much comfort. I think I'm saying it safely. Based on her models, they're data dependent. Her view and concerns about the equity outlook has not changed. So let's just see what her thoughts are today. Gina is, of course, Bloomberg Intelligence Chief Equity Strategist. Did I say it right?
That's right.
All right. No, but did I say your warning?
Yeah, it's close. It's close enough. You know, it's minute to minute these days, Carol. So,
well, so how do you make sense?
Yeah,
like the rally yesterday, right? It wasn't.
You came in. You basically shook your head at the rally yesterday, and you said, "Anytime we see a move up, such as this, it's not a good thing."
Yeah.
And you pointed to 2008,
right?
And you said sure enough, the superlative was going back to 2008. You reminded all of us the market did not bottom until March of 2009.
Yeah, this is something we did earlier this week, is just looking at these major capitulation moments in the S&P 500 and put them in context of what's happening in the fundamentals. And what you do find is that the big sell-off, VIX spikes, capitulation moments, whatever you want to call it, in the midst of economic distress tend to happen way earlier than the ultimate bottom occurs. Whereas you can use things like capitulation, VIX, pairwise correlations, whatever technicals you love to show capitulation. You can use those for timing bottoms when the bottoms are a little minor 10% corrections that are not necessarily affiliated with major economic distress. But the simple fact that we're in this period of extraordinary uncertainty, and our other models, our more fundamentally oriented models, are telling us that the economic downside has really yet to be fully priced in the S&P 500, that kind of context would suggest to us we could be in for a more extended period of volatility, even if the volatility never reaches the levels that we got with Liberation Day.
So even though we're like off our lows, I mean, like how are you thinking about like how we end up today and what's important coming off of yesterday's rally?
I think the most important thing to watch right now, frankly, is fundamentals. I think that the market is going to be volatile. I think it's going to jump around. It's, you know, I wouldn't be surprised in any given day if we're up 5,000 and down 5,000.
The VIX kind of tells us that, right? A little bit.
Hold on. Say that again. Up what?
5,000 or down 5,000 on the Dow, not the S&P 500, which of course is at 5,000. It's a huge move.
That's a huge move.
Yeah. So I would not be surprised to see extreme volatility because our sensitivity levels to any kind of policy movements right now are enormous, right? We saw that yesterday. What I think we want to keep our eye on now is what are companies telling us throughout this earnings season? Are they going to start pulling guidance, because that's usually a sign of pretty extraordinary uncertainty? How are they navigating this crisis? Are they planning to push costs onto the consumer? And then further, are they starting to change their operations in response to the tariffs that are enacted?
We've kind of heard that that's happening already. We heard CarMax and Delta this week. Amazon CEO Andy Jassy said, and I'm going to get this, I'm not looking at exactly what he said, but the gist of his comments were, we think that producers will pass along the increased cost to consumers.
Yep.
That's happening.
Yeah, and I think they'll try. And then
What do you mean try?
the next, well, I think they'll try to put those prices out on the market, but will
Can
the
we handle
consumer accept those prices
Right, if you don't buy it, right?
Or also, is there a substitution, right? I think that this is very interesting in the context of China in particular, which provides an enormous amount of our consumer-focused
Is there a substitution there?
Is there a substitution? Does the consumer have to take the price? And then the consumer only has so much disposable income to go around. What are the alternative categories that they have to cut back on in an environment of accelerated price? Because we know wages are only growing at a single-digit pace. Tariffs are already coming in at 26% on average. That's a whole lot faster than wage growth is, and especially for the lower-income consumer, could be very, very meaningful at driving the ultimate pie and how they slice up that pie of income in their spending.
Bank earnings.
Yes.
What are you going to be watching out for?
Oh, I think this is going to be really interesting because we've seen such a tightening in financial conditions. Our sector strategist, Mike Casper, runs a macro model of financial sector earnings. And one of the things that model told us earlier this week is to expect financials earnings to be about half as much as consensus is anticipating. That's in terms of a growth rate. So some sensitivity coming for financials because we've seen such tightening in financial conditions. So what does that mean? What do we look for then? How tight are financial conditions, and are banks starting to prepare for a downturn? Because you would see loan loss provisions accelerate. You would see bank sort of lending get tighter. You would see them talk about the credit quality, what's happening with delinquencies and default rates. Those sort of indicators are things that we want to watch for in the banks specifically.
Well, we got a little clue, right, from Jamie Dimon and being on Fox and talking about the prospect of recession.
What about basic day-to-day movement of customer funds, what they're doing with their debit cards, what they're doing with their credit cards, how they're doing paying this stuff off?
Yeah, I think that that's a great point because you can get a lot of that data now in today's world of alternative data.
Yeah.
You can get a
So
lot of that.
You don't need to wait for the banks. You don't need to wait for Bank of
Yep.
America or Brian Moynihan to tell us what's going on there.
How are consumers actually handling this situation? What are they spending on? You could get that out of MasterCard data. You could get that out of all kinds of second
Are you
measure
seeing
data.
anything of concern there?
You know, I haven't looked in the second measure data that's available on Terminal. It's something I'll put on the to-do list, the laundry list of to-dos. It's something we should definitely do in advance of the consumer sector earnings season especially. I think given that tariffs really just got implemented, we're at the point where we can start to really follow that data series. But it's not something, I have to admit, it's not something we've really tracked too much.
You do follow the economic data. So what's the next data point you're thinking about here?
Oh,
I know
God.
earnings, obviously, but...
So we have consumer prices and producer prices this week. We're sort of in the midst of getting those indicators out now. I think the Fed is going to be absolutely critical to watch. You know, what tends to happen in the sequence right now is the market starts to acknowledge that recession risk is real. They start to follow the earnings numbers, and the analysts will mark down their expectations. And then the market will feel so lost and confused that it starts to look to saviors, right? It looks to the Fed, and we've already seen how the market looked to the White House as a potential savior from this. I think the market will start to really push on the Fed, and how much will the Fed be able to respond in the environment of inflation and growth is going to be absolutely critical. I think the job market is also really, really interesting right now. Challenger layoffs are at levels we only usually see in recession experiences already. So we're getting the layoffs there, but we're not seeing it in the non-farm number. Why are we not seeing it in the non-farm employment? Why are we not seeing it in the unemployment rate? Some of it, I think, is just survey. Some of it is we're still creating some jobs to offset those layoffs. Will we see job creation then start to slow? And will we also ultimately see the unemployment rate start to rise? Because those are really key triggers for the Fed.
I'm going to ask you the question that I asked you yesterday, but a day has passed and we have new data.
Yes.
Are you more or less concerned today than you were when you walked in yesterday?
Oh, I'm still very concerned. I don't think it's changed a whole lot.
It hasn't changed at
I
all.
think if anything, the only thing that I can say is at the very least, it does look like we had our panic. Our major first big capitulation event has happened.
Yeah.
I mean, does that make me feel really better that we won't have another one? Not necessarily. You know, I think that this whole the tariff situation is just incredibly uncertain. We still have average tariffs to contend with of 26%. Even if it's 10% on everybody, that still is a big sea change for the economy to contend with.
That's what we were thinking about. We had some guests yesterday. Maybe it was you too, who just said, look, let's not forget 10% in any given environment. Tariffs would be a big deal.
Yeah, huge deal, considering we're coming from an average tariff pace that had been close to 3.
All right, we're going to leave it there. Gina, thank you. So appreciate it. Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence, our go-to every day in terms of the trade. Tariffs, we heard a lot about tariffs at the White House today from President Trump.
Yeah, Chinese imports, tariffs on Chinese imports are at least 145%. We heard White House National Economic Council Director Kevin Hassett say that trade talks with some U.S. counterparts are already well along, including deals that were close to done last week.
A wild 24 hours. I hope you're keeping up, everybody. Bloomberg News White House correspondent Stephanie Lai has to keep up. She's out there at our Washington, D.C. News Bureau. All right, where are we? The latest. We know the president held his cabinet meeting. Negotiations with countries. What are we hearing? Update us.
Certainly. So the president did not mention whether or not he was speaking with President Xi as of yet. There really is no word from the administration as to if conversations have been happening with China. However, with other allies, there has been discussion among some of his economic advisors that there will be deals underway. This morning, Kevin Hassett had told a various number of news outlets and reporters that the U.S. has already been in discussion and that they have about 15 deals that are in the works right now, as according to the USTR.
But does he really know? And the only reason I say that is I feel like Tim and I have been talking about this, different reports about who's saying what, and then the president comes out and says something. Like, who really ultimately, is it what President Trump decides in any given moment, or is there somebody who really has his ear hour to hour?
Yeah, so the president said just an hour ago in his cabinet meeting that most of the discussions are being led by Secretary Besson and Letnick, and that President Trump is looped in on these conversations. Kevin Hassett also earlier this morning tried to insinuate that there is a orderly system for how this gets done, that the Chief of Staff, Susie Wiles, is coordinating all of this with the secretaries who then will make the deals and run them by Trump.
I anticipate, Stephanie, this is going to be on a country-by-country basis, but do we have any idea what a deal looks like when it's done?
It's actually funny that you mentioned that, because Hassett himself said, you know, it's kind of an open question right now what a deal is, or what they're considering an offer from these countries. And so really it does seem like something that is an open conversation between the two nations to you know, try to bring down the tariffs.
Look, again, country by country here, you know, we're not just talking about China, or we're not such as Australia, or maybe even the entire European Union. But what's on the table to satisfy the president?
You know, it's not just trade. Just yesterday, Trump had mentioned that he's also open to a number of other projects. One big one that he's mentioned quite a bit is LNG plants, and there's a number of things that he's just trying to get, and concessions that he's trying to extract from our trading partners.
I'm just thinking about kind of where we go next and what the expectation is. Because I do feel like the president tends to kind of gear up Monday, Tuesday in a big way, and then kind of wind down heading into the weekend. But we're living in unusual times, safe to say. I'm not going to say that. But so what are we expecting tomorrow in terms of the president? Might we hear some updates?
Yeah, so tomorrow what we know right now is that he is going to travel back to Florida for the weekend. As you know, he tends to wind down, but that doesn't mean that the work stops. You know, what some of his economic advisors have been saying is that the work is really just ramping up now, and that they're having these conversations with the trading partners, and that for the next couple of weeks, we should really expect a lot of world leaders to be coming to Washington to be having these conversations with the president. So, you know, as much as this is behind closed doors, we might also get a glimpse of it playing out in real time.
Well, you know, I asked general questions to you about what a deal looks like with, you know, country X or country Y. The elephant in the room is certainly China and the 145% tariffs that are on the country right now, Stephanie. What does a trade deal with China look like based on your reporting?
Yeah, I think it might be too premature to say. Obviously, they haven't seemed to even have communicated yet. Not only is the conversation centered on tariffs, it's also, we know, it has derailed the TikTok deal. And so one big aspect of these conversations will also be, how does the U.S. move forward with the TikTok deal, specifically if they would move forward with the Oracle proposal. And that, of course, would need buy-in from the Chinese government. And now we had reporting last week that that was already in the works, that the Chinese government was informed, and that ByteDance was helping usher that deal into fruition. But because of the tariffs, that was derailed, and we saw the president extend the deadline. And so when it comes to a deal with China, that will most certainly be one of the aspects of the conversation.
I think there's also a notable entertainment angle here, Carol. Disney shares are down by about 6.5%. Early this morning, we learned that China will reduce the number of imported U.S. films and introduce more films from other countries. Disney got about 10% of its revenue from Asia Pacific last year. The president was asked about this. His answer, quote, "I think I've heard of worse things."
Yeah. What?
He was asked about this specifically during the cabinet meeting by press. He said, "I think I've heard of worse things." Yeah. As in like, it didn't really bother him. That was the takeaway.
It's interesting because when I think about the movie studios and content and getting distribution in Asia, this is something when trade talks have come up over the last decade or so. This has been a big issue of contention, so something we'll continue to keep a watch on.
The studios worked so hard to get into China, and they work with every film to make sure that it works in China.
Exactly, right. It's very tricky in terms of changes and meeting, you know, certainly what the government will find acceptable. Stephanie, thank you so much. Stephanie Lai, Bloomberg News White House correspondent, joining us from D.C. All right, folks, that's going to wrap up this first hour of Bloomberg Business Week. We are looking at a market where the S&P 500 is down about 3.2%. NASDAQ 100, it is down about 3.8%. Dow down 2.5%. We're definitely off our lows of this session. If you're watching on TV, The close is coming your way in just a moment. Tim and I continuing right here on Business Week.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. On Wall Street, the Dow is tanking again after news that the Chinese tariffs are at 145%. Jennifer Jacobs reports from the White House, though there are signs both sides are willing to negotiate.
I think President Trump hopes that China makes the first move, and then the Chinese coming out with a statement saying, hey, listen, we've been clear and consistent that we're willing to have talks. That's a message that they've had for a long time. They're not just saying right now.
The Dow is off at 924 points. CBS's Jill Schlesinger watching the numbers.
So much of investing is about confidence. And it's very difficult to have confidence in an administration whose policies change day by day. And it's very difficult to build confidence once you rob confidence by making herky-jerky moves all the time.
It's not just investors who are worried. Here's CBS's Michael Wallace.
A survey by Harris X and Allison Worldwide finds Americans expect car prices to rise by more than 14% over the next year. Olivia Ojeda of Costa Mesa, California, has to buy a new car. Her old one caught fire.
The people that get impacted are me.
41% of those polled say they are very unlikely to buy a car. That's up from 28% in February. Those who do plan to buy are leaning toward American-made brands and away from foreign models slapped with tariffs. Michael Wallace, CBS News.
House Republicans have narrowly approved their budget framework after satisfying some GOP holdouts who wanted deeper spending cuts. Democratic Senator Chuck Schumer gives it a thumbs down.
House Republicans plowed ahead on a morally and financially bankrupt plan to gut Medicaid while cutting taxes for billionaires.
Secretary of State Marco Rubio said today he hopes nuclear talks with Iran this weekend lead to peace. Iran's supreme leader said his country could expel nuclear inspectors ahead of the talks. The U.S. just said that would be a miscalculation. Health Secretary Robert F. Kennedy Jr. says a large-scale study is underway into the cause of autism. He called it an epidemic and said by September we will know the causes. The CDC is stepping up its vaccination advice in the wake of the measles outbreak. Alexander Tin has that.
The CDC is now backing stepped-up recommendations for measles vaccination for Americans traveling to areas within the United States affected by this year's record measles outbreaks, including parts of Kansas and Texas. That means a second dose for many adults who were previously considered up to date with just one dose, and a shot of the vaccine ahead of schedule for many children.
The World Health Organization is calling for greater efforts to combat measles. It's spreading in 58 countries. This is CBS News. A mega deal in the world of high fashion. CBS's Vicki Barker reports.
It's Versace. Just weeks after Donatella Versace stepped down from the fashion house founded by her late brother Gianni, another era is ending for the label. Luxury Italian brand Prada has just announced it's buying Versace from U.S.-led Capri Holdings for close to $1.4 billion. It marks the end of Capri's attempt to create an American luxury group to rival its European competition. And analysts say it will allow Prada to diversify its portfolio and compete on a larger global stage. Vicki Barker, CBS News, London.
Do kids perform better in school when they're given universal pre-K? A new study claims they are often better prepared in math and reading than kids who don't have the free programs. On the other hand, the study notes their improvements tend to fade with time, suggesting kids still need support in early elementary school. I'm Cammie McCormick, CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily, with Carol Masser and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, is it Friday yet?
No, not even close.
It is Friday's Eve, everybody, so don't despair.
Got like an hour to go until the close of equity trading here, Carol. And then you got all day tomorrow, friend.
Hey, listen, just quick check on the markets, folks. We're off our lows of this session, but still down on the S&P 500, down about 2.8%. NASDAQ 100 down 3.4%. Looking at the S&P, 401 names to the downside, Tim, 102 to the upside. So very different tone from where we were 24 hours ago yesterday.
Yeah, the S&P 500 at one point was down the most since 2020, and the bond market, long-term treasuries tumbling. We're going all in on markets over these next 2 hours.
Yeah, it's all about tariffs, right? Oh, once again, investors worried about the tariffing impact, what it means for the global economy, what it means for the U.S. economy. So we're going to talk with someone who's been quite a bull in the market, and he's made really good calls over the last couple of years. We'll see what Ryan Dietrich has to say in just a moment.
Hey, first up, though, a check on the day's trade and top business stories. Here he is, Charlie Pellet.
Thank you very much indeed. 54 minutes to go ahead of the closing bell. Keep it locked into Bloomberg Radio for the very latest. That's what we do here at Bloomberg. We keep you up to date on what's happening with markets and, of course, excellent first-rate analysis. Here's where we stand. We've got the S&P 500 index down now by 2.9%, well off session lows in the late morning. We did see the S&P down more than 6%, but right now down 158 on the S&P 500 index. The Dow down 883 now, down 2.2%. And NASDAQ lower by 625 points, a drop there of 3.6%. The 10-year, 4.39%, with the 2-year that's currently yielding 3.83%. Spot gold up $91 the ounce, higher by 3%, $31.73 on the precious metal. West Texas Intermediate crude was trading below $60 a barrel, $60.36 right now. It is down 3.2%, and Bitcoin down now by 4.4%, 79,527 on Bitcoin. Economic angst enveloping every corner of Wall Street as U.S.-China trade tensions escalate. As for the economic outlook, Lauren Seidel-Baker is an economist at the Institute for Trend Research.
We still see general growth this year and for the next, I'll call it 3 to 5 years. But the risk with tariffs, once we finally do get certainty on tariffs, and that is a big wild card at the moment, the risk, I think, is that this takes growth slightly lower. I don't think it takes it negative, though. So we are not forecasting a recession even with this tariff impact.
Lauren Seidel-Baker of the Institute for Trend Research. China has announced it will curb imports of Hollywood films, opening a new front in its trade war with the U.S. Hours after President Trump's record tariffs took effect. Media stocks hard hit today. Case in point, the Walt Disney Company down 6.4%. Shares of Paramount Global, they're down by 2.4%. But Warner Brothers Discovery, that stock now plunging by 13.7%. Again, keep it locked into Bloomberg. The S&P down 3.3% for on-demand news 24 hours a day. Subscribe to Bloomberg News now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for the update, Charlie.
You ready for this?
I'm ready for it.
I've been waiting.
Well, Ryan Dietrich has been a U.S. stock optimist and right about his market and recession calls over the last couple of years. He nailed it in 2023 and 2024. And when we talked to him in December, he said the bull market had more room to run. So given the volatility and the declines that we've seen, including today, it's time to check in with him again. Ryan Dietrich is a chief market strategist at the Carson Group. They've got about $42 billion in assets under management. He joins us from Cincinnati, Ohio. Ryan, are you still bullish?
Boy, first off, thanks for having me back. You know, we are. I know it's been rough. I know we did not expect to see a near bear market this year. I know I came on with you guys earlier this year and said maybe we could get between 10 and 15% correction after not seeing one all of last year. But clearly with everything like everyone's talking about.
And we got a 19.99% correction.
Yeah, we were close. And intraday, I know we were there. We can get into a lot of the different things here, but I think the key thing that we're really stressing is, yes, we still think stocks are going to do okay when all is said and done this year, but, you know, to be diversified, I know it's kind of boring to say, but, you know, just yesterday, right, we manage a lot of money, right? Just yesterday, we actually went into a little bit more international stocks. We specifically like Europe here. We think, you know, when times of stress and uncertainty, you want to be diversified. We have some bonds. We've had some gold for a while. We've had gold for 2 years now.
Okay.
It wasn't quite as popular. So be diversified here when things are like this.
But at the end of this year, do you see the S&P 500 having a gain or a loss?
No, I'd say a gain, and that's really unique because we were just down 15% for the year not that long ago. You look in history, when you're down at least 15% at any point during the year, it's kind of rare. You're looking at like 82, 2009, and 2020, and I think by memory, that might be about it, years that we're down at least 15% for the year to come back to positive. But we can get into the weeds of it. There's so much negativity. We think if any potential good news, we saw what happened yesterday. Do we go into a recession or not? It's still our base case, no. You know, but again, we get all of the worries. Now let me just touch on one thing. I know you guys like talking about technicals here. Yesterday, if you look at the NYSE, New York Stock Exchange, I've got data back to 1980 on this. If you look at the volume, up versus down, it was 68 times up volume versus down volume. That's a record. We've never seen a day with that much up volume versus down volume. What does that mean? Well, listen, you're talking like August of 82. You're talking like March of 2009. Those are some other times we saw days like yesterday, which kind of tells us the sellers went on strike. And I know the sellers came back a little bit today.
Wasn't a lot of it short covering yesterday?
Yeah.
I mean, this is what we've talked about with our team. I mean, there was a lot of short covering going on, no?
You're exactly right, and that's how bottoms start. We hear that every time. It's short covering, and then it tends to go a little bit further. So,
but it's not a fundamental trade. It's not like you're, okay, I'm buying this because I think, you know, their earnings outlook is great. It's, I got to cover my short.
Yeah, you're right. And for the shorts, that's true. But again, what's the market do, right? Right, Carol? It's all what's baked. And by the way, you said it feels like Friday. I think Monday morning felt like Friday, didn't it? It's just like, when is it Friday around here? But anyway, you know, what's baked in, what's not. I mean, there is some, all of your guests have pointed these things out. Huge put-to-call ratio spikes, over-the-top negative sentiment, rightfully so. I mean, look at the headlines, and it's been unfortunate what's happened for a lot of investors. At the same time, we're stressing your best days of the year tend to happen around your worst days of the year. So if you just sold because you had a 10% drop Thursday and Friday, then boom, you have a 9% bounce just yesterday. I mean, that's some important things to remember. And again, to us, what's being priced in is so over the top negative that there's probably still more, a good deal more upside, to be honest. Maybe it's not going to happen tomorrow, but when we look up and avoid a recession, we think things are still going to be okay when all is said and done this year.
What changes your view? What would have to happen between now and, let's say, 6 weeks from now, when you come back on with us and I ask you, Ryan Dietrich, are we going to end the year with the S&P 500 higher or lower? And you tell me lower. Why are you going to tell me that?
Yeah, that's a great question there. One of the things I really like to follow are the credit markets. I know you've had a lot of good credit guests on, you know, last several weeks also. When you look at spreads, right, keep this simple, triple B spreads, high yield spreads, they are not anywhere near what they were in 2022. So if the smartest people in the room, and I grew up thinking this, is the credit markets, they're not as worried right now about a monster under the bed as what the stock market is. It's shocking. Honestly, it's shocking to me right now. Year to date, high yield corporate bonds are down about 3%. If you were to say the stock market's done what it's done with the headlines we've seen, I would expect to see more stress in you know, high yield corporate bonds. But we're not seeing that. Now, that can change in a hurry. Okay. We get that. But I think if the credit markets really spiral out of control, Tim, that's what would worry me. And we're not seeing that as of today, knock on wood.
We do have a headline that crossed around 220. U.S. leverage loan funds seeing a record $6.5 billion weekly outflow. Just wanted to throw that out there. The thing is, you know, we had an economy that was doing well. We were still dealing with a little bit of inflation.
Yep.
we know the game in town right now is concerns about tariffs. And if we stay at 10%, as most people have assessed, Ryan, that is a tricky thing. It's, any other moment in time where if we just impose the United States 10% tariffs on all of our trading partners, that's a problem. So if that stays in place, what does that kind of problem look like in terms of the equity trade and the corporate earnings trade and the U.S. economy?
Yeah, you're right. I mean, it's the uncertainty factor, right? I mean, obviously, we got the decent news yesterday with the 90-day kind of punt, if you will.
But the 10% is still in place.
It absolutely is. And again, nobody, for the most part, thought 9 days ago that we'd be here where we are when President Trump held up that little piece of paper with all those countries, all those numbers on it. We zoomed in and realized, oh my goodness, this is an effective tariff rate of maybe 23, 24, 25%. But you're right, it's all about art of the deal and going back and forth. But the truth, again, that's why we're getting this kind of revaluation, right, of markets. Why we've had one of the quickest corrections we've ever seen. We were almost in a bear market. I'm with you, but again, I mean, you have to think the resourcefulness of the U.S., the ingenuity of the U.S. If we just know it's 10%, then I think we'll be okay. We can get through that. Yes, if it's over 20, Carol, that's not going to be good. We've all talked about the consumer confidence levels, small business confidence levels. People are just confused, and when you have uncertainty, this is what you have: a sell first, ask questions later mentality. We just need a little more, a positive news on this trade front, like we saw yesterday. It doesn't have to be majorly positive news, but I think it's just some decent news. And one more thing on this, look at the labor market. I know this can change in a hurry, but we initial claims today wasn't all that bad, right? The labor market is still hanging in there. So it's hard to have a recession if you're not laying off a bunch of people. Now, we get it. That could change.
That can change. And I should note that we did just speak to Gina Martin Adams on our Bloomberg Intelligence team, chief equity strategist. And she noted that although the claims are holding up and non-farms are holding up, she's seeing some weakness when it comes to the Challenger grain Christmas numbers that is concerning to her. I do want to remind everybody where we are in the trade today. The S&P 500 was down as much as 6.3%. It's bounced off those lows. We're down 3.5%. The NASDAQ composite down 4.4%. The Dow down 2.63%. The Russell 2000, those small caps, down about 4%. Ryan, to kind of go with Carol's point when it comes to tariffs, you love talking technicals, but at what point in your view do fundamentals overrule technicals? Because tariffs aren't technical. These are fundamental, and this is now affecting companies here in the U.S. So at what point do fundamentals overrule technicals?
Yeah, I grew up with the old saying, news trumps charts. Trump's being the key word there. So we know news matters. And I mean, believe me, from a macro point of view on the Carson Investor Research team, we look at technicals, valuations, and fundamentals. So fundamentals are clearly in there. It's going to be really interesting. I mean, get your popcorn ready, right? When we got these banks coming up tomorrow, right? We've got a lot of companies coming out. I mean, it's really unique what Delta just said. Delta said, we're not going to give you any guidance because we don't even know what to say. I mean, so that's really interesting that's what that company's doing. How many other companies are going to do that? We'll have to wait and see. But I'm anxious to hear what corporate America has to say here, Tim, about kind of the future. One other thing, I mean, I'm sure you guys talk about this, the dollar. I mean, the dollar action, I mean, this is one of the first crises we've seen in our lifetime, most listeners' lifetime, where the dollar did not get a bid. People did not flock to the dollar. So listen, I truly don't know what exactly it means. Is a dollar losing reserve currency status? I'd like to think not, but it's really unique what we're seeing with the dollar being this weak. I mean, this last comment here, March of 2020, gold down, stocks down, bonds down. Dollar was the only thing that went up the first half of March 2020. And we're really not seeing that dollar.
Well, yeah, so what does that tell you about this environment? If we're seeing gold surge, but a weakness in those other areas that you mentioned, what does that tell you?
Well, again, I'm going to put my investor hat on, my portfolio manager hat, because this is what we just did yesterday. And we've been talking about this for a while. If the dollar's weak, you want to own some international exposure. You want to have some international stocks because they tend to do better in a weak dollar. Yes, a weak dollar does a little bit better for commodities on the whole, but specifically in our tactical models, we've got a 4% allocation to gold for, I think it was March 31st of 2 years ago when we added that, so almost 2 years ago. So there are some things that you can do okay with a lower dollar. Also, one of the things we just added again yesterday in the money we run, low volatility. Low volatility, if you look at that, it's pretty much an ETF that has everything really except for tech. I mean, it's like the high flyers. And that is up 1.5% on the year. I'm not saying that's spectacular, but compared to where we were, so low volatility, international exposure, maybe some commodities, some gold. We've got some managed futures too. Yes, we are still about 74% or so equities in our unconstrained models we run. So we've got some equities, but when you look at what we have in equities, it's not just, crazy over-the-top aggressive stuff. There's some other things like low vol that we still like here, Tim.
Hey, Ryan, one thing I want to ask you, and you mentioned international equities, and you said Europe specifically. I'm looking at our Markets Live blog, and it talks about how U.S. equity valuations have fallen more than their peers today, extending their decline since January 20th, and they talked about the rally yesterday was full of strange distortions, with traders ignoring the fact that the overall level of tariffs in the U.S. hadn't changed all that much, a reality that seems to be registering now. But when you do look around the world, you mentioned more in Europe. Are you looking to possibly even increase that exposure overseas at this point?
Well, given we just increased it a little bit yesterday, Carol, probably not quite right now. But I will say this. I mean, I've done this for 25 years. And for 25 years, I've heard Europe is cheap, right? Developed international is cheap. Well, sometimes you're cheap for a reason. But again, we've seen Germany came out, maybe 6 weeks ago with kind of the big bazooka, really trying to use a lot of fiscal policy to get their economy going. There are some things that, again, in times of uncertainty, you kind of want to diversify, and that's, again, just why we've moved a little bit more into international, specifically Europe. Now, EM, just quickly on EM, we're still not too warm and fuzzy about EM. We're still not, I know China had a big bounce, but it's rolling back over. So we'd stick more developed international, kind of the European side of things versus emerging markets,
Hey, one thing I want to ask you, flows. What are you seeing in terms of flows in and out right now, or over the last week or two or a couple of weeks?
Yeah, I mean, a good deal of outflows. I mean, there's been a good deal of worry still. I mean, there truly is some panic in the air. We know that. I mean, the VIX is the one we like to talk about. I know you guys like to talk about it. We just had the first VIX spike above 50 in a long time. I took a look, like when you have that initial VIX spike above 50, like the last 6 times going back like 20 years. Well, not surprisingly, 1 and 3 months later, it's volatility and honestly some weakness. But 6 to 12 months later, you tend to be pretty strong. One more on this. We had, as everybody knows, a really big up day yesterday. I found 23 times the S&P was up at least 5% in one day. So those are like the best days we've seen. And yes, a lot of them took place in bear markets, and nearly all of them took place beneath the 200-day moving average where volatility kind of reigns. Still, when you look at those 23, 6 months later to a year later, you're talking some really solid returns. 1 year later, S&P's up 91% of the time, a year after.
But were we in a tariff trade war?
Yep. Well, I mean, hey, listen, some of those took place in the great financial crisis. Some of those took place during the flash crash. I mean, I totally get what you're saying. But a lot of times when we all are worried and then we price in all this negativity, Carol, maybe we can get some. I'm a glass half full guy. You know that.
I know I was going to ask, have you ever been a bear? But I'm not sure.
I've asked him that before, and I think you have been.
Yeah, I mean, we can be more neutral. Honestly, we manage money. We have models that we have to have certain allocations to equities, right? So I can't just say go all in gold. But we totally can position things a little more defensively. And honest to goodness, when I came on with you 2 years ago, we had more growthy things. We had more aggressive things. Now with the money, with the equities we own, like I'm talking, I mean, we've got some low volatility in there, So that's not something we had 2 years ago.
I think what Carol's asking, and it's a question that a lot of friends have actually been asking me, people who are not in the markets, in and out of the markets, they're just like normal people with 401ks and who have investment accounts, is this time different? Yes or no?
Well, the 4 most dangerous words this time is different. Sir John Templeton. Here's what I've done. Every 15th, I put a little money in my kids' 529s. I actually put a little bit more in. Right, my 401k, I actually try to put a little bit more in. I have no idea when this is going to bottom, but if you don't need that money for 5 to 10 years, the old saying, the stock market's the only place things go on sale. Everybody runs out of the store screaming. There's a lot of that. Okay, so there's some really good companies you can get a lot cheaper that everybody probably loved 8 months ago, and who knows where they're going to be 3 months from now. But I think if you're longer-term investors out there listening that have time, this is going to be a time we look back and say, wow, Liberation Day was not fun. That was not a good time, but boy, I'm glad I didn't panic. And one more little cheeky one, plans are useless. Planning is everything. President Eisenhower, have a plan, stick with it. And a lot of people, unfortunately, don't stick with their plans when you have scary headlines like this. And we get why, but then you look back and you realize, oh my, I should have probably stuck with my plan.
Yeah, provided the long-term outlook or the economic outlook, the U.S. economy hasn't changed fundamentally as a result of maybe long-standing tariffs. Like, there's so much at play here, because we've heard from some super smart people like yourself, but also like Howard Marks, who's saying that, you know, there could be certainly longer-term impact because of the tariffs and the volatility that we've seen in the markets. Hey, so glad we could get some time with you. Ryan Dietrich, he's Chief Market Strategist at the Carson Group, joining us there from Cincinnati.
Well, big banks kick off earnings tomorrow. We'll hear from J.P. Morgan and others. Everyone's watching for what Wall Street C-suite will have to say about the tariffs. Meantime, yesterday we saw that Wall Street execs prevailed once again, reestablishing their political potency. We're going to get to that story in just a minute.
Yep, we are indeed. We're going to talk about Wall Street, what our folks are hearing. First up, though, back to the markets, guys. Let's get an update for you. Here's Charlie Pellet.
Hi, thank you very much, Laura. Across the board now, 36 minutes to go ahead of the closing bell. Big banks tomorrow morning. You mentioned JPM down now by 3.4%. Wells Fargo also reporting tomorrow down now by 5.4%. And Citigroup ahead of earnings next week down by 4.6%. Stocks lower across the board right now with the Dow, the S&P, NASDAQ all in the red. Key takeaway at this hour, we are off session lows with the S&P down 184 now, down 3.3%. Worst level of the session, we did have the S&P down by more than 6%. The Dow down by 2.5%. NASDAQ Composite Index down now by 4.2%. 10-year 4.39% with the 2-year 3.83%. Economic angst enveloping every corner of Wall Street today. Gold, though, up $89 the ounce. Spot gold up 2.9%, 31.72 the ounce, and West Texas Intermediate crude oil is down 3.2%, 60.35 for a barrel of WTI. So where are the opportunities in this market? Nancy Tengler is Chief Investment Officer at Laffer Tengler Investments.
We're still selectively buying tech names, mostly focused on the software side of things, less focused on the hardware side. We still believe AI is instrumental. You saw Spotify headline that said, no more new jobs unless you can prove it can't be done with AI. So I think those are important. Walmart came out and reaffirmed the full year guidance. They're going to generate, they're our poster child of an old economy company that has pivoted to the new names.
Nancy Tengler of Laffer Tengler Investments. Novavax shares plunging now by 21% after Health and Human Services Secretary Robert F. Kennedy Jr. raised doubts about the efficacy of its COVID vaccine. Novavax's shot is already on the market under a conditional approval. Again, Novavax right now down by 21%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie Pellet. We've got a couple guys here in the Bloomberg Interactive Brokers studio who know
Just a
exactly.
couple of guys. We found them outside wandering the halls.
These are guys who
just saying
really have their ear to Wall Street what executives in the C-suite at banks and also what investment managers who manage billions and billions of dollars are thinking, what they're doing, who they're talking to. We got Sri Natarajan, Bloomberg News Chief Wall Street Correspondent. Max Abelson is Bloomberg News finance reporter. They're part of the team who spoke to executives across the financial industry to chronicle their reaction and the mood on Wall Street after Trump's sudden reversal on tariffs. You guys have got to check out that story at Bloomberg.com and on the Bloomberg terminal. I do want to start with you, Max, because a lot has happened in the last, could have said a week, could have said 48 hours, could have said 36 hours, could have said 24 hours. This is a fast-moving story. You have your ear. You have the ear of these folks. They have your ear. What are you hearing from Wall Street?
Well, you know, instead of talking about what I was thinking we were going to talk about, which is our story with Hannah Levitt and Todd Gillespie about the Wall Street execs, you know, basically crediting Jamie Dimon and Bill Ackman with swaying Trump on tariffs, I want to call listeners' attention to a different story that Sri also co-wrote, this one with Annie Massa and Hannah Levitt, because I think it says so much about this really chaotic and uncertain and strange time that we're in. There's a J.P. Morgan strategist who's a big deal, Mike Sembelis. And he literally, Sri, is this fair to say that he censored himself? He physically blacked out the letters of a report, essentially implying that if he, and by extension J.P. Morgan, and by extension Wall Street, were to be honest about what they're seeing out there, and what the way they interpret what's happening in Washington, that if they were to be honest, that Trump would, would punish them. And I can't say I've ever seen anything like that. You know, in a way, it's a relatively, it's not that it's a small story. It's just it's a specific, you know, observation. But I think it's a big deal. And I think it shows that right now in this market at this moment, without exaggerating, I think there are two kinds of fear. And one kind of fear is about what's going to happen with tariffs, what's going to happen in the United States financial markets, what's going to happen in the global markets. I think there's also a fear about the White House and a billionaire president who is very clear that he is happy to take revenge personally and professionally on people he dislikes. And I think it's really, you know, we've seen it all, but I can't say I've seen something like that.
It's kind of a, like, what's going to happen to me, right? Like, there's that focus. Sure.
The image of this in the story, just to spell it out for people who are listening or watching right now who haven't seen the story, it looks like something that has been declassified by the government, like a historical paper that is just filled with blocks of black covering up certain bits of texture.
And that's, of course, Semblus obviously trying to make a little bit of a point on what he sees the climate to be right now. And he said, I've been doing this for over 30 years and I've never experienced a moment like this where people have to walk on eggshells. Why that's important is goes back to the other story we were discussing and the broader story playing out in markets. At a time like this, when there is so much turmoil and chaos and volatility, can you really count on Wall Street and its elder statesmen to be out there speaking with candor, being fully honest? Even the criticism we saw leveled at Trump by some of his billionaire supporters over the weekend and into the early parts of the week was couched in so much praise, was padded with so much praise that they were going out of their way to make sure that they could try and get their point across to the president, tell him that the tariffs, the proposal, the way he wanted to go about reshaping the global trade order could have a catastrophic impact on the markets, but they were weighing every word ever so carefully. Yesterday, we thought what we got was a bit of a reprieve. Markets obviously shot up, and in the moment, sort of it made sense because you were truly worried that Trump and his team were going to stick to their guns, and it was not going to be good news for the markets. And you did see a reversal, but actually the action today tells you that that was brief and momentary. And we might be operating within a certain band now, but that band is not great compared to where we were a month ago. And there is no necessity and direction and clarity on where we head next because policy itself can turn on its head every few hours.
But not having that guardrail, right? And we've been talking about this a lot in terms of the CEO community and folks just not maybe comments, but they're made anonymously, right, through different surveys, and they're not tying their names to things. But by not having that guardrail, like the Wall Street guardrail, I think, what if we didn't have some of that? Like, I think about the financial crisis. Can we think about that crisis and what CEOs, certainly on Wall Street, were saying and what was needed? And if they had been afraid of the administration, like, I'm just curious if we can take it back to there.
The timing is powerful. You know, it's true that we're not in September 2008, and we're not in March of 2008. I actually talked to Bob Diamond, speaking of 2008, who, of course, the former Barclays head, and he said, you know, look, back then, markets were spiraling out of control. Now it feels like that's something that could happen, but it hasn't happened yet. Something is about to begin tomorrow, though, and Sridhar and I are going to have to wake up really early in the morning, and we're going to get at our desks, and we're going to start bank earnings, and we're going to be chronicling it. Actually, every 3 months, I live blog it. Shout out to the Bloomberg News live blogging system. The reason that live blogging matters, the reason that bank earnings matter, and that there's a whole ecosystem of analysts and investors who listen in really closely to what bank executives have to say, is that it's just as much a matter of looking at the past. You know, obviously that's what earnings are. You're saying, okay, this is what happened in the first quarter. It's looking back. But the real reason it matters is because it's a glimpse of the future. It offers a chance for bank executives to say, this is what we see on the horizon. You know, if you want to pick something narrow like IPOs, bank executives were dancing in the street, to use their metaphor, because they thought that there was going to be this huge boom in M&As and M&A mergers. That's the kind of thing that we'd talk about at bank earnings at the end of last year. Now we listen in, hoping to get insight into what they're seeing in the economy, what they're seeing in business going forward. And it's like a very queasy thought to think that they won't give, or would be rather afraid to give, an accurate picture because of the possibility that, like, you know, they'll get in trouble if they say the wrong thing.
And look, I think it's always tempting to, every time there is some sort of a jitter or something more serious in the markets, it's tempting to go back to 2008, wonder if it could get as bad as the 2008 financial crisis. Max would obviously remember this well because he was there. He was already a veteran reporter in the markets and covering it very closely back then. But you have to remember 2008 was a systemic breakdown. There were things about the capitalism that was unleashed in the world and how it was playing out in different corners of the market and how interconnected the world had become that was impacting the markets. What is happening now seems to be the markets trying to decipher, markets trying to discern, markets trying to understand what the policy is going to be from one administration.
One
from
individual.
One individual driving it. And that's perhaps driving them a little mad and making them cower in fear a little bit, to be honest.
And I think one thing that we've talked about a lot and we've heard from a lot of our guests is that the difference between those other situations that the two of you talk about is that this is, as Carol mentioned, from the policy stemming from one single government, from one single man. And critics have said this is self-inflicted. We're speaking with Sri Natarajan, Bloomberg News chief Wall Street correspondent, and Max Abelson, Bloomberg News finance reporter. In the meantime, taking a look at markets, we're off our worst levels of the day. The S&P 500 is down 3.5%. The NASDAQ composite down 4.4%, and the Dow down 2.8%.
Yeah, folks, we're off our lows of the session, so we have seen more selling earlier in the day. I'm looking at the S&P, just one metric, 434 names lower in today's session, 68 to the upside. So we've seen, it's pretty broad-based in terms of what we're seeing for the selling.
Okay, so Max mentioned bank earnings. I want to go there. You're going to be live. You're both going to be live blogging them.
Can I just follow on what we were saying? I know. Hang on a second, though. Has there ever been another moment in time, where we don't feel like people feel comfortable to kind of say the truth? And I guess that's why I was going back to 2008. I mean, look, we needed to know what was going on. Very different crisis. That was a crisis. Nobody wants to say necessarily crisis yet. But I mean, there is something, if we are not going to get on those earnings calls, like truths, and making connections between this has caused this.
Let me draw your attention to a conversation I had yesterday with, and all of you will remember this gentleman very well, Dick Beauvais, now retired analyst, notorious for his blunt commentary, had a over 5-decade career at various brokerages in Wall Street.
We would have him on for all the bank earnings in the mornings. Yeah.
Right? And you could count on him to speak his mind. He was blunt, often too blunt, people would say. Yeah. But if you had Dick Beauvais with you, you were getting what he was thinking. And I asked him about this moment. I mean, obviously, we were talking about this whole idea of self-censorship and what the JP Morgan analyst was saying, but the broader climate, what other analysts are perhaps feeling. And he said, look, a guy once called me after I published one of my reports and said if he saw me walking down the street in New York, he would run me over with a car, right? His point was, analysts always fear the reactions from individuals, sometimes even corporates. But then what comes after that is what's important, right? He said, but I never imagined it would reach the point where you worry about your own government. But I do believe it has reached that level. Those are sobering words. And of course, he's talking about analysts, but that there is a reason why CEOs and business executives feel like they need to hold their tongue because they do not want to get on any hit list.
Speaking of holding your tongue, I just want listeners to understand that when Sridhar said that I was a veteran reporter in 2008, that was his way of saying that I'm very old. And I just want to clarify that I was actually a rookie reporter in 2008, so I don't want listeners to think I'm older than I am. But I want to speak about, I think maybe, Sri, is it fair to say that the Dick Beauvais of our time would be Mike Mayo? I want to call whether or not Mayo is a good parallel. At a time when...
He doesn't hold back.
That's right. He doesn't hold back. But at a time when...
This is Mike Mayo of Wells Fargo.
That's right. Veteran analyst. At a time when things feel up in the air and there's fear, different kinds of fear, I think it's helpful for us as financial journalists to just stick to the specific and try to be as concrete as possible. And I was hit by Mike Mayo put out a report really recently. He says that the big U.S. banks in 2025 are going to set aside as much as $60 billion for bad loans if, and that's a big if, uncertainty climbs to the levels that we saw near the start of the COVID-19 pandemic. So to Shree's point, we are not in 2008. We're also not in the early days of the COVID pandemic. This is something else. But what does Mike Mayo say? Expect more reserve builds sooner rather than later. And we're going to find out in the next few days if that's true.
And more reserve builds would imply that they're concerned about the consumer.
Thank you very much. That's exactly right.
Or recession, right?
Putting essentially setting money aside for loan souring. But, you know, we don't know what's going to happen. And I also don't want to I don't want to contribute to the fear by making it sound like the only way out of this is something bad happening. I find no one can ever predict what's going to happen or things around Trump. Maybe everything will be talking again tomorrow, talking again in a week or in a month, and everything will look copacetic, just fine. We don't know.
It just makes me wonder if like there's going to be the earnings call and then you guys are going to have side conversations with folks who, you know, off the record or whatever, or some context, but don't want to identify to try and really get an idea, Shri, of what's going on.
Yeah, and look, it almost sounds like a cliche. Every quarter, every earnings season, we talk about the fact, well, the numbers are important. People are more interested in what lies ahead. So I don't know how else to stress this, but I think it is truer than ever before that while the numbers are important in Q1, you really want to hear from these bankers what lies ahead. And hopefully they will also lay out scenarios where if the tariff regime went to where Trump originally proposed it last week during his so-called Liberation Day, how bad could it get? How would it be, or what the scenario would be, good or bad? How would it be if it stayed at whatever level he has proposed right now, where you know, tariffs on Chinese goods could be as high as 145%, but also a fairly higher than usual baseline for almost every other good we import? What does that scenario entail, and what they see if all of this were to go away? It would be good to hear them lay that out,
right,
with clarity and whatever level of certainty and assurance they can offer, because then we'll have a yardstick to compare what the government's action should be and how we should prepare for it.
I'm looking at the markets, and we're deteriorating a little bit as we head into the close, down 4% on the S&P 500, 4.8% on the NASDAQ, and the Dow down 3%. Before we let either of you go, one final question heading into earnings tomorrow. Shri, I'm going to give you the first word. Max, you're coming next. The most important thing we can look for tomorrow from the three banks that are reporting?
Again, it sounds rude to say this, but I almost don't care about what they have to say about Q1.
Who cares? Q1's done.
It's all about.
Q1's done.
We have a very good understanding of what it is from the investment bank side. Again, they will talk about deal making, and you know, doesn't matter how this entire scenario plays out in 3 months or 6 months. What it has done for certain is injected uncertainty in the business community, and that is the most. Uncertainty means dampened confidence. Dampened confidence means no deal making. That is going to be a big hit. There's no going to be an easy way to reverse that. So all these expectations you had heading into the year that this is going to be a deal making boom year, now we will be really talking about the fact: is it possible? Is it truly possible that in year one of Trump 2.0, deal making volumes in 2025 might be flat or perhaps even lower?
Which is amazing, right?
And again,
how we started the year.
Problem is, if Trump changes his mind on anything tomorrow, the whole scenario could change, but that's the first question we have for now.
All right, we're going to leave it on that note. You guys rock. Shri Natarajan, Chief Wall Street Correspondent, Bloomberg News, and of course, Max Abelson, Finance Reporter at Bloomberg News. They're going to be up and early, so be watching for their stories on the terminal.
How great is it we get to spend 20 minutes with these two guys?
It's pretty cool. And it's like,
we're lucky.
Blows my mind as we kind of what we get ready to hear tomorrow. So guys, thank you so much. All right, let's get back to the markets, guys. We are seeing another leg down, but we're still off our lows. Charlie Pellet, where are we?
And right now we got 19 minutes to go ahead of the closing bell. Do want to begin with a developing story in New York City. Just getting word that a helicopter has crashed in the Hudson River. No word on injuries. The NYPD says it happened around the West Side Highway and Spring Street. The police department says emergency vehicles, traffic delays can be expected in the surrounding area. The NYFD responding, but again, we do have a helicopter down. No word on injuries, but that's your headline right now on the Bloomberg. The Dow, the S&P, NASDAQ, all very much in the red. Let's head over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. It is an ugly day for stocks, and that's with stocks off the lows. The Dow is currently down 1,400 points, was down 2,200 points. S&Ps are down 4.4%, and NASDAQ is off by 5.2%. The U.S. 10-year is at 4.4%. Gold is in the green. Oil is sinking, and Bitcoin That's down by 4.2%. Among the main 11 S&P sectors, only consumer staples and utilities were in the green. Energy and tech were under pressure. And leaders to the upside in the Dow, UNH and Verizon, while Nike fell 8% and led to the downside. In pharma news, Novartis plans an investment of $23 billion in the U.S. over the next 5 years. And in others, Fed's Goolsbee said a volatile tariff policy means the Fed should wait. In the tech space, Amazon CEO says he has not seen a change in consumer behavior yet. And wrapping things up, bank earnings kick off tomorrow with Wells Fargo, JP Morgan, and Morgan Stanley all reporting in the pre-market. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. Just another developing story to pass along to. A passenger jet carrying at least 6 members of Congress clipped by another commercial plane on the ground at Ronald Reagan National Airport. Nobody injured in the incident, which did cause damage to the winglets on both planes. And again, repeating a developing story at the SAR, NYPD and the New York Fire Department saying there is a helicopter in the Hudson River at Westside Highway and Spring Street. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, you are listening and watching to Bloomberg Business Week Daily. Carol Masser, Tim Stanovic, live here in our Bloomberg Interactive Broker Studio.
It's getting worse, Carol.
Yeah, I was just going to say, we've got another leg down in terms of the equity trade. So here we've got, about 16 minutes to go, and we're now down about 4.6% on the S&P 500. Again, still off our worst levels, but here we are in the final 15 minutes of trading, and we're seeing investors selling potentially into the close here. Dow down about 3.6%, a decline of 1,457 points. NASDAQ 100 down 1,014 points. It is down about 5.3%, and the loss is growing.
Let's bring in Rich Weiss to drive to the close with him. He's Chief Investment Officer of Multi-Asset Strategies at American Century Investments. The firm has about $232 billion in assets under management. Rich joining us this afternoon from Los Angeles. Rich, what's the environment for you right now? How would you describe it?
Oh, I think your prior guest hit it on the nose. Uncertainty, uncertainty on steroids. There's a complete lack of visibility here. Impossible to plan, very difficult to set investment strategy out, a year, much less, a year or two. 2-3 days is impossible. And, while I was waiting to come on your show, I didn't get a chance to check the markets, but I'm not even sure what happened in the last 3 minutes, but it could be significant.
Well, we did see we saw some kind of last 5-10 minutes, some selling. So the loss is deepening. We're still off our worst levels, Rich, but still down, as we said, about 4.5% on the S&P 500, NASDAQ 100 down about 5.2%. Dow down 3.4%. I'm looking at the major industry groups in the S&P 500. Everything is down, but you're looking at energy down 8%, information technology down about 6%, consumer discretionary down more than 5%. All right, so complete lack of visibility. That's never good when you've got to be a chief investment officer. So what do you do? Are investors saying, what are you doing with my money? Do I pull out? Are investors pulling out? What are you doing?
Well, obviously, it depends on the particular client and their unique situations, whether they're, young and just start working, have a long time horizon, or at or near or in retirement, of course, and their risk tolerance. But overall, I think what we've been saying for a while now, and it still holds true today, diversification's your only friend in this type of environment. Nobody knows where the ball's going.
If you've already lost and haven't done anything in the last couple of weeks,
asking for a friend.
Asking for a friend. Like, what do you do?
Yeah.
Do you just stay, or do you because you'd be eventually selling near the bottom, especially on the equity side of things, but a lot of asset classes. Like, what do you do?
Well, diversification means many things, right? Rebalancing back to your long-term norms. But we are definitely not buying on the dips here, right? The flip side of that, of course, is catching a falling knife, which seems to be the rule of the day right now. So we are not buying on the dips. That's a strategy that obviously has worked well over the past, 10 years or so. But this particular downturn is a little more serious than prior ones. Looks to be here for a while. I think you need to be prudent for most investors, cautious, get on the sidelines if you're not already, or again, chasing this market right now is fraught with peril.
You're saying get on this. First of all, I have a couple questions, but why is this downturn more serious than the others?
This one seems to be more like, a catastrophe. It's man-made in this case, COVID, the financial crisis. This is a very serious one, and I take my cues from the market, right, if nothing else. The potential for a slowdown/recession, although we don't use the R word now, we call it a detox period or a slump or an economic adjustment. I'm just paraphrasing from the administration at this point. But the potential for a severe recession, if this tariff and trade policy continues, is very high. And so we haven't seen a significant recession, a long-lasting one, in over a decade, right? There have been some blips. The market's recovered very quickly. But I don't think that's likely to happen this time around, not with inflation running hot and economic growth certainly slowing, decelerating, hitting zero or going negative potentially.
You said that if you're not on the side, I'm paraphrasing because I don't have it right in front of me, but you said something along the lines of get on the sidelines if you're not on the sidelines already. Does that mean
not necessarily selling stocks.
Okay.
I don't want to be misleading. Yeah, not necessarily selling, but depending on where your strategic longer-term allocation should be, again, we would not be necessarily rebalancing by buying stocks at this point. The visibility, there is none. Bonds in a recessionary scenario should be your friend, or cash. If you are going to be purchasing stocks, we'd certainly be looking outside the U.S. versus domestic equities at this point. The whole U.S. exceptionalism theme, I think that's gone at this point.
Gone forever or gone for the next 18 months?
No, not forever. I believe our system will recover and we'll do just fine eventually. But for the near intermediate term, we have some real problems here to deal with. And let's face it, the current policy is not helping. Whatever that policy may be, nobody knows.
Can I ask you, when you say this downturn is more serious than others, it's man-made, it's a catastrophe, and it sounds like you're saying we haven't seen a significant recession, but it sounds like we could. So is it that you're looking at, to be fair, we all look at the White House, we all look at President Trump, what he's going to do. Is it all based on what this one individual, our president, decides to do or not do when it comes to tariffs? Is it really boiled down to that?
I believe it is at this point, with the exception possibly of Chairman Powell, who is standing up. I don't see any other body or person stopping the president at this point from doing what he would like to do, whatever that may be. And so, it does boil down to one person or his advisors, Peter Navarro, or is it Ron Vera? I forget, but one of those guys who's helping him.
You're referring to the expert Ron Vera, whom Peter Navarro is said to have quoted in some of his books.
Right, who's non-existent, yes.
Rich Weiss, hang on for a second. You are Chief Investment Officer of Multi-Asset Strategies over at American Century Investments. We do want to update folks on a developing story. Charlie Pellet hit on it. A helicopter has crashed in the Hudson River on the west side of Manhattan. This is according to the New York City Police Department. The accident occurred in the vicinity of the West Side Highway and Spring Street. The department putting this out in a social media post. So it is a developing story. It's a live story, and we're continuing to track it.
Hey, Rich, what is the best case scenario here? You sound concerned. You sound like you're thinking we're going to see a slowdown. You've talked about this being uncertainty on steroids. You called it man-made. You called it catastrophic. This downturn is more serious than the other ones. What's the best case scenario here?
Well, I'm afraid at this point, the markets clearly have weighed in, right? And the president has backed off a little bit. He flinched, if you will. But the answer may be political, and I'm hopeful we don't have to wait for the midterms to present, some challenge to what's going on. But maybe there are other forces that correct some of this policy, whatever it may be. I'm not sure that the answer is financial at this point.
All right, we're going to leave it there. Hey, listen, Rich, really appreciate your bluntness and sharing your thoughts on the current environment. He is Chief Investment Officer of Multi-Asset Strategies at American Century Investments, the firm more than $232 billion in assets under management. We want to get back to certainly a developing story, another busy news day here.
Yeah, let's bring in Miles Miller of Bloomberg Television, managing editor of Bloomberg Television. He joins us here in our Bloomberg Interactive Brokers studio. Carol mentioned the headline, a helicopter crashing into the Hudson River, according to the NYPD. What else do we know?
Yeah, the fire department told me this afternoon that this helicopter appears to have gone down in the waters off Pier 40, but it happened on the New Jersey side, so closer to the Holland Tunnel entrance on the New Jersey side, and perhaps near Jersey City. What we know at this moment is that one person's been pulled from the water. We don't know exactly the condition of that person. We also know that marine operations boats, so a fire boat has gone to the site where this helicopter's gone down and is looking to do a search and rescue operation. The fire department has divers that go in the water in situations like this, and they do extensive work to try to get people cut out of their seatbelts, all of that kind of stuff to deal with that.
I want to jump in. It's a breaking news situation. We're getting new information as you're speaking, Miles. We're learning, courtesy of ABC, that fatalities have been reported in the Hudson River helicopter crash.
Yeah, exactly. Obviously, a live situation continuing to be developed. At this point, here's a little bit more, too, by our Max Zimmerman. I just want to pull it up. Helicopter has crashed. We've just been talking about this. The department warned in a post on X of traffic delays to expect emergency vehicles along the West Side Highway and Spring Street, Lower Manhattan. You mentioned ABC News said fatalities have been reported, and at least 4 people were on board. So we're getting a little bit. A little bit more.
There were 4 people on board this helicopter. The helicopter flipped upside down, and what we also know is that people were taken to Jersey City Medical Center. That's the staging area right now, and that the fire department on the New York side is also staging at Pier 40.
Miles, there are many types of helicopters that fly in the skies. There are helicopters for tourists. There are those that transport passengers to and from airports. There are those that are used by news organizations to have eyes in the sky. Do we know at all what type of helicopter this is?
Right now, we don't know what kind of helicopter this is. There have been a number of helicopter incidents in New York City dating back. There was the one incident happened in 2019. Helicopter crashed into a building. The top floor of the building killed a pilot. We had another incident where a doors-off helicopter back in 2018 crashed into the East River, killing the pilot and passengers who were on board as well. And then we had another incident with a helicopter where it basically fell off of the helipad on the west side. Everybody was rescued in that incident. So we have a history of this.
I should note for viewers and listeners who are not from New York City, in New York City, helicopters do not land on top of buildings as a result of a fatal crash back in the 1970s. That doesn't happen anymore. What they do is they take off from other parts of the city, airports, they take off from places in New Jersey, but they do not land on buildings in New York City.
And we usually see them taking off either on the West Side Highway or the FDR. I've got to say, I've taken a helicopter ride over New York City and taking it from, I think, the West Side. Having said that, do we know where this helicopter took off from?
No, but we do know that there is a helipad on the West Side there, and so they'll certainly be looking into that. There's no tail number right now as the helicopter's on its belly. Right. But I'll tell you, before, 2 jobs before I worked here, I was at the fire department, and I dealt with a helicopter crash. And in incidents like this, you look at the condition of the sky. It's a cloudy day today. There's some helicopters using visual flight rules who may not be able to see in this. So you don't always see helicopters go up in this foggy, cloudy condition. So
we got to run. Miles, thank you so much. Our own Miles Miller giving us an update on that crash in the Hudson River. All right, folks, just a couple of minutes away from the closing bell on Wall Street, heading over to our TV colleagues. Closing bell starts right now.
To the closing bell, we got
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
about 2 minutes away from the end of the trading day. Alex Steele alongside Scarlett Fu going to take you through the closing bell in a global simulcast. We're joined now by Bonnie Quinn, Carol Massar, and Tim Stenovic, bringing together our Bloomberg television, radio, and YouTube audiences worldwide. We're going to parse through the crucial moments of the trading day, which is pretty much every single moment. We are off the lows, but we're still looking at S&P down 3.3%.
Yeah, exactly, right? Lots of volatility once again, very different tone from what we got yesterday. We are, as you said, Alex, I think it's important that we did see a bounce off the lows. We'll see what happens in these final minute and a half or so of trading, but you are seeing broad-based selling. Most names in the S&P lower here.
We just had a really sobering conversation with Rich Weiss at American Century Investments. He's not buying the dip. He said it's like catching a falling knife. Vonnie, he says this downturn is more serious than the other ones. He called this a man-made catastrophe.
And by the others, he means the great financial crisis or COVID. I mean, this is what he's saying the environment is.
Yeah, I mean, Ben Emmons calling it this morning a yippee-ki-yay market, and it really does feel like the Wild West out there. We haven't had any circuit breakers triggered, but we certainly have had moves of more than 5%, 6% in some cases, and we may not be done. Bloomberg's Matt Levine saying this is a buy the truth, sell the news moment. So what is the truth? The truth is that there are plenty of tariffs, and they have been put into effect.
Well, the truth is nobody knows what's going to happen, and the data will be backwards looking, although we do get the University of Michigan Consumer Sentiment report tomorrow, and inflation expectations on a one-year basis. That'll be critical because that's a lifetime read, although it is based on what people say, not what they do.
I love me that you Mish. I should point out, guys, we just talked to Steve Sosnick, and he was saying that retail clients are still buying that dip. That conditioning still stays. There we go, the closing bells on this Thursday. You're looking at declines for the S&P coming in around 3.5%, the NASDAQ around 4.5%, the Dow up 2.5%. I should point out, if you take a look at the S&P, the NASDAQ 100, the NASDAQ, the MAG 7, they all fell the most at one point today since 2020.
All right, to the S&P 500 I go, guys. 428 names to the downside on this Thursday, 74 to the upside. Scarlett, one unchanged.
All right, let's take a look at the IMAP, which shows you the different sectors in the S&P 500. Basically a sea of red, although you can see that consumer staples did finish the day just marginally higher. Yeah, by 0.2%, and that's thanks to the likes of Kroger, Church & Dwight, Colgate, and Kimberly-Clark. So classic defensive consumer staples, companies that will be around, that will continue to do business even in a tough economic environment.
All right, that's a lot of red. I was terrified to find gainers today that they would hold, but
I
got a few.
You did it.
Kroger up 3%, guys. The consumer staples.
You got 4. That's what we call an overachiever.
I was. Consumer staples, I think as a whole, I think they finally blipped into the green a little bit overall, but nonetheless, we saw some pressure on that group. But Kroger, among the names that did actually show some gains, up about 3%. Gold, right? Mining stocks advancing today. Bullion prices climbing to a fresh record. And so you saw investors moving into this. A safe haven, right? Gold. And so you saw Newmont among the gainers, up about 4.5% in today's session. This one's up about 35% year to date. Here's a biotech company, folks. Keros Therapeutics up about 18.5%. This is after initiating a review to evaluate strategic alternatives. They're also thinking about a potential sale. It's based in Massachusetts. It also adopted a shareholder rights plan in response to, quote, significant and rapid accumulations of the company stock by investors who have indicated a desire to influence the control of the company. So this one was an outperformer. And here we go. PriceSmart. I've never heard of it. It's up 7% today. This is a $2.7 billion market cap, an operator of warehouse clubs in Latin America, and they reported second quarter earnings per share that beat estimates. So that's where investors were hiding today.
You got to travel abroad to find those gainers, Carol. Easy job that I had. In fact, I picked a couple indexes because there were so many stocks lower.
Embarrassment of riches.
It really was. I want to start with the MAG 7, down 5%. Dragging down indexes a day after posting its best day ever. Yesterday, it rose 15%. Today, it fell as much as 8%, but it settled in lower by 5%. Tesla, Meta, NVIDIA, and everything else in the MAG 7 were lower. And have you guys talked about what happened to CarMax today? Shares falling 17%. This after the company said it's removing timelines from its financial goals due to uncertainty around President Trump's trade war and broader macro factors. They are, though, seeing increased demand for used cars, and prices are going up for them due to expected tariff impacts, though they're facing rising costs for parts, and they're looking at mitigation plans as well. Also, keep an eye on shares of Disney. Disney fell by, let's go ahead and round that up to 6.9% today. This after we learned that China will reduce the number of imported U.S. films and introduce more films from other countries. That's according to a government statement. Disney got about 10% of its revenue from the Asia-Pacific region in 2024. That's how it breaks it down. The president was asked about this news from China earlier today at his cabinet meeting. His answer to the question was, quote, "I think I've heard of worse things." He did not elaborate beyond that. And finally, semiconductor stocks getting beat up today. This after they were up 19% yesterday. The stocks fell 8% today. Everything was in the red.
An interesting one as well was the 30-year auction. We were all waiting for that at 1 o'clock to see if there would be a bid, and there was no buyer's strike. It was good news for that auction. Pretty strong demand, although if you're looking for any kind of a directional signal, the bid didn't hold quite so well as yesterday's auction after the auction. So we had the 30-year rise about 4 more basis points after that auction to finish the session now at 486.51. I will point out, though, that the 2-year went in the opposite direction, down 6 basis points, 384.33, right in the midpoint of its 2-day range, if you like, because we have seen a 40 basis point round trip for the 2-year yield, but it's in the midpoint there, and that was after the CPI data salved some egos out there.
Yeah, and I should point out, too, that 30-year moved 54 basis points in 5 trading days. You had that 5-10 spread really steepening out, the highest, or the widest, I should say, since 2021. And my question is, until bonds calm down, can stocks calm down?
Probably not, right? And so this is why I guess our shift begins now. Earnings, right? Bake earnings tomorrow. And I'm looking at the KBW Bank Index down another, 5% in today's session after a 9% rally yesterday. Very different tone. But what we get on those earnings call, nobody cares about the quarter that was. Everybody cares about the outlook. What do we get in terms of commentary? And on that, I'm going to bring you in, Tim, because we just had a great conversation with Sri Natarajan and Max Abelson. There's a great story on the terminal about a JP Morgan analyst kind of holding back in a conference call, a presentation, because concerned about maybe saying certain things that might get the attention of the White House.
Yeah, this story getting a lot of attention. The strategist has been lauded by Jamie Dimon as one of our firm's great thinkers, and he's taken this unusual step to highlight fears on Wall Street over speaking out against the Trump administration. To that point, Max and Sri also telling us loan loss provisions and any commentary on how these banks tomorrow are thinking about this current quarter, given the impact of tariffs, how they view consumers, and how they're doing. Remember, it's JP Morgan, Wells Fargo, and Morgan Stanley that are reporting tomorrow morning.
Thank you for the reminder. You know, going back to that.
I sense like you know this already, Scarlett.
Going back
it's
to
like
that,
the moment we've all been waiting for.
Exactly. Going back to that story, though, that you mentioned about JP Morgan strategists being careful about what they're saying, it kind of shows us how the U.S. is starting to, I don't know, in some ways behave like an emerging market. And you see this in the way that people are being extra careful in what they say and how they say things, as opposed to a developed market.
Yeah, I mean, it's going to be interesting to see the price action tomorrow, right? Because we have another day's trading, and we've had such a whippy week and so many differing things out there. And don't forget, there may be another China response later on this evening. China just getting up to start their day. They're meeting with some of their products with a 145% tariff on them. What's the response going to be? A further weakening of the yuan?
Well, you have to also wonder, too, what the tape is going to look like for these banks, guys, which I'm really curious about, right? I mean, we saw Delta rally despite pulling guidance because we had an up tape, and then you saw CarMax saying that their targets might not be hit in their time frame, and you saw it get pummeled. So I think how we set up the tape will be really interesting as well.
I agree, right? How investors read into it, or whether they're like, I don't care. All I care about is what I'm getting in terms of tariffs and what the future looks like in terms of a trade war. Do we have one? Do we have one that lasts for a long time? Do we have one that just lasts for a little bit of time?
Well, I think key is to watch what happens in China. I mean, if you just look at the tariffs each and every day, we're seeing more tariffs imposed by this administration on China, up to 145% from 125% just earlier this week.
Yeah, well, that number can still increase because it went from 125 to 145 today. It's kind of clear that there are a lot of tariff threats issued over the last couple of days, and in adding it up, you know, it's hard for us to understand where we're at because it's a moving target.
And what I'm curious about is, does China and Europe try to strengthen their alliance? It certainly seems like the PR messaging out there from from China, at least, is that it's, making definite advances to Europe and offering things to Europe and asking Europe for help. Will Europe, decide to help China, to the detriment of the United States, or, does that get nipped in the bud pretty soon?
Gotta say, I was sick on Monday, and it feels like has been a month this week.
Oh my gosh, totally.
Crazy. All right, guys, that's a wrap. Our cross-platform coverage on radio, TV, YouTube, Bloomberg Originals. We call it the closing bell, and we will see you all tomorrow.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody. Among our most read stories on the Bloomberg, no surprise, a helicopter crashing in the Hudson River. The New York Police Department telling us this, giving us the update. There's been at least one fatality, while 2 people have been rescued and taken to a local hospital, according to a person with knowledge of the matter. At least 4 people, Tim, were on the flight.
For more, we bring in Naha Katan, a Bloomberg News, a greater New York reporter. Naha joins us here in the Bloomberg Interactive Brokers studio. A developing story. The details are scant at this point, but what do we know?
Not much more than what's already been reported. There could be more than 4 people. It could be 5. We understand that from images, the helicopter fell into the river upside down. The people were taken to local hospital, probably on the Jersey side, because it happened closer to the Jersey side, but it's still developing.
And we don't know exactly where they took off from, right? We still don't have details on what the flight was, where they came from. These are things that we're just kind of waiting. And we should remind, for those who are watching on YouTube and Bloomberg Originals, we are showing live pictures of the Hudson River. And again, that is the New Jersey side. And so you can see certainly some activity around there. It's a little bit tough to see, but obviously there's some boats, I would assume some rescue boats, some fireboats, just kind of assessing the situation, probably looking for any survivors.
At this point, do we know what the type of helicopter that was involved? Military helicopters, police helicopters are constantly flying in New York City. We also know that there are services that take passengers to and from parts of the city to airports and back and forth, helicopters that go to the Hamptons as well. There are popular rides for people who are visiting and for people who live in New York to look at New York City from above. Given the number of people and what we know, any indication about the type of helicopter?
I have seen some reports that it was flying into New York City. That's what we know at this point. And we also, there was another aviation incident earlier today when a passenger jet was clipped by another aircraft, and there were some Congress members aboard. So they were tweeting from there exactly how it was happening, how it felt.
Well, it raises the question, too, about the FAA at a time when, it's under a lot of scrutiny because of the mid-air collision in Washington, D.C. earlier this year, and then other reported incidents of crashes from not commercial airlines, but other airlines, not necessarily happening more often, but there is a different type of scrutiny, it seems, on the FAA right now. Do we have any information from federal authorities on this, or is everything right now still coming from New York City?
It's all coming from our sources in New York City right now.
Yeah, I mean, listen, we can certainly speculate and stuff, but you don't know whether there was something that actually went wrong, right, with the helicopter itself. And this is where getting the wreckage, talking to those survivors, and getting an idea of exactly what went down. And understanding kind of where it took off from. Again, we were talking about it's cloudy out there, but I mean, helicopters tend to fly fairly low. And so, again, we're looking for some more details on this. But just if you are joining us, a helicopter has crashed in the Hudson River. There's been at least one fatality. 2 people have been rescued, taken to a local hospital, according to someone with knowledge of the matter. And at least we're talking with our Naha Katan, who said that there's either 4 or 5 people. A city official said at least 4 people were on that flight. So again, a lot of unknowns, and we're trying to fill in some of the holes here.
Naha, we're going to let you get back to reporting on this breaking news. Appreciate you stopping by. Naha Katan is Bloomberg News Greater New York reporter joining us here in our Bloomberg Interactive Brokers studio. Red on the screen today, the S&P 500 closed off its worst levels of the day, down by 3.5%. The Dow Jones fell by 2.5%. The NASDAQ fell by 4.3%.
All right, so we want to get to kind of the environment that we're in today. And Bloomberg Business Week editor Brad Stone writes in the Business Week daily newsletter that in the first Trump term, cabinet members such as John Kelly, Rex Tillerson, and Gary Cohn were considered adults in the room, the guardrails. These were experienced executives. They understood how markets work, the business environment, and they were veteran policymakers who could counter the president's most destructive impulses, Tim.
The concern that I think a lot of people have, and Brad writes about it, is that now the cabinet is packed with loyalists and have feared that there would be no such tripwire to avert campaigns against real and perceived enemies at home and abroad. Brad Stone is the editor of Bloomberg Business Week. He's also the author of many books, including Amazon Unbound, Jeff Bezos, and the Invention of a Global Empire. Brad, good to have you with us this afternoon. What was your takeaway, or what has been your takeaway, from the market carnage that we saw over the last week, the volatility yesterday, the decline today, and the messaging from the White House?
Right. We packed a lot into the week. Hi, Tim. Hi, Carol. Look, I mean, overall, the story today is that these tariffs still pose enormous concerns to the market, to investors, to companies. You've mentioned a bunch of them on the broadcast. And there's still lots of questions about if and how these will be implemented and what they mean for prices and treasuries and equities and the like. When I wrote that newsletter on, let's see, today is Thursday, so it was yesterday.
A lot has changed.
It was minutes after Trump had posted on Truth Social withdrawing lots of the tariffs, increasing the tariffs on China. And I wrote that there was a palpable sense of relief. Now, it might have been short-lived, but you're referencing the first Trump term. My favorite story from the first term was when Gary Cohn, I think Bob Woodward reported this in one of his books, was actually taking letters from the Resolute desk in the Oval Office that Trump wanted to sign, like withdrawing the U.S. from NAFTA. But the idea was, yes, that there were sort of adults in the room, seasoned voices, sensible opinions. And I think part of the momentary relief of this week was that Scott Bessent and Howard Lutnick, despite maybe what they had been arguing before, really broke with some of the hardliners like Peter Navarro in the administration, and that Trump really listened to members of his coalition, Bill Ackman, Jamie Dimon, essentially listened to what the market was telling him and made at least a movement towards sanity.
Yeah, this is what's interesting, right? Brad, I think about how much going into the election and coming out of it, we were like, well, wait, there's going to be no guardrails this time. The president's been, or Donald Trump at that point, even on the campaign trail, clearly talked about putting people that were going to carry out his wishes and kind of, I feel like there was almost a feeling, no, it'll be okay. He's going to listen to watch the stock market and so on and so forth. Yet here we are. And it does beg the question, is he really listening to the business community? Is he listening to informed voices on, the economy and what tariffs do? Or is he kind of doing his own thing?
Well, I think what we've seen this week is that he is sensitive to those voices, and he is certainly sensitive to the stock market, to bond prices and treasury yields, does not want the phrase bear market next to his name. But that when it comes to tariffs, he is just a president on a mission. And I think back to the Business Week interview with then candidate Trump over the last summer, and I went down with some colleagues, and we interviewed Trump for almost 2 hours, and we really all marveled at his fixation, not just on tariffs as a way to raise revenue, as a way to what he thinks is to reinstill fairness in global trade, but his sort of devotion to the memory of good old President William McKinley in the late 1800s, who he believed had a very sensible trade policy, and it came up a number of times. And so this has really become key to the Trump dogma, I guess, if you will. And so I don't know if even though maybe we got some relief this week, that this is he is sort of determined to go down this path, and I don't know if it's ultimately going to matter what business leaders and what stock market prices tell him.
Okay, so that's what I want to talk about, because like you said in the first term, he seemed sensitive to them, and he talked about the way that the Dow was doing and the way the S&P 500 was doing. He liked to post on Twitter at that time about records that were reached during his administration. Yes, he talked a little bit about that yesterday, but when he was asked about the stock market today during the cabinet meeting, he said he hadn't seen it. And this is a day that was a down day, and at the time, stocks were lower. Does the market guardrail still exist in your view?
I mean, he's paying close attention, right? Was it this, again, I've lost all track of time, but he said at one point, the bond market is now beautiful. He's paying attention, but I don't know if it's a guardrail anymore, because I think that there's a belief that, that tariffs and trade war will administer some short-term medicine, and it might be painful, but that in the long term, he believes it'll be good for the country. And look, I mean, this is probably not a president who's running for re-election. Of course, we've got to hedge that a little bit. I think he's concerned about his legacy, but I think he's more willing to go down this path, even if the indicators are all bad, because he just has this deep dogmatic belief that this is the way you fix the American economy.
Yeah, he's certainly been a big believer in tariffs. Brad, hang on for a second. We're talking with Brad Stone, editor of Bloomberg Business Week. We do want to give you an update on that helicopter that's crashed into the Hudson River. ABC News is reporting at least 5 people were on board, including children, and at least three were killed, in that crash. We also have a headline from our own Bloomberg News team that the New York City mayor has been briefed on this crash. So again, we don't know where it took off from, trying to find out what kind of helicopter it was. But again, it does look like some reports of greater fatalities than first thought.
Brad, I want to go back to you. No easy segue here, but talk a little bit about the difference between this administration and the first Trump administration, and also any contrast that you're seeing, within these first 100 days versus the Trump that you met as a candidate. And we should remind everybody, this Bloomberg Business Week cover story of the Trump interview was almost in this different time, almost in this different universe, because it was just days before he was shot in Butler, Pennsylvania at that rally.
Right. And he was still running against President Biden at the time.
Yes.
Well, look, I mean, one thing that is different is that this is, in the second Trump term, a much broader coalition, right? He got more votes and won with a decisive electoral majority. And in that coalition is not just like the classic Trump Midwestern blue-collar voter. He won a lot of the swing states, but also business leaders, I think, are a much larger part of the coalition right now. And if we do take some lesson from this week, and, for those who think that a trade war and reciprocal tariffs are a bad idea, could take some hope in the fact that, there are voices in this coalition like Bill Ackman, like Elon Musk, for example, who had some very strident words on X to say about Peter Navarro, or Jamie Dimon. I mean, I don't know if he's necessarily a member of the coalition, but it was clear that Donald Trump saw Jamie Dimon's appearance on business television this week, where he said that the chances for recession were very likely. Or, Larry Fink of BlackRock, who our own Eric Schatzker interviewed this week, in just a tremendously timed interview, where Fink said that the market could decline by another 20%. I think Trump sees these business leaders as his supporters, whether they are literally or not, as members of his coalition. And so I think that's different, right? That he is going to want to appease and appeal to these business interests as he navigates and pursues his tariff strategy.
Hey, Brad, how are you thinking about the coverage in Bloomberg Business Week? Especially you guys are always so, in touch with corporate executives, CEOs, folks who are running companies. And I'm just wondering, in an environment where it does feel like CEOs are very careful about what they say because they don't really necessarily want to get the attention of the White House or become a target. So it's an interesting time. We were just talking about this with our Sri Natarajan and Max Abelson about the big banks tomorrow. coming off of a JP Morgan analyst who gave a presentation but was very careful about what he said because he didn't want to bring attention to his firm. So it does seem like we're in a little bit of a different environment about executives being very careful and cautious in terms of what they reveal.
It's absolutely true. Everybody's speaking very carefully, using some coded language. At Business Week, you know, we're covering it every day. We're trying to understand the president's intentions, you know, the impact of the trade war, not just on markets, but on consumers. You know, Americans and people all over the world are incredibly price conscious these days. So, you know, what these even 10% baseline tariffs mean for prices at Walmart, at H Mart, at the gas pump. We're paying close attention to that. And essentially trying to like select these moments. As you know, guys, we not only do we cover these issues every single day as part of Bloomberg.com, but we produce a monthly magazine. And you can just imagine trying to close a monthly, which we're doing this week, is like trying to jump onto a locomotive because things are moving so quickly. But I think it's an important moment, and I think we stand right at the brink of really a changed world order, for better or for worse.
Brad, one thing I got to ask you about is the tech world. You come from a tech writing background. You've written several books about Jeff Bezos, including the Everything Store. And I'm curious about the view of these tech leaders who supported Trump at the inauguration but have lost so much money. Just 30 seconds more.
Yeah. Well, I mean, I think they're probably exerting themselves and making their opinions known via back channels and calls to administration. But like publicly, we saw Amazon withhold or put on pause some orders from China. We've seen Apple move the supply chain out of China, try to protect itself now for many years. And so, look, I think they're all scrambling and keeping their heads down, but, you know, probably thinking a little bit about what this means for them and their businesses.
All right, gonna leave it there. I'm so glad we could catch up with you. Brad Stone, editor of Bloomberg Business Week, joining us, of course, there from the West Coast.
Hey, let's get an update on business news and everything that's happening in markets. Here he is, Charlie.
All right, I thank you very much, Tim. Do want to begin with the helicopter crash in the Hudson River. ABC News now reporting 3 dead in that crash in the Hudson. ABC News says it released 5 people, including children, on the helicopter. Mayor Adams has been briefed on the crash. Video shows the boats in the area with the helicopter upside down in the water. Again, NYPD, NY Fire Department also at the scene. But again, ABC now reporting 3 fatalities. All of this comes on the same day that a passenger jet carrying at least 6 members of Congress was clipped by another commercial plane on the ground at Ronald Reagan Washington National Airport near Washington, D.C. Again, we are following both of these stories for you, but the key headline here, ABC News now reporting 3 dead in that New York City helicopter crash. Stay with Bloomberg for the latest. The Dow, the S&P, NASDAQ, another down day today with a 3.5% drop on the S&P 500 index, down 188 points. That was well off session lows at the worst level of the session. The S&P had been down more than 6%. The Dow down another 1,000 points today, down 2.5%. This, of course, after yesterday's surge for stocks in which the S&P 500 yesterday was up 9.5%, today down 3.5%. NASDAQ lower by 4.3%. Russell 2000 index of small cap shares also down 4.3%. 10-year 4.40%. The 2-year 3.85%. Gold up 2.9%. 31.71 the ounce. West Texas Intermediate crude just above $60 a barrel. 60.19 right now on WTI, lower by 3.5%. Bitcoin down 4.3%, 79,575. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Do appreciate it. Charlie just gave us the numbers, but they're worth repeating on a day such as today, where we saw a lot of volatility. The S&P 500 down 3.5%, the NASDAQ Composite down 4.3%, the Dow down 2.5%. Carol, at one point in the session, we saw the S&P 500 down more than 6%. At one point, that superlative flashed on the Bloomberg screen. Worst day for the S&P 500 going back to 2020. That's not how we closed.
No.
But it speaks to the volatility that we're seeing in the session.
No, absolutely. And I think we were watching very closely to see how things moved into the close. And so we did finish well off our worst levels of the session. We did not see selling into the close, which certainly would have dampened sentiment. Yeah, no. But a little bit. And then we kind of bounced off of it. So it was interesting to see that kind of moving. But I'm looking at the VIX. It moved up 7 points. We're at 40. We were as high as almost 55 today. Earlier on Bloomberg Surveillance this morning, one of the guests talking about when you are hitting, 55, 60 on the VIX, you should expect often a lot of big swings in any given day when it comes to the trade. And that is exactly what we're seeing. Again, so much of it taking its cues out of the White House. But eventually, sentiment gets dampened enough. Companies don't spend, companies don't hire, consumers don't spend. Big banks tomorrow when they report earnings going to be so crucial in terms of what we hear about the outlook and what they are seeing in terms of visibility.
Hey, I do want to talk about one of the top stories this hour, Carol, and that is the breaking news story that we're following. The helicopter that has crashed into the Hudson River, the New York Police Department reporting this, the latest sign in a string of aviation incidents in the past few months. There has been at least one fatality. 2 people have been rescued and taken to a local hospital. This is according to a person with knowledge of the matter. 5 people were on the flight, including 3 children, the city official said. I want to bring in Miles Miller. He's managing editor for Bloomberg TV. Miles, a fast-moving story. I was just reading the first 2 paragraphs of what you wrote and put out just minutes ago. What else do we know?
Yeah, so right now what we know is that there's been at least one fatality on that helicopter. It took off from Lower Manhattan and made its way up the Hudson River, and for some reason that helicopter flipped over into the Hudson River, and then it became an intense rescue operation from the NYPD and the FDNY's marine units and harbor units to try to get to the people on board. We know the helicopter is cleared, meaning nobody is left on board. 5 people were pulled from the wreckage of that helicopter. 1 person died. We know that 4 people were taken to Jersey City Medical Center. And this is important to note. Of the people who were on board that helicopter, there were 2 adults and 3 children on that helicopter. This is a thing that has been talked about for years in New York City, the number of helicopter flights that take off from the Hudson and East Rivers, and we are not immune to helicopter crashes in this area. In fact, in 2019, there was a helicopter crash on the west side. Luckily, no fatalities in that incident, but then a year earlier, a helicopter all people on board. So it's definitely something that the fire department has dealt with in the past. And when things like this happen, they put divers into the water in an effort to reach them, cut their seatbelts off, and see if they can get them to help.
I will say, too, and just so you, some of the headlines that we've also seen, Miles, from ABC, at least 5 people on board, as you said, including some children, at least 3 killed in the Hudson River helicopter crash. Again, ABC News, and I know this is, a developing story, and it's very fluid at this point. You're on the scene, or where are you?
Yeah, I'm on my way to the scene. I'm on the West Side Highway right now. And just to set the scene of where this is, this happened basically just due north of the Hudson River, of the Holland Tunnel. And what we also know is that both units on the New York side and on the New Jersey side responded. This is a New Jersey incident, so New Jersey State Police will be involved in this. The New Jersey Attorney General's office will be involved in this. But there was certainly an effort by New York officials to get to the scene quickly and try to get to as many people as possible.
And certainly the FAA at some point will be involved in this. I want to bring in Sid Phillip, Bloomberg News, Deputy Team Leader and Senior Editor for Global Aviation. He joins us here in the Bloomberg Interactive Broker Studio. This comes on a day where at least 6 members of Congress were on this passenger jet that was clipped by another commercial plane on the ground at Ronald Reagan Washington National Airport near Washington, D.C. Yeah. Of course, these incidents shaking the confidence in the safety of the U.S. aviation system following that deadly midair collision. Are there more incidents happening right now, or are they just getting more attention?
It's a combination of both things. So there are more incidents that have taken place, but there's also a sort of greater awareness of things. So essentially minor incidents where another plane clipped another plane's wing, which did not really result in any injuries, did not result in anything, would normally just be a blip on the radar. But the fact that there's a lot of scrutiny on aviation safety incidents at the moment, following that fatal crash in DC, does sort of turn up the volume on aviation safety in the US at the moment.
I just want to mention a headline crossing from the FAA, a Bell 206 helicopter. So we're getting some identification. Again, things are just coming in drips and drabs. I mean, I have a lot of questions about where it was coming from, private ownership, who owned it, was it a tourist, right? Because we have a lot of those tourist helicopters around here. We also have a lot of corporate, but we have a lot of tourist.
Exactly. I mean, we're looking to see what the details on the ownership of the helicopter, the age of the helicopter, how many people were on it, all of the I mean, in terms of what the capacity of the aircraft was and everything. So we're trying to still narrow down what the specifics are and which airline, which operator was operating it, how old the aircraft was. But we're still sort of waiting on those details, and we're still working on getting that out.
Hey, Miles, come on back in here, because it does seem like every few years there is an incident in New York City with a helicopter. And then following those incidents, there are questions raised about regulation of these, how crowded the skies are, and about who's actually operating these helicopters. Talk a little bit about the questions that come up after this, because we do talk about this, I would say, every 3 years or so.
Oh, yeah. You know, so I was the chief spokesperson for basically critical response at the fire department. And, you know, in my time there, and it was a short period of time, we had 2 helicopters go down. So it's always something that is in the minds of people in New York. Obviously, the 2 heliports here in New York City are operated by the Economic Development Corporation. There have been questions about whether that should be transferred over to Port Authority because they operate our airports. Then there are questions about how many helicopter flights take off in New York City. You know, if you live in New York and you go to the waterways, you're always seeing helicopters taking off and landing, and there's questions about just how many. And then you've got the operators, right? You've got, you know, folks who are doing doors-off helicopter flights. You've got Blade involved, a major operator here in New York. Uber's involved as well. And so these have been questions for many years. But you'd have to say, with the amount of flights that take off in New York, the record for helicopters in this city is a positive record because so many helicopters take off from New York. But the question is about regulation and also about who operates these heliports, and you know, if there is sort of stringent record keeping about how about you know, flight records and all that. But I also have to say, you know, I'm looking up at the sky right now. I have eyes on the wreckage site in Jersey City, and it is a cloudy day. You know, what were the conditions when this helicopter took off, and is it a good day to be flying, especially for a helicopter? If you know anything about the way that helicopters operate, they spend most of their time trying to get back down. So they're fighting gravity every time they go up. So that's something I learned along the way covering helicopter crashes.
We're talking with Miles Miller, BTV and radio managing editor. Also here in studio, Sid Phillip, Bloomberg News deputy team leader for global aviation. You know, Sid, one of the things I think about the difference between planes and a helicopter, a plane, if it gets into trouble, can maybe glide its way in. A helicopter, if it's mechanical or there's some problems and the blades stop, there's not much you can do.
Helicopters also have emergency landing measures, but at the same time, they're much harder to fly and much harder to control, and which is why it's much harder for the pilot to fix things when things go wrong. And so statistically, helicopters are efficiently very, very safe. But when things go wrong, it's very, very difficult. And given we don't know what the circumstances were yet, we don't know what the conditions the pilot was dealing with, and what the issue was, and so we still have to wait and watch.
Lots of questions.
Yeah. Another headline crossing, Sid, that I want to get you to weigh in on. The FAA and NTSB are to investigate the New York helicopter crash. Not at all surprising that we're seeing the federal authorities get involved here. Typically, though, an investigation such as this can take years.
It can, and so we will know the details of it as the days go by, and the formal investigation could take years. And so we're looking to see what the initial details are, what we sort of gather a preliminary, but then once we actually get the major details, that's when we actually know what really went wrong.
I just want to mention an AP story. Now, this crossed about 4:27 p.m. Associated Press saying 6 people have died in the helicopter crash in the Hudson River in New York City. Of course, this happened just off of Manhattan. Fire department said it received a report of a helicopter in the water at 3:17 p.m. Wall Street time. Videos posted on social media showing the aircraft mostly submerged upside down in the water. The fire department, as we've been talking about, saying it had units on the scene performing rescue operations. Multiple rescue boats were seen on video circling the aircraft. And again, yeah, a lot of other emergency vehicles, fire trucks, other emergency vehicles on the streets near the scene where their lights were flashing.
We're getting some additional news from the deputy mayor for communications commenting in a post on X. The New York City mayor has been briefed on the helicopter crash in the Hudson. FDNY has divers in the water, and the NYPD News has the harbor unit searching as well. There will be more details and a full briefing to come. This is according to a post on X from the New York City deputy mayor for communications.
We are talking with our own Miles Miller, BTV and radio managing editor, moving in on the scene there in New Jersey. Sid Phillip, Bloomberg News deputy team leader, Global Aviation. Top of mind for you, Sid, as again, it's really rough. We don't want to speculate. There's a lot to be known in terms of knowing what happened here specifically, what caused the crash. But what are you thinking about in terms of this situation? I mean, again, we have been talking about a lot of aviation incidents. Coincidence, or is there something more significant that maybe regulators need to look into?
I mean, I think we'll have to wait for the investigation to come out to actually see what went wrong and then sort of put that together, saying that this is another one of those incidents where there's some regulatory scrutiny required. I mean, at the moment, it does seem like that is a coincidence with just a bad run of incidents that have happened lately.
Did we mention what happened at Ronald Reagan earlier?
Yeah, we did. The earlier today, and then also what we saw earlier this year in the Washington, D.C. area with the collision, the midair collision back in January. I do want to bring in Miles Miller, who is continuing to make his way to the area that is being searched by the NYPD and the FDNY. Miles, just give us an update on where you are and what you're seeing.
Yeah, so just, and I think this is important for our terminal listeners to mention this. Where this helicopter went down is right in front of the DTCC building, the depository clearinghouse building. It's just about, I would say, 15 blocks south of the ferry terminal in Hoboken, New Jersey. The scene is situated right in front of the Holland Tunnel exhaust building. It's that Art Deco building right on the Jersey City shoreline. I can count about 15 boats that are in the water, a big FDNY boat, some of their Zodiac boats, some of their smaller crafts, about 45 feet boats that are still doing the work. They believe that they've gotten everybody who was on that helicopter off. And now we know that they are confirming that more people may have been killed as a result of this. But certainly it's quite a sight to behold. Then over on the Pier 40 side, FDNY, NYPD all staged there, still trying to get some more information about what happened here.
Miles, we are also hearing from ABC News, 5 out of 6 people on board were killed in the crash. This is coming from law enforcement sources.
Report.
Right, which said 6 people. And ABC News is saying law enforcement sources told them that.
Now just to work that out, right?
Yeah.
We reported 2 adults and 3 children. You would need to have probably an additional person who would be flying, who would be operating the aircraft. So that's probably where that's coming from.
ABC also saying the helicopter was carrying a pilot, 2 adults and 3 children. And they, again, citing law enforcement sources. The family members were tourists from Spain, according to the sources, and that the helicopter...
Just had that confirmed as well.
Excuse me?
Just had that confirmed as well.
Okay, great. And they said the helicopter was in the air for about 12 minutes before the crash. I'm just getting, again, they're just talking about some eyewitness stuff about people hearing some sounds and the helicopter splitting in 2 with the rotor falling off. Another witness telling WABC 1 propeller broke into pieces. So again, the FAA has identified it as a Bell 206 helicopter. and was upside down in the 50-degree water, so very cold as you would expect when rescuers arrived to the scene. And Miles, as you've been saying, closer to New Jersey, the New Jersey side of the Hudson River.
I want to give you a little
please.
piece of detail about this. So we're told now that this helicopter took off from the Wall Street heliport. Now, of course, the Wall Street heliport just got a new operator just about 7 days ago, and a number of flights take off from there, whether they're tourist flights, whether they're business flights. It is one of the busiest heliports in the city. It's also where the president takes off from when he comes into town, Marine One. So it's a very busy heliport. They operate quite a lot of flights on a daily basis.
Sid, there are more questions than answers at this point. I know you were going to just jump in, please.
No, I was going to jump in and say that, I mean, at the moment, I mean, these helicopter flights, the tour flights, they're not very long. They're sort of short flights. I mean, we're looking at the helicopter, not the sort of tour flights. I mean, they're 20, 30 minutes long. And so for 12 minutes into it, wouldn't really be a massive sort of red flag that something went wrong soon after taking off. I mean, that's typically how long these tours last, and it still sort of remains to be seen how this sort of progresses, but we'll have to keep waiting and watching, really.
One of the things that I'm going to be watching for, Sid, is questions that are raised about helicopter operations and operators in the New York City area. Do you expect that to be a point of concern for regulators as they try to piece together what happened here?
I think they will. I mean, regulators will take a look into licensing. They'll take a look into sort of who is operating the companies, the sort of maintenance records for these aircraft, whether people are sort of maintaining them adequately, are the pilots suitably qualified. But I mean, at the moment, it's still early days, and so we're still waiting to see what the government comes up with and what the regulators come up with in terms of their findings, and then they sort of put those regulations in place.
And just, I'm not sure if we still have Miles, because I know he's been moving to the scene. Great. Miles, I just want to come back to you, and if there's any update that you are hearing or seeing.
Yeah, so I'm still seeing a number of crews arrive on the scene here on the New York side. I'm going to get back in the car and head to the New Jersey side, but you're still seeing people arrive, which is usually a sign that they're going to do a secondary search in the water. Initially, the FDNY came in and did that first search with divers. Then the emergency service unit of the NYPD, which does this kind of work every day, will go in, get on a boat, get on a Zodiac, get as low in the water as possible, and then do another search in the water in the area around the wreckage to make sure that there's nobody else on board.
Yeah, and I know the ABC News report said that there is a search ongoing for that sixth person on board, but there are some contradictory reports about saying that either 5 are dead or whether or not there are 6 fatalities. So we'll continue to update everybody on that. Miles, thank you so much. Miles Miller, BTV and radio managing editor, and our thanks to Sid Phillip, Bloomberg News deputy team leader for global aviation.
In the meantime, I do want to head on over to Charlie Pellet. I know he's been watching this story closely, as well as everything happening after hours. Hey there, Charlie.
Hi, thank you very much. And here's what's going on. We've got the Dow, the S&P, NASDAQ all declining again today, with the S&P 500 index down another 188 points today. That represents a drop of just about 3.5%. Keep in mind that at the worst level of the session, we had the S&P 500 index down by more than 6%. Dow Industrials today tumbling 2.5%, down 1,014 points. NASDAQ was down 737 for the NASDAQ Composite Index today. That was a drop there of just about 4.3%. The 10-year, 4.42%, with the 2-year, 3.85%. Spot gold advanced 2.9%, 31.72 the ounce. And West Texas Intermediate crude was down 3.6%, 60.10 for a barrel of WTI. Bitcoin today down by just about 4.1%. 79,807 on Bitcoin. Bottom line, more tariff angst today on Wall Street. Rich Weiss is Chief Investment Officer of Multi-Asset Strategies at American Century, and he was interviewed on Bloomberg Business Week Daily.
For the near intermediate term, we have some real problems here to deal with. And let's face it, the current policy is not helping. Whatever that policy may be, nobody knows.
Rich Weiss of American Century, interviewed on Bloomberg Business Week Daily. Next up for Wall Street, big bank earnings tomorrow morning. Before the opening bell, we'll be hearing from JP Morgan Chase, Morgan Stanley, and Wells Fargo. Yes, complete coverage as those numbers drop, and of course, reaction to those earnings reports. Recapping S&P today down by 3.5% for on-demand news 24 hours a day. Subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Really do appreciate it. As you heard from Charlie, fear engulfed Wall Street again as U.S.-China trade tensions escalated. It sparked a plunge in stocks, the dollar, and oil, while bond havens misfire anew in the latest sign of disorder in the financial system. This comes a day after the biggest stock buying wave in 5 years. Assets tied to economic cycle sank again.
Can I just say I'm exhausted? I want to see what Louis Navellier has to say. He has seen his share of crises, volatility, market cycles. He's chairman, founder, and CIO, of Navellier and Associates, and he joins us from
Rancho Santa Fe, California.
Nice.
Are you just north of San Diego? I don't even know why he's inside right now. He should be outside.
I know.
But it's a beautiful
Don't
sunny
you want
day.
to go outside?
I was out playing golf. Yeah.
Really? So then you're not worried about the market?
No, because I have good earnings. And the real good earnings kick off next week with Taiwan Semiconductor, although I don't own that stock, but it's a bellwether. I think Netflix will probably be okay. And then we'll start to focus on earnings. And I live quarter to quarter. So I think there's 4 months of efficient markets, which is earnings season, and 8 months of mean reversion. And the mean reversion season will end soon.
Wait. Okay. So wait. I'm just like
This is what happens.
dumbfounded.
You know what? You should have gone and played a game of golf today, Carol, because it relaxes you.
Apparently.
And everything is fine.
How do you... So what's your read on Washington? What's your read on the president? And what's your read on tariffs?
The bond vigilantes are in charge. Obviously, Scott Bessent had a meeting with President Trump, and Howard was there, our Commerce Secretary.
Howard Lutnick.
Those are both experts in treasuries, and the bond vigilantes took over. So they had to put the 90-day suspension on.
But so then what do you think was going on in the White House today as we saw a bunch of selling?
I think the bond vigilantes are still in charge. We had a 30-year bond auction, and we got away with it. But the dollar's weak. Apparently, a lot of the people who own our treasuries are net sellers, and they're just not as friendly as they used to be. I personally think that rates will collapse in Europe, and then the dollar will get its mojo back. But for the short term, these big institutional bond players are in charge, and they allowed our treasury yields to spike, and they had to do something, so they put the 90-day suspension on.
Hey, Rich, Louis, we spoke to Rich Weiss at American Century Investments. I'm looking at my notes here to go back to what he told us. He called this uncertainty on steroids. He said he's not buying the dips. He said this downturn is more serious than other ones. He called it man-made and a catastrophe. He was pretty dour. He had warnings. It doesn't seem like you have the same sentiment.
Well, I mean, I'm a quant. I'm a fundamental quant. And I will confirm that our models tightened up. And the models would like us to be in the top 5%, the creme de la creme. The way those models work is when the market goes down 5%, we can withstand that. When it goes down 20, we can't withstand it. They throw the baby out with the bathwater. But fortunately, the babies bounced yesterday. And I mean, I had portfolios up over 19% yesterday. And it was a big bounce. I mean, obviously we got spanked today. So I feel very confident that when earnings come out, things will right itself. I mean, you just want the volatility.
Do you care about backward earnings, or you're saying that you are confident that the outlooks are going to be good too?
No, I'm on the outlooks. I don't have analyst cuts. Okay. I have 80 stocks I own. I do not have analyst cuts. I'm not talking about the top-down strategists that lower their target for the S&P. No, I'm talking about the actual analysts that cover the companies. So I'm pretty insulated right now, and I'm very comfortable. My largest holdings are NVIDIA and Supermicro. You saw how they bounced. I have a big holding in Lilly. Obviously, it's struggling here with the fear of, the tariffs on the pharmaceutical ingredients and all. But, yeah, this could have been rolled out a lot better. Obviously, Peter Navarro was fighting with Elon and all that stuff, and that didn't help, you know. Also, I did notice a lot of the negative press was coming from outside America. And, you know, those markets would gap down and it would put us in a piss poor mood. And this is in the previous days. But, you know, the good news is they're responding to the market. Who knew that Trump Social was one of the best ways to call the market? And that's controversial in itself.
Go on with that. What do you mean?
Well, he's told everybody to buy yesterday morning before the market opened.
You believe that?
Yeah, no, he put in print. It was all in caps with 3 exclamation
No.
points.
I mean, I saw that, but I mean, yeah.
Well,
he didn't tell us what to buy. He didn't tell us whether we should buy cars or houses or stocks. You know, so he's not going to get persecuted for it. I know Adam Schiff wants to persecute him, but you know, I found that to be very interesting. You know,
Louis, given what we learned in the last 27 hours, this 90-day pause, is that just kicking the can down the road here?
No.
Why not?
No, well, there's 2 things. First, we're going to have a 10% tariff, okay? Those are non-negotiable. And the reason they're doing that is we have a big underground economy. So I'm in California where 20% of people don't have bank accounts. And guess what? You either have to put a VAT tax on them or tariffs. So that's what they're going to do to get more tax revenue. As far as the reciprocal tariffs, it looks like most countries will cave. You know, Israel set the standard. But even when they cave, Trump's still trying to extract business from them. You know, like, what are you going to buy? You're going to buy energy? You're going to buy food? What are you going to buy? And so I think that's what's complicating the tariff negotiations is they have to guilt you to buy stuff. And so in the end, we are going to get a lot of onshoring. And we are going to have a boom, but we've created a tremendous amount of uncertainty. So any company that warns, okay, or guides lower is obviously going to get shot. And yeah.
You said we're going to get a boom. So you believe that this trade policy is a good thing?
Because in the end, we're going to have freer trade in the end, except for the 10%. And obviously, we're having a fight with China. We're having an economic war with China right now.
That's a pretty big trading partner to have a war with, given that these are 145% tariffs. When do those get resolved?
I don't think they get resolved. I think, you know, Xi's got his own problems in China, you know, and he's got a deflation problem. And the Financial Times talked about they might have to devalue the currency. The rates are lower than Japan. In fact, they are the new Japan. They're losing millions of people a year. They're losing households. They got problem after problem after problem. So we'll see if cooler heads prevail. But Xi got rid of all the reformers, the ones that were running the economy a few years ago. So, you know, it's just 2 egos going at it. And they might respect each other, but I don't know if they can get it done.
Hey, Louis, have you been moving any money into like Europe and money outside the United States?
No, because I'm expecting the dollar to get its mojo back. You know, in fact, if the dollar does get its mojo back, it's going to help squelch those 10% tariffs. You know, you know, but we already had a great CPI, and we don't see the inflation yet. But you know, if I'm ordering things, it's chaos right now. And in the meantime, we've had all these goods dumped on America. I assume they're going to discount them and sell them. I mean, you know, so I think you know, I think we'll be okay, but we need some leadership. And I think we'll get it from our semiconductors and some other places. In the meantime, we do have an energy problem because oil prices are so low, the premium's not going to be profitable. Right. So that's going to be an interesting development. So if I was Trump, I'd start putting oil in the Strategic Petroleum Reserve to put a floor under this because he doesn't need a boom bust in the oil patch.
What happens if we do get a boom bust?
Well, we're already having a bust now. We don't have a natural gas problem. We have an oil problem.
You call this a bust right now?
Yes, because the Permian will stop drilling. Yeah.
Because it's just not profitable, right? Like you got to have a certain price in order for it to make business sense.
Yeah, I know. Alberta's hurting. You know, this hurts Alberta. they have to use natural gas to steam the tar sands. So this, and then now we obviously want a tariff on the Alberta oil. I think it's 10%. So I was actually at Mar-a-Lago when the Alberta premier was there, and she was not happy. Okay, this is before things escalated. Okay,
tell us more.
She wasn't happy. She's they're sticking up to Trump. She has to, because that's where the pipelines are. Canada used to put oil on trains, but in 2013, one of them overturned and wiped out a nice Quebec town and killed 47 people. So basically, there's no place for Alberta to ship the oil except America, and now we're putting a little tariff, at least a 10% tariff on that. Yeah.
So Louis, I have to ask. We just got about 30, 40 seconds here. Wait, you said you were at Mar-a-Lago. So were you talking with the president?
No, he's president now. Before he was president, he would run around kind of like he's the maitre d', and he was very friendly. But when he is president, his area is roped off, and he waves to everybody. He knows who some of us are.
Were you talking with him before he was president?
Yes, he would come in and say hi, but he pretends he knows me. I don't think he knows who I am. I'm not a member. I guess get invited a lot. I do live in Florida.
All right.
Yeah. Even when you're in California playing golf, you're still in Florida.
Well, I move around. My mother-in-law's here, and we have to check on her because she's elderly. So, but yes, we spend a little time here too. But no, I'm a Florida resident, so yeah.
All right, listen, appreciate getting some time with you, and I'm sure we'll come back to you in the near future. Louis Navellier, Chairman, Founder, and CIO of Navellier & Associates.
Love it when you join us, Louis. Thanks so much.
Yeah, joining us from Santa Fe, California.
Rancho Santa Fe.
Rancho Santa Fe, sorry.
Just north of San Diego.
California boy.
Yeah, I mean, I switch places with Louis any day at this point.
Couple things, guys. Interesting market day. We did see some selling. We did finish off our lows of the session, but still down 3.5% on the S&P 500. Dow Jones Industrial Average down about 2.5%. NASDAQ 100 down about 4.2%. And it was pretty much broad-based selling. So a 180 from what we got in terms of the roar to the upside yesterday. 428 names in the S&P lower, Tim, 74 to the upside. We really have another top story, though, at this hour.
Yeah, I'm going to read right from this story. Miles Miller, helicopter crashed into the Hudson River on Thursday. It's the latest in a string of incidents in the past few months that has rattled confidence in aviation safety. We've had conflicting reports about how many people who were on board and how many people were killed on board. I know we'll continue to get updates from our team as we do hear from Kaylee and David on Balance of Power next.
Yeah, be sure to stay tuned and watching Bloomberg because we will update the situation. That's going to do it for us, though, on this Thursday edition of Bloomberg Business Week Daily. Do not forget, of course, how could you? Earnings season officially getting underway tomorrow with the big banks reporting before the opening bell, bright and early, and we're going to have full team coverage and getting into those analyst call and commentary from the C-suite. That's going to do it from Tim and me. Have a good and safe evening, everyone. We'll see you tomorrow. Balance of Power starts right now.
From the world of politics to the world of business, this is Balance of Power. Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. Alongside David Gura in for Joe Matthew, I'm Kaylee Lyons.
A sharp reversal on Wall Street as President Trump warns of, quote, transition problems from his tariffs policy. And the White House clarifies the levies on some Chinese goods could be as high as 145%. Analysis from Joanne Feeney of Advisors Capital Management.
Plus, we'll hear directly from a member of the administration this hour as Small Business Administrator Kelly Loeffler joins us to discuss the impact of the president's